Welcome back. As promised, we'll get to all the stocks that are in focus. Qs, of course, are far more cautious. We've been telling you that. Most of the Asian markets are down, and the implied open is suggesting that we will also open down by about 80 to 85 points. That's the last. We saw the GIFT Nifty, now it's 95 points lower. So prepare for a gap down, and then we see what happens from there. As usual, it's time to get to the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Hormaz, let's start with the Indigo. What's the latest?
Well, the latest is the fact that operations appear to be returning to normalcy. At least that's what the company statement says. They flew over 2,000 flights across Friday and Saturday with minimal cancellations. They also mentioned that the two cancellations that did take place were due to technical reasons and the fact that the passengers of those affected flights were immediately accommodated on the other available flights. Now, what the company has also said is that they'll be operating across all 138 destinations today, and that is indicative of operations returning to normalcy. So what this indicates is that the overhang is addressed as of now. The company has already cut its third quarter guidance as well with regards to some key parameters. So now the next trigger that emerges will be the results and what the company projects for the fourth quarter and the road ahead as well. So for now, an overhang seems to be addressed. So going with green for Indigo.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's hop across to Ekta. She's got a bunch of pharma stocks that she's tracking. Morning, Ekta.
Morning. Well, I'll start with Dr. Reddy's. I expect a mild red on that stock because the USFDA completed a pre-approval inspection of their Srikakulam facility and issued 5 observations. The inspection was from the 4th to the 12th of December. Aurobindo, the USFDA has inspected their Unit 5 API manufacturing facility. It was inspected from December 1st to 12th. They've been issued 3 observations. The company says that they are procedural in nature. Biocon, I expect it to possibly be in the green because they've signed a licensing agreement to commercialize their biosimilar aflibercept, which is basically used for ophthalmic conditions, and the licensing agreement is with Regeneron and Bayer. The agreement is for Europe as well as the rest of the world, and this follows an earlier settlement for the US and Canada. So they will be able to launch this particular biosimilar in the UK in Jan 2026 and the rest of the settled countries in March 2026. So maybe that stock would see some amount of green because it gives a pathway and licensing agreement for this particular biosimilar.
All right, Ekta, thanks very much for that. Well, Keynes, Tech and Usha Martin are the next two on our radar. Nimesh is here. Nimesh is back from his small break. Nimesh, morning. Welcome back.
Thank you, Prashant. So the first stock is Keynes Technologies, has been in the news for the last 2 weeks. Remember, the stock is down 45% from the recent highs. But now, interestingly, on Friday, Capital International bought nearly 4.5 lakh shares, investing close to 190 crores in Keynes Technologies. I know there was a lot of controversy around the accounting standards, but the management did clarify last week that they've addressed all the accounting as well as the collection concerns with the smart meters. And finally, they've said that they're going to exit the service model, and only supply smart meters going forward. So some bit of concerns aligned. And now that Capital has bought nearly 4.5 lakh shares in Keynes Technologies. So I expect some green in that name. The second name is Usha Martin. Interesting, block deal data there as well. The promoter entity sold nearly 23 lakh shares at an average price of 430 on Friday. Buyers include interesting names, including 3P, which is run by Prashant Jain, Morgan Stanley, as well as Bandhan Mutual Fund bought in that block deal. The company has reiterated 12 to 15% sustainable volume growth in the very near term. So expect that stock also to trade in green. But Keynes could be an interesting name because after all the controversy, Capital has bought nearly 4.5 lakh shares on Friday.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's hop across to Upasana. She's here to tell us about Amber as well as TBO Tech. They had the analyst meets, I think. Tell us more, Upasana.
Yes, certainly, Nigel. Firstly, let me start with Amber Enterprises. The management has reiterated their guidance, implying a strong 13 to 15% outperformance to the industry in terms of consumer durable segment, is what they've said. The company has also indicated industry-leading growth in AC segment. They've also said that they are seeing much stronger growth, and also they are sticking to the stronger growth outlook in their other segments over a medium term. Most of the focus of the discussion was on their electronics segment, and companies also reiterated a robust medium-term pipeline through organic expansion projects. Now, TBO Tech also in focus on the back of analyst meet. The management says that it has underscored sustained relevance of offline agents amid rising luxury and experimental travel demand. Companies also scaling to AI tools to empower advisors, while partners like Emeritus Hilton to value its reach, curated content, and even service depth. So on the back of these positive commentary, expect both these stocks to open in green today.
Okay, so TBO Tech and Amber will be on our radar on the back of those analyst meetings. Thank you for that, Upasna. Let's get to Ria, who's watching out for NLC India and Godavari Power. Ria, morning. Tell us why.
Well, good morning. NLC India today will be in focus since they have received an LOA for setting up a 110 megawatt grid-connected solar PV power project in Uttar Pradesh. And separately, NLC India Renewables, which is a wholly owned subsidiary of the company, has signed a JV agreement with PTC India to set up a 2,000 megawatt green capacity project in phases. So the stock is expected to open in the green on the back of both of these news flows. The next one is Godavari Power. The company is going to enhance its BESS project capacity from 10 gigawatt hour to 40 gigawatt hour. Now they are going to set up a 40 gigawatt battery pack and container capacity for roughly rupees 1,625 crores versus their earlier plan of just 10 gigawatts for rupees 700 crores. This project is to be completed in 2 phases, and phase 2 of the project is to be done in FY29. This stock also expected to open in the green today.
Okay, all right, got that, Ria. Thank you very much for giving us the updates over there. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are Interglobe Aviation, Aurobindo Pharma, Biocon, Keynes Technologies, Usha Martin, Amber, TBO Tech, NLC India, and Godavari Power. There's only one stock on the red side, potential, a negative opening. That's Dr. Reddy's. Okay, so that's the equity market roundup. Let's now figure out what's happening in the world of commodities. It's all those metals, precious or otherwise. They've been capturing investors' imagination. Manisha, good morning. What's on the radar for this week?
Well, Friday was a bit of a profit taking, but Monday morning we are back onto gains when it comes to gold and silver. Support comes in from rate cut, robust ETF inflows, strong retail demand, rising lease rates, especially for silver. And then you are looking at a deficit in silver as well, which could continue for a 6th year in 2026. So very strong supports continuing for silver, which absolutely is outperforming most of those commodities and various other asset classes as well. The gains also have continued for copper, where LME is trading near all-time highs, and the U.S. copper price is trading at a 4-month high. Well, we have been talking about supply disruptions in Chile and Peru. It also is about the ore grades declining. The LME inventories have been falling as well, so that has been giving a lot of support to copper. I quickly want to touch upon platinum, which is trading at a 2011 highs right now. The strong Chinese demand clearly has been supportive for this one. But do keep an eye also on the cryptocurrencies, because you have Bitcoin slipping back below 90,000. There are concerns that Bitcoin-heavy companies perhaps could be removed from the MSCI indices, and that is bothering the companies as well as crypto markets overall.
Okay, all right. Thank you for that update, Manisha. We'll look out for more details over there. Right now, we have to take a quick break. On the other side, focus is going to be on the insurance sector. The Cabinet has approved the Insurance Amendment Bill, and it's likely to be introduced in the Parliament today.
Welcome back. Well, the Union Cabinet has approved the Insurance Amendment Bill, which allows 100% foreign direct investment into the insurance sector. The new legislation also aims to give more teeth to the insurance regulator. Sapna Das joins in to fill us in with more details on the proposed legislation. Sapna?
The expectation is in the coming week, it's going to be tabled in the parliament, maybe as early as Monday. That's what we are getting to hear very clearly in terms of tabling of the bill. And there will also be a certain sense of urgency in getting it cleared as quickly as possible. So, all eyes on that, and there will be a lot of action in the coming week. That's one. Second, very quickly, of course, 100% FDI, raising the cap from 74% currently. That's a big one. It's more of a signaling by the union government. If you look at the current FDI, the kind of flows that have happened in the insurance sector, there is still a bit of headroom available even to reach 74%. So this is an important signaling from the part of the government to basically invite more foreign investment. Please come to the Indian market and put in money in the insurance sector. I think that's a message loud and clear. That's one. Second, some other important changes have also been proposed in the amendment bill. Number one, of course, is setting up a new consumer protection and education fund for the insurance policy holders. It was not the case so far. So that's one. Second, also giving more teeth to IRDA in terms of disgorgement of wrongful gains. Now, SEBI, as a market regulator, already has this power since quite some time. The same is now being given to the IRDA. Third, of course, also in terms of merger of non-insurance companies with insurance majors. Now, we did try to find out what this really means. So given to understand, say, for example, it's an insurance major has an SPV and they would like to merge it with the main insurance company. That's how it's going to be, or even non-insurance companies for that matter. So this is basically more in terms of promotion of ease of doing business and giving some kind of scale. Of course, post-merger, the insurance entity is what will continue.
Sapna, thank you very much for that. Parag Thakur is with us of Fort Capital. Parag, good morning. Great to have you with us here as we get into one more week and one more Monday. A few Mondays more, and that's the year. This insurance amendment business, right? From what Sapna is saying, what cabinet has approved, and what will be in the parliament today at 12 o'clock, we understand, doesn't have two things: the composite license, which is that anybody can do anything. Life can do health, health can do life, etc. And second, it also doesn't have open architecture, which means that, an LIC agent can only sell LIC policy, can't sell any. But open architecture meant that, agents are free. This was seen as negative. So it kind of doesn't have, what Sapna is telling us so far, it doesn't have these two. This was some of the majority of the big bang, so to speak. So the big bang now is only that FDI bit and, some more. What do you make of it, Parag?
Yeah, I think I will have to read the final guidelines. Right now, my positioning is on Bajaj Finserv, which I feel is a fantastic play on NBFC as well as insurance, plus various businesses with their seeding like broking and AMC and all. And in insurance, remember Bajaj Group has bought out Alliance for 24,180 crore, 25% stake. I view clearly this as a promoter buying in Bajaj Finserv. So it means that Bajaj family is buying the balance residual stake of Alliance in its insurance arms for 24,180 crores. So I would say that, and Bajaj Finserv, if you see current market cap is exactly 54% of the Bajaj Finance stake which they hold. So I would say that it's valued very reasonably, and it's a Bajaj Group company, and it gives exposure to insurance also, both life and general, and both are going to grow very profitably. So I would say that this is my positioning, but I would like to read the final guidelines and understand it more properly before taking a bigger view on this particular amendment.
The other one, maybe we'll have a discussion lined up actually, is the merger between life and non-life. So Max Financial perhaps is the other one. From a near-term perspective, which perhaps could be in...
A holdco discount can be lesser.
Yeah, can be. Although we had Amitabh Chaudhary a couple of weeks back with us, but that's another bit, that Axis Bank, buying stake, and there was all that other bit involved with that, right? Investigation, SEBI is looking at the price. I'm not sure if that has any bearing on this. The merger itself between Max Financial and Max Life. Indigo, Parag. So we have this estimate now, which is pretty close to what CNBC reported on Friday, which is near about 500 crores, the compensation, and it'll be paid out in January. Stocks stabilized over Thursday and Friday. What from here, according to you?
I think if it is a 500 crore hit one time, it's okay for a business which has survived so many downturns and so many bad cycles in the past also. But just to clarify, I have not still bought into it. But I would like to say that the believers of airline industry as a sector and Interglobe can use this as an opportunity to buy because it is one time and this cloud will also pass. So I think, but I have got enough other companies to buy. So I would say that I will wait. And plus, I have raised some cash also just ahead of this Bank of Japan meeting. So I would like to stay on cash for some time, 5-6% at least. But there are many interesting opportunities because I am very constructive on India as an economy from here on. And I would like to say that this particular fall in FMCG stocks, led by Hindustan Lever saying that our YOY will be flat EBITDA in Q3, I think I would use this as a good opportunity to accumulate on every dip.
Okay, all right. Parag, request you to stay with us. I want to ask you your view on Lenskart as well as Hindustan Zinc. For the time being, we'll slip into a short break. Come back. We'll continue our chat with Parag. Our technical experts will also join in.
Okay, welcome back. There's about 15 minutes to go, a little more than that to go for the pre-open session to kick off. Pharma is here with the big movers from yesterday. That is Friday, the last session, and what lay behind the price action. Harmaz, over to you.
Morning, Prashant. And a lot of metal stocks were in focus all through last week, and Hindustan Zinc was no different. It was the best week that the stock had since May of last year. 13% gain over the last week that you saw. Third straight day where over 1 crore and more shares were traded in a single trading session for Hindustan Zinc. Friday's volumes were the highest in 6 months, with almost 4 crore shares being traded. The 20-day average of close to 60 lakh shares. And out of those 4 crore shares, only 85.5 lakh shares were marked for delivery, and that is 4x of the 20-day average of close to 21 lakh shares. Now, the stock is still down around 30% from its record highs of around 807 that it had hit in May of last year, but still, of course, falls into that category of low free float stocks. Transformers and rectifiers is another name. It's been an underperformer, but it was among the top gainers in the broader markets on Friday. The biggest single day gain since January of last year. Volumes were the highest since December of 2007, and 6.2 crore shares were traded, the 20-day average of close to 40 lakh shares. And out of those 6 crore shares that were traded, only 46.5 lakh shares were marked for delivery, the 20-day average being around 13 lakh shares. And Friday's turnover, nearly 60% of its free float market cap, and the stock down nearly 60% from its 52-week high, which is close to 650 rupees. And lastly, Walchand Nagar was another mover in the broader markets, the biggest single-day gain that the stock saw since December of 21. Friday's volumes the highest since September of 2017. Volumes were the sum total of the last 28 sessions put together, with over 70 lakh shares that were traded. The 20-day average is only 3 lakh shares here. And out of those 70 lakh shares that were traded, 7.5 lakh shares were marked for delivery, the 20-day average being close to just over 1 lakh shares. The stock has had a disappointing year so far, down around 40% on a year-to-date basis.
All right, thanks a lot for that, Hormuz. In fact, let me take the point forward on one of the stocks that Hormuz mentioned. Now, Jefferies has initiated coverage on Hindustan Zinc with a buy rating, target price at around 660 rupees. They are valuing the company at around 10 times EV upon EBITDA. Let's run you through 5 key assumptions that Jefferies is making. They are expecting a sharp acceleration in earnings, more than 20% over the next 2 fiscals, 26 as well as 27, and 7% in FY28. Though we need to know the Jefferies EPS estimates, where they're 9 to 31% above what the street is expecting. On valuations, well, they note that Hindustan Zinc, yes, it's trading at around 9.2 times EV upon EBITDA, which is above its 10-year average, but they believe that this premium is justified, given the increasing share of silver in the EBIT. Point number 3, their price assumptions actually are below the spot levels. On zinc, their assumption is 4% below spot. On silver, their assumption for the next couple of years is 3 to 10% below what spot rates are. We need to note that Hindustan Zinc, though, has hedged 37% of its second half of the year volumes at around $37 per ounce. So the full benefit of these higher prices that we're seeing of $50, $60, that will flow through only in FY27. Which brings us to point number 4. On volumes, they're assuming metal sales are expected to grow at a modest 2% CAGR over the next few years, because major of the expansions will come on stream only after more than 2 years. Remember, by 2030, the management is targeting 2 million tons of refined metal and 1,500 tons of silver. And finally, Jefferies forecast annual free cash flow of around 8 to around 14,000 crores, with ROEs at around 69 to around 85%. So put all this together, Jefferies, they have initiated coverage on Hindustan Zinc, and they have a target price of 660 rupees. Parag, what do you make of this one? Float is limited out here, but that tailwind is coming about with silver prices zooming and, breaking out of a range that we've seen for 45 years or thereabouts. I'll tell you what, speaking to a couple of silver experts, they said now it's not a percentage move. It'll be a multiplier mode. If that's the case, will you bet on Hindustan Zinc?
No. I am a contra investor, Nigel. So I will not buy into this momentum after the stock has rallied 13% in a week. And after that, entire world and I would say everybody is bullish on silver. I will never buy that. I will buy Hindustan Lever, where everybody has given up. Everybody has thrown in the towel.
Okay. But so Hindustan Unilever is something that you're bullish on, is it? You're a contra investor there.
Yeah, contra investor. I have 3.5% weight and always looking to increase on any dip.
Okay, I thought Parag was being, I said HUL just for he was naming the stock Hindustan just for the sake of it, but he actually had HUL.
That's why I remembered.
Okay.
No, it happened. But take your point there, Parag, absolutely. Just yeah, and makes sense to kind of be a little careful when you've got everyone which is already on one side of the trade in that sense. The other bit which I want to talk about, Parag, is names like Asian Paints. Again, I mean, taking a leaf out of your HUL kind of idea, kind of unloved sector still, although it's come back up. It came back 2 weeks ago. Last week was down almost 10%. Any thoughts on the paint space?
So we, like today I'm speaking about lever, we bought Asian Paints at around 2,240. But we booked out actually, and we have already sold it. But I would love to buy this kind of blue chip great companies when nobody wants to look at them. So that is why lever comes into my list first today.
Okay, all right. Let's turn the lens then to Lenskart. And let's run our viewers first what Morgan Stanley has to say. They believe at current levels, the stock is fairly valued. They have, I think they have an equal weight on the stock with a target price of around 445 rupees. They note that the company is a distinctive play on shifting lifestyle dynamics. The company is largely insulated from macro headwinds. And also they believe that it has elements to be the Accelero Luxottica from India. That's one of the big brands in Europe. They believe that it has the potential to go to that sort of heights. For the time being, the stock at around 405 rupees. Parag, what's the view out here? One of the most hyped IPO of 2025. Everyone had a view. To be fair, the stock actually is around its IPO price itself after correcting 10% on the listing day, though the float is very limited. Interested or not?
No, basically, I am looking at this company amongst the latest IPOs. I find this company interesting. It actually adds value to the customer. It makes cash profits at least. This quarter, we saw 100 crore PAT and significant amount of depreciation. So cash profit is there. But I would agree with Morgan Stanley that it is fairly valued. I would like it to buy at a lower price. I have not yet bought it, but it is one of the IPOs which, one of the companies which is tech enabled and it really provides value to the customer. So something on my list, but yet I have not acted on it.
Parag, hi, morning. Speaking of IPOs, what about ICICI Pru AMC? Did you like the price at which they're coming or no?
Yeah. So 6-month profit is 1,600 crore. So you can say they can make a profit of around 3,000 crore. IPO valuation is 1,06,000 crore. So it is at 35 P against 46 times for HDFC AMC. And I have worked, so I will be biased. I have worked with ICICI Pru AMC for 6 years. Mr. Naren is my mentor and guru. So I would say that it's a fantastic IPO. Instead of applying to unknown names in IPOs, investors should apply here. Definitely, it's a proven, time-tested management and AMC. And they will take care of your money, whether when you invest in them directly in mutual funds or their stock, in my view.
So that's a thumbs up from you. Two more stocks which have been in the news all through last week. So just quickly running them past you. One is Siemens. Siemens sounded a little cautious in their investor call on their, on the pickup in capex, etc. Though they're saying their, their SI business, smart infra, that's doing really well. What did you think? The stock fell on Friday. What did you make of it?
I feel that all these cap goods companies, selectively, of course, there may be some who are available at attractive valuations, but I think the multiples are too stretched. See, this is not a thing which you consume day to day, right? It is. So you have to take a very big call on capex, and capex right now, this year government's focus is clearly on increasing the disposable income for middle class. GST cut, interest rate cuts, and income tax slab increase all tells you one story, that government's focus is consumption this time, and through consumption they want to revive the private sector capex cycle. Up till now, last 10 years, government has done a front loading of the growth by doing capex. Now they want private sector to kick in, and that is what they are driving by increasing the consumption disposable income. So I would believe in that theme and go in consumption stocks. That is my personal view. Of course, at some point, definitely capex cycle will come back. But right now, my portfolio is more tilted towards consumption.
More tilted towards consumption. Okay. Since I was going to ask you about Keynes, but since you said consumption, let me ask you about the big QSR deal that everyone's been speaking of, and let's see when we get details. This Sapphire and Devyani. You know, over the weekend we had news that the gentlemen who are running the Costa Coffee business and the Vango business, they're stepping down. So maybe it's a precursor to, you know, that larger amalgamation. And this has been on for months now. Do you like the QSR space? How do you look at these two companies? Any thoughts?
See, in QSR space, I've been tracking the numbers. Jubilant Food is showing good numbers. But apart from that, I have not seen interesting numbers from this space, but I think it will come out gradually. So it's a space to watch out for. I have not acted on it yet, but it's a space to watch out for.
What about restaurant brands, Asia? Any view out there? That deal as well is apparently in the works and, you know, widely reported, I think, for a while. And, you know, we as well had the recent update just a week or so, I think a couple of weeks or so ago. And the stock has done well from there.
Yeah, so because the stock was beaten completely down, right? I think last time some blocks happened at around 100 rupees. Now it is 67. So I would say that the stock is completely beaten down. If somebody can take care of the balance sheet and reduce leverage, then of course it is very attractive at this price. But of course, disclaimer, I have not bought it yet.
Okay. All right, Parag, we'll leave it on that note for this morning. Thanks so much for that quick fire. We managed to pack in lots of stocks this morning. Thank you for that. You have a good day. We need to take a quick break. Come back on the other side. We'll have the pre-opening rates. And also, we get into a conversation on the telecom space. Gaurav Malhotra of Axis Capital is joining in. There are some fresh reports around VI and what the next steps could be from the government. We'll address that. And then our technical experts, Sudarshan Sukhani and Mitesh Thakkar, with some of the trading calls of the day. Welcome back. So we are all set for the pre-open the next minute or so. And let's see, because the implied open has been telling us it's going to be a cautious start. We'll probably start 90 points lower. There you go, 80 points lower. We'll have the actual rates, pre-open rates coming in. Let's, in the meantime, get to our technical experts. Sudarshan Sukhani and Mitesh Thakkar are with us. Gentlemen, morning to both of you. So it's the same situation, right? The market seems to be getting sluggish. It's stopping out every time we hit this 26,000, 26,100 zone. So, Sudarshan, what would your trading approach be with respect to the indices today?
Good morning. Actually, it's not a good morning. I'm in Delhi and I'm 500 plus AQI. For those who don't live here, good morning. Now, markets are in an uncertain position. You know, we have gone into a trading range and we are refusing to come out of it. 25,900 on the lower side and roughly 26,200 on the upper side. This market will resolve itself at some point of time and move out of this range. That will be the real direction of this market. Inside this range, it's going to be intraday trading on the best kind of range. Stay away. So today's view is that so far as 25,900 is being defended by the bulls, nothing to do. If it is broken, take short positions.
Okay. Take short positions. Got that. All right, Sudarshan, and hope things get better on this AQI front. We are just getting a bit of a demo here in Mumbai. It's extremely painful. Anyway, let's move on with market action. Mitesh, what about you? Going to get a dip this morning. Last 2 days have been good. Buy the dip or stay away?
Actually, difficult to understand if you want to buy this dip. Good morning, because we are still in the middle of that range of 26,300 on the upside to about 25,800, 700 on the downside. And therefore, when you get a gap up or gap down in the middle of the range, difficult to decide which way the market is heading. So I, for the time being, ignore the index trades and focus on stock sides. But yeah, buying closer to lower end of the range, which is 25,800 is what the people should look at, and take profits around 26,200, 250 levels, and a breakout beyond 26,300, obviously. That's the longer term breakout.
Okay, got that. What about individual stock, Mitesh? What's on your radar?
On the stock side, I have 2 buys and 2 sells. On the buying side, on the buying side is ICICI approved with a stop at 636 for targets of 670. And a strong reversal was seen on the charts of Dalmia Bharat. So that's a buy on a mild dip, say around 10-20 points, 2060, 2050 could be a good entry point. Keep a stop below 2029, look for targets of 2125. And on the selling side is CAMS with a stop at 768 for targets of 730, and ITC. That's a sell with a stop at 404 for targets of 392.
iPru is one of Mitesh's picks. By the way, all of the insurance stocks, life and non-life, they've opened out with positive gains. And some of the smaller names like Go Digit, early in the pre-open session, are really flying high. Go Digit is going places. It's up 7-8% right now. That's iPru, SBI Life, HDFC Life. Most of the life insurance companies are up and about. Let's pull up Star Health as well, the standalone health insurers, because, of course, it's 100% FDI that this new bill is promising to allow, raising the cap from 74% earlier. Okay, Sudarshan, let's come to your stocks for the day as well. Which ones are you going with?
It's almost the same, 2 buys and 2 sells, and one of them is common. Dalmia Bharat is a buy for me also with a stop under 2035. Delivery is a buy, and you were talking about consumer-oriented products, so maybe buy with a stop under 405. I have 2 intraday shorts, GAIL, which has a miserable chart, an intraday short with a stop above 175, and Bharat Dynamics, another chart, if you see it, falling relentlessly day after day. So that's an intraday short with a stop above 1440.
Okay, I just want to make a quick mention. Thanks very much, both of you, and we'll chat again. Sudarshan, Mitesh, Rupee, by the way, has made a new low of 90.56 against the USD. So remember, Wednesday, over Wednesday and Thursday, the dollar index fell about 1%, and that's against a basket of currencies. And those were essentially the days where the rupee also made a new low. We had a very senior person on the trading side from Bank of America who basically said that it's a couple of things: interest rate differentials, to his mind, between India and the US. That's, of course, unless the Fed starts to cut and the rate differential narrows, there's going to be a persistent problem. And of course, the second bit was the India-US deal. He said, well, important for sentiment more than anything else, but important nevertheless. on your screen, 90.55 as we start this morning. It's not a big one. We've had very large moves in the last 1.5 months or so, but incrementally, this marks itself as a fresh low on the currency. Cibil.
Absolutely. And let's see if it pulls back, because on Friday it hit these lows and then it pulled back a little bit to about 90.40 thereabouts. We'll see how this plays out. By the way, the problem with the Nifty right now, because that rate is looking so warped, is because of just one stock that's stuck, and that's HDFC Bank. It's stuck at 5% lower. Very unlikely that we get that sort of an open, but we'll see. Because of this, the overall Nifty rate is suggesting a 300-point downtick. Let's just give it another couple of minutes. The other one to focus on would be Vodafone Idea for sure. I mean, look at what Vodafone is doing. It's zooming ahead in the pre-open. It's crossed that 12 rupee mark now. Okay, now it's cooled off a little bit. When it opened out, it was trading above 12 rupees. And this is one of the focal points that we want to discuss with our next guest. There are reports that are suggesting that the government could look at the next steps for Vodafone Idea, and these steps could include giving the company an interest-free moratorium period of about 4 to 5 years for the payment of the AGR dues. Let's actually go across to Gaurav Malhotra from Axis Capital to talk about this and, of course, other developments in telecom. Gaurav, morning. So Vodafone Idea always gives us the headlines, right? Now, and we're independently trying to assert this and confirm this, but the reports that are indicating this kind of a moratorium, 4 to 5 years, no payments needed, no interest, is just a complete stop on that massive payout of 83,000 crores. Does it give enough of a lifeline for Vodafone Idea to go ahead, raise debt funds, and basically get the business on track?
Yeah, see, the way to think about it, that there are two major items which are outflows, which we need to think from Vodafone's perspective. One is the AGR, and the second is the spectrum dues, right? So in the AGR, we actually forget that there is a spectrum amount of almost 1,20,000 crores also sitting. Now, if this were to happen, what we are reading in the news, that if there's a 4-5 year moratorium, it is sort of half and will be interest free. Then the way to think about it is that from this year, the Idea had to pay 16,000 crores just on a yearly basis, just from AGR annual. Now that will then obviously not be there, and that gets a push to say 20, 30, 31. From a spectrum, at least in the next couple of years, the amounts are not very significant. It's like 3,000 crores this year, 7,000 crores next year. But say come the year after, the spectrum amounts due will be like 15,000 crores, and then it goes to 27,000 crores. So obviously this helps, right? At least the next 2-3 years, it really helps on the cash flow situation. And then the key variable which we have to sort of understand is what happens to the EBITDA, right? Because end of the day, the funding gap will be a function of how much EBITDA gets generated. So today, the pre-index EBITDA is around 9,000 crores. Now, if you have to pay, say, 15,000 crores 3 years hence, and just for spectrum, right? Then obviously the 9,000 will have to sort of move up substantially. So we'll have to see, but definitely if this were to happen, then at least it gives you some breathing space for the next say few years.
So Gaurav, lots of numbers. Let me just reiterate for clarity. What you're saying is that if the moratorium comes in, then on the AGR front, there's huge relief. Vodafone doesn't have to pay the 16,000 odd crores every year. And spectrum, you're saying that though the overall sum is very large, over 1 lakh crores, it's staggered. So it's only about, 3,000 crores every year, which is not, much of a deal.
3,000 crores this year, which goes to 7, which goes to 15, and this goes to 27,000. So that number sort of keeps moving up.
Okay. But it is manageable is what you're saying. The spectrum payouts are still manageable as long as the moratorium comes.
EBITDA sort of moves up substantially from 9,000.
Okay.
I heard an interesting analogy. While this was, I don't know, Gaurav, you can hear me, that this entire Indigo crisis was going on, right? I mean, monopoly and not too many players in the system. And someone said, well, it's the same thing. If anything, the Indigo crisis should precipitate a solution for Vodafone. Because of
what's the link? What? Indigo, Vodafone?
Yeah, because in telecom as well, you've got few players.
Yeah.
Right?
Yeah.
And it's a vitally important sector, obviously. And what happens if so the government would not want concentration of market share just between two players. It would want one more strong player. So
But the government can want what it wants. Ultimately, people have to come in, set up the business, put in the capital.
The business is there. I mean, I have people in my family who use Vodafone. It's just that you got to take a view and, the numbers and all, of course. But the point is, it's about relief. I mean, they've got such large and, the numbers, etc. Gaurav pointed out. I don't know, Gaurav, does that make sense broadly? I mean, it's just from a more top-down kind of perspective.
The government has been talking about the fact that they don't want to duopoly in telecom, right? And it is amply clear based on all the interventions which they have taken. So it's quite evident that they don't want a two-player market, even though BSNL is there, but BSNL from a market share is just too small, right, to matter in the larger scheme of things. So they do want like a three-player private market. So like I said, from a relief perspective, this definitely gives a relief for the next few years. And then obviously beyond that, we'll have to see what happens to the EBITDA and how the company can sort of navigate that up move. For it to start making meaningful sense, say from FY29 onwards.
And beyond national good, for which obviously nobody wants monopolies or duopolies, telecom or any other sector. In this case, the government owns almost half the company. So in any case, it has a lot riding, right? It needs to perhaps see this resolve itself.
Interesting one. Now, Gaurav, simple fact, that a lot of viewers will want to understand. Talking about a potential relief, now the stock has crossed that FPO price of around 11 rupees. So technically, that's in favor. And there's probably a price increase as well that's on the cards. Are you factoring in a price increase? There was some murmur that this is likely to come about in December. So run us through that. And what do? 11 rupees, 80 paise. Would you, say that maybe risk reward is in favor? Or no, you would say stay away?
See, the tariff hikes are being assumed across all the operators in their estimates, whether it is Jio, Bharti or Vodafone. So nothing, so it's not as if this tariff hike needs to come for the numbers to sort of be upgraded. The tariff hike has been delayed, but I think so it's just a matter of time. Our house view has been that somewhere between December to June, December of this year to June of next year is when we should expect some tariff hike of say around 10-12%. See, from a stock, Vodafone stock perspective, it's a little tricky because we'll have to see what is the actual relief. Assume that this relief is what we are talking about, say 5 years, halving of the spectrum amount, the AGR amount, right? So that is actually 3 to 4 rupees, up from a share price perspective. Now, our target price is around 9, so then 9 becomes a 12 and a half. So from our perspective, it really doesn't swing the needle as much. Equally importantly, in Vodafone, we also need to see what happens to the base business, how much capex is put in, and what happens to the subscriber and ARPU trends over there.
Okay, so 10 to 12% tariff hike over the next 6 months. And if Vodafone Idea gets this sort of a reprieve or a moratorium on AGR payments next couple of years, then perhaps it really has a fighting chance to set its house in order. Got that, Gaurav. Great conversations always. Thank you for the perspective, and you have a good day. We look forward to connecting again soon. Well, with that, let's get back to the screens and let's see if this pre-open session has settled. And it finally has, and the Nifty is down about 116 points in the pre-open. Now back to our technical experts then. Sudarshan, what's the stock call you're going with?
Well, it's delivery. Buy with a stop under 405.
All right. And Mitesh, what about you?
Buy on ICICI Pru for targets of around 670.
Okay. All right, gentlemen. Got that. Thanks very much. Let's just see what's going on in the pre-open and also in terms of some of the stocks which were in news. KC International, by the way, has won an order. It's a little over 1,000 crores. Stocks reacting well, 3.5% up. TBO Tech had an analyst call. As what Riya just told us. And that analyst call, whatever they've said over there in terms of business expansion, the market seems to be liking it. And of course, there's Vodafone Idea, which is up and about. With that, let's look at Federal Bank because there is a positive brokerage report on Federal Bank as well today. Gaurav's joining in. Gaurav, welcome back. Congratulations. It's the new side of life. Now you join in as a happily married, boy or man, should I say. Congratulations. And tell us more about Federal Bank.
Well, thank you so much. Now, moving to Federal Bank, if we look at UBS, they are actually being bullish on Federal Bank. They have increased the target price to 310 versus what it was at 250. And their argument here is that they see improvement in the operating side of the bank, and that is the reason why they are being bullish about it. For credit costs, they are expecting credit costs to remain low. When it comes to loan book growth and net interest margins. Now they are expecting it to remain subdued, at least in the near term. But what is another key thing to highlight is that if you look at the valuation, now they have given a valuation, they value Federal Bank at 1.5 times price to book if we compare it with FY27. Now they believe that this is similar to IDFC First Bank, but if you look at Federal Bank, they have better ROE profile, and that is the reason they also believe that the loan book growth gap that we are seeing right now will get narrowed in the medium term. Apart from that, they are now raising their medium-term target almost by 5 to 9% in terms of EPS, and that is the reason why they have increased their target price to 310. And given the bullish call, we will definitely watch on how it works for Federal Bank in a day-to-day.
All right, Gaurav, good to have you back. Congratulations. Wishing you and the BV a very, very happy married life. And you know who's the boss, brother. Any tips you require, please reach out. Been there for 11 years, so I know how it is. We'll chat. Once I'm out from the studio, but all the best to you and the lovely lady.
Thanks.
Okay, all right, let's do a quick recap then of all the top stocks we covered earlier this morning. Stocks in focus include Indigo Aviation, we have Oro Pharma, Biocon, Keynes Technology, Usha Martin, Amber Enterprises, TBO Tech, NLC India, Godavari Power, as well as Dr. Reddy's. So those are all the top stocks that we're looking at. But I think, Prashant, we just got a few seconds before we get to market open.
Oh, absolutely. And, let's keep it with the price. We'll have the first rate start to come up on the Nifty Bank, etc. And then we'll take it from there so in terms of individual names. So what do we have? First rates, 100 points lower on the Nifty, 376 points lower on the Sensex. So 25,930, 84,891. And there you go, off we go. A third lower on the Nifty. And I think the Nifty Bank finding a price, 59,300 or so, I think is where we are starting at. 59,270, 250, 240, 0.25% lower on the Nifty and the Nifty Bank both. Mid-cap index is down a third. The small-cap index, I think, is starting slightly lower as well. So those are initial rates. At this point in time. A third now lower on the Nifty. So fast changing, fast moving, just finding, I guess, a level. But it's about 85, 90 points lower at this point in time. I think you got bulk of, everything which is opening is in the red and about 5 or 6 names are in the green. Trent is down on one end, Cipla, Dr. Reddy's at the others. Indigo is starting higher and it's the biggest gainer at this point. I don't know if it's a big gain, but on the Nifty, it's the biggest gainer. At this stage. That's a Nifty heat map up on your screen. 90 points lower. Surabhi.
Okay, let's take a look at what's moving up and down on the Nifty. On the downside, you've got Trent, 1% lower. M&M is seeing some profit taking, 1% lower. Dr. Reddy's and HDFC Life. There is NTPC, there's JSW Steel. So basically, there's no sectoral trend. It's completely mixed. Nestle is slightly lower. Eicher Motors is slightly lower. Hard to pick out any kind of sectoral sense in this. On the upside, not too many stocks at all, actually. It's an overwhelming down screen, at least for now. There are only 2 green ticks really on the upside. One is Interglobe Aviation. Now, that stock's up about, 17 rupees this morning. And then there is Shriram Finance that's managing to keep its head above water, but only very barely so. Overall, the Nifty is down. It is that gap down open, 100 points that has been delivered. Now we need to see if the bulls can once again come back in and buy this dip, taking the Nifty up to 26,000. But for now, 90 lower.
Well, that's right. Should be, a few stocks that are in focus. Geojit, I think we should get that stock up for you in the screen. There are close to around 3 crore shares that have got traded out there. So there's a very, very large trade that's taken place on Geojit. I think we should get that one up for you on the screen. One, the volume's very high because there's massive volume actually in terms of a change. We'll try to get you further details on that. Stock a little bit lower. Another one from the broader markets that's low is Reflex. That's down close to around 10%. I think there was an IT raid out there. Stock was down even in Friday's trading session. And today, it's seen another downtick. Actually, they've conducted, IT Income Tax Department has conducted a survey at the company's office from December 9 to around 13. So that explains why that stock is under some pressure. Pull up Brigade Enterprises as well. The IT department conducted a survey out there as well between December 9th as well as 13th across its premises. So I think we should get that stock up for you on the screen. Besides both these two names, Astra Micro, they are backed 120 crore order. So I think that stock, in fact, has opened up in the green. Some mild green is what we're seeing on that particular name. Let's get it up for you on the screen. Coffee Day, volumes, not very high, but that stock is up close to around 15%. And I believe Surbi was watching a movie over the weekend, and PVR, in fact, is in focus. A good bounce is what we're seeing on that particular name, and the pipeline as well in terms of releases look pretty good. So that stock up 5% as we speak.
You know what? And the theatre was packed, I can tell you that much. It was houseful, and it was almost next to impossible to get tickets for this latest release, Dhurandhar, anywhere, in Mumbai suburbs. So yeah, I think it was a weekend of good box office collections. PVR Inox up 4.5%.
Absolutely, and I think we'll have more rates come up for you on your screens as we kind of go along. The Nifty is now settling, finding its feet 90 points lower. It's about 1/3% lower, so giving back some of the repair that we saw over Thursday and Friday. It's I think right out. Let's just look at the market breadth as well. Too early to do that, but maybe just gives us a quick sense more than anything else at this point in time. NSE advanced decline ratio should be up on your screens in just a bit from now. What do we have? Okay, on the Sensex, the NSE, it's 1,500 down and about 900 higher. On the BSE, something similar as well. So that's the picture. Krishna Sanghvi is with us, CIO Equities at Mahindra Manulife Investment Management. Krishna, great to have you with us here in the studios. Good morning. Thanks very much
thanks,
for
Prashant.
Joining us. So where are we at, Krishna? I mean, no man's land as we wrap up this year. Can't thump the table and be bullish. No reason to be bearish, I guess, as well in that sense.
Yeah, I guess no reason to be bearish is a best part. Bullish part, conceptual economy is good. We're doing good. 1 and 2 years, we get this kind of syndromes where markets are getting a little bit lackluster, more with downward bias, and that's where we need to look. Whether markets are run up too much ahead of time or not. So if you think of it. Today, the reasonable amount of thought process that, small caps are not doing as well. But if you step back a year back, maybe, it was exactly reverse. So that's a little bit, economy angle where we say that economy does well, but the leadership in markets among large, mid, small or among sectors keep on changing. Maybe you call it profit pool participation or market acceptance of those profit pool. And last is, investor behavior. In terms of what segment of markets they seem to be more attracted. Because let's face it, investor flows also drive market behavior. If too much interest in small cap or mid cap in terms of money flow, that does, create a new demand. And the last part in the markets, the way we see really is that you got, a reasonable rebalance this year vis-a-vis what, the previous 2 years has been. The mutual fund, the domestic investor appetite for stocks remaining good. This year has seen a nice rebalancing where, corporate India has basically come up to get, its own share of fresh funding, or maybe promoters or PEs and VCs have got their own share of exits. Nice rebalancing, where it was a good demand for a couple of years. This year has been, supply has caught up. So hopefully next year, let's see how best, the market respond to this both, reasonable appetite for Indian equities by domestic investors vis-a-vis the corporate supply.
Yeah, at least in the next next 15 days, at least IPO activity should be a little low because, it's the end of the year and normally you don't have too many large issuances, etc. opening up. But then, of course, we'll see. Next year, of course, it's a big pipeline, at least going by some of the indications, etc. out there. Krishna, just to complete that point, for viewers who are watching, is it possible we spend another 6-8 months in this kind of a phase where not very much is happening with slightly downward bias? That's not the general consensus expectation. That's why I'm asking you that.
Yeah, it's possible. So I guess let's look at, Indian market from demand supply dynamics of market. Economy, let's say broadly, we know we are more or less in that, close to 10% nominal GDP growth rate we've established well. I think let's look at markets. Okay, from a demand supply, you got Indian investors looking to buy equities. They have nice nominal income growth, savings are rising, so they have a willingness and appetite for equities both. Corporate India is in a way some sort of a perpetual supplier of equities. So you got two players balancing out. Core demand from Indian investors looking to invest, core supply from Indian corporates either directly for the good of the company in terms of raising money for the growth, or possibly some sort of a promoter exits or reduction in stake, etc. So the third player in the entire dynamics really is the FII. So there will be cases wherein FII turns positive on India. So you suddenly have a nice equation of two participants looking to buy and one looking to sell. There are cases where FIIs look to sell, and there you have a two sellers and one buyer market. So if I look from that perspective, we need to evaluate how India is vis-a-vis the global, and that's where the good news starts. Where we had some sort of a dream run for a couple of years till, let's say, CY24, where Indian markets did exceptionally well vis-a-vis other emerging markets. Now we're reaching a situation in CY25, the way the year behaved. Indian markets may not have done much, let's say, but global markets, especially other emerging markets, have done pretty well. Which means on a relative valuation perspective, again, India becomes, attractive investment option for FPIs, because unlike, Indian investors who have a reasonable reasons to remain invested in India because of our own, let's say capital account convertibility kind of, issues, global investors have a nice, ability to dissect valuations across economies, across markets, and 1 year, 18 months of underperformance makes them, reasonably attractive. The way 12 months back the noise was really that India is slightly more expensive or premium valuation vis-a-vis the global emerging markets. Today the noise is exactly, after what's happened in last 12, 18 months, we actually caught up. Might be still premium, but the gap is what, finally. So that's the advantage of financial markets. Finally we are a nice, rebalancing of YOY, which is matters.
By the way, you guys were talking about primary market, and Krishna was talking about the paper supply as well, right? Wakefit is listing today, and we know the company. Most of us have sort of either been to the store or touch and feel is there. Large part of their revenue comes in from selling mattresses, and then there is some furnishings as well that they're doing. So furniture and mattresses, guess at what price the issue is coming in terms of valuation?
Market cap, they were asking for?
Yeah, the price to 70 to 80 times.
Earnings.
So, and Krishna, that's my question really, right? Because
so a good mattress is very expensive, huh?
It is. But Krishna, my point is, and kudos to the investment bankers who managed to sell these stories. Now, and kudos to the companies. I'm sure it's fabulous businesses, whether you're selling mattresses or chashma or whatever you're selling. And the backend has to be digital. You have to reach your customers through a very, very digital, effective, efficient medium, right? But does that make you a tech company? And does that justify the kind of valuations that some of these companies have been coming at? What is the investor experience going to be? And these issues have been, of course, there's a lot of selling. Even the Wakefit IPO, by the way, largely is an OFS. It's barely 300 crores coming into the company. It's existing investors exiting at these valuations. It has a separate rupee, situation that it creates. Lata was, telling us about that. But really, what are we in for? What are we talking about when we have these companies coming at 70, 80 times? And obviously with this kind of paper supply.
I think macro picture, if you look at, let's dissect some of these IPOs into components of, what value add the IPO brings. Okay, the easiest value add is they create additional market cap for India. So if you think of it, despite a lackluster year vis-a-vis last year, Indian market cap has actually risen, and market cap to GDP has further gone up. The reason primarily being around 100 odd companies which have listed and created, market cap, which basically means, India is, as a top-down, become far more expensive than what maybe we would have been a year back. From a pure market cap to GDP, which is that one of the global indicators. Now, come to think of these IPOs, some of these IPOs, we call them good IPOs, where the company is raising money for its own growth. The money primarily goes into the company for its own expansion, whether it's a rollout of a store network or a physical capacity creation by way of plant, etc., or even at times improvement in working capital. Company wants to be debt free by raising money, and that's good. There are some companies, where it's more of a stake sale, and that's where you need to differentiate between some of those variables. But yeah, clearly the IPO is in a way, look at it over 10-20 years. That's for a typical end outcome of a bull market. There is too much strong demand for equities. Corporates have a nice reason to
I just get worried when I think of my SIPs buying businesses at 70, 80 times, because a lot of the IPOs have happened only thanks to domestic mutual funds and domestic institutions, right? That's how they've been sold. Well, fingers crossed, I guess, for the future.
Yeah, I guess, and somewhere just to say that worry, you might just need to adjust how much as a percentage of the portfolio those are carried, rather than getting worried with the SIP.
That's true. There might be a very small part of the retail portfolio. Absolutely.
Krishna, I'm an optimist, and I believe phases like this is a very good opportunity. In the next 15 years, my portfolio look very, very good. because the last 18 months actually has been painful to see a flattish number on all, all the SIPs, all the mutual fund investments that I do. But I believe it's par for the course. And, in the longer run, we'll get that low double-digit returns that we are looking at on a CAGR basis. But I'm going to put a very simple question to you. To getting into 2026, what kind of expectations you have on the headline index? As you said, we've seen a bit of consolidation, but actually consolidation may not be so bad. We are a geopolitical risk. We didn't have earnings. We had a slowdown in the economy, and we didn't have a trade deal till now. And yet we're flat, which isn't such a bad, outcome. So what's the expectation on the headline index, point number one? And point number two, just one sector, which you're most bullish on, incremental money should go there for 2026.
So I think headline index, clearly, we are in for a growth economy. So conceptually, we are there for a rising market trend. Now the intensity, possibly that's where the third variable in the global market called FIIs or FPIs in our case possibly matters, because they are the people who want to normalize or neutralize valuation differences across geographies. And so that gives some hope that after what's happened to Indian markets in the last 12-15 months, including partly the currency makes again India slightly more attractive because we depreciated. So I think fair to assume that we have a nice probability of FIs coming back to India, and we need that little bit restoring of balance, because as I mentioned, look at market from a three-player industry: core buyer, Indian investors; core supplier, Indian corporates; and the swing or the delta comes from. So I'll possibly go with that.
So positive bias on the headline index, and hopefully the FIs, things look attractive enough for them to come back after the kind of selling that they've done. So we got that out of the way on the headline index. Are the individuals, that one sector that you believe is giving good potential?
So I think India, let's say the core story can still remain consumption.
Okay.
Let's look at last 18 months in a collective period. Government has done reasonable things to increase the post-tax income for people. They've done reasonable things to reduce the cost of products by way of reducing GST.
Yes.
So that piece has, let's say, established. So what possibly I'll say, consumption is a nice overall subset, whether it's look at auto, whether you look at retail, look at staples, and a combination of is always.
So you would say discretionary as well as staples, both of them?
It'll be a combination, because that's where the difference is. How does market appreciate those changes is a function of valuation multiple, not really the earning growth. So if I look at economy, the earning growth is likely to come more into consumption space. And partly in the entire piece, even financial services are in a way consumption, because more post-tax money with investors typically means, with consumers means they can be investors also. So that's the piece, I think,
Consumption, got it. I think earlier this year you had also spoken about metals, and in various conversations that we've had, and actually that sector has done well. It's not for the faint-hearted, but it's more than valuations, it's momentum. It has enough momentum in 2026 as well?
No, I think metals, let's look at India as a core story on metals. Okay, we have a situation where we are going for manufacturing in India as a core concept. Now, if manufacturing is a long-term story, we need the back end to manufacturing, which means metals is one of the core products which, it's very difficult to believe that we will import metals but end up, manufacturing in India, because then it doesn't really create that Atmanirbhar kind of concept. So the idea is Indian metal companies are likely to grow in line with the GDP. Even look at last 25 years, India steel has grown at a CAGR of more than 7%.
Correct.
So we're looking at something similar. Now, only challenge in metals is because the companies take 4 and 5 years to come with a plant. The cyclicality possibly plays out, because they're investing for a plant which is likely to come 5 years down the line. But markets, at the exactly same point you mentioned, you said investing for 15 years, but end up reviewing in 18 months. So that challenge, partly comes on some of these corporates. So the volatility of the sector from a news flow and the stock price perspective can be there. But I think from a core thought process, a lot of these Indian metal companies are likely to have reasonably high volume growth over next 3-5 years.
3 top investment ideas for 2026.
Stocks.
Come on. I don't know if you can give us stocks, but if not stocks, thematically, 3 money-making ideas for 2026 in the equity market.
So one is Indian equities.
No, that is a given. That is a subset that I've already outlined.
Yeah.
Within that, 3 themes.
Yeah, I think consumption. Clearly, maybe second can be metals.
Metals. Okay.
And third is we need to possibly be ready for some sort of upside to outside India-based companies where last 1 year has been pretty weak on news flow, on maybe global economy, maybe tariff-related worries, and we see
some of the exporters.
Yeah, something like that. Yeah, that's right. Export. Basically, anybody earning income from outside India, they have a nice rally because even rupee is supportive for them.
Yeah.
All we need is some news flow positive either on trade deals or,
True, and that has to happen at some point or the other. Right. It should happen. Krishna, thank you so much for joining us. Great to have that perspective from you. By the way, since we're talking exporters, look at the rupee right now. There is absolutely no stopping the decline. I mean, now we're looking at a level of 90.62. So it's just breezing past levels. And this is what I remember when we spoke with Anindya of Kotak last week. This is what he was also. I mean, a lot of experts have been saying that now that the RBI is not defending any level, it's just a race to 91. I mean, it's a one-way bet. Importers have been buying more and more dollars. And it's just, it seems to be a one-way street on the currency. It's already down 0.25%. But early in the morning, I don't know, maybe let's see if we have some sort of intervention as the day progresses.
As the market opened, I just highlighted one stock, which is Geojit. A massive volume took place out there. The stock, I think, was at 68 rupees. I last checked, it was 73 rupees. So there's 15% equity that changed hands on Geojit. And there's a big uptick, what we're seeing out there. Volume's very, very large. We'll try to get you further details, but that's one stock that's on the radar. The other one is Hindustan Zinc. And, we had a note coming in from Jefferies today, and they have gone ahead and they have initiated coverage on the stock with a target price of 660 rupees. Their estimates that they're factoring in with regard to EPS is 22 and 29% over the next 2 years. That's 26 as well as 27. In 28, they're working with, a single-digit growth of close to around 7%. Remember, they're much higher in comparison to consensus estimates on the street by around 9 to around 31%. So their estimates are much higher. The stock, they point out, is trading at around 9.2 times. That's much higher than the long-term average of around 7.3 times, but they believe is justified because of the higher share that it has with regard to silver in the EBIT. On the pricing assumptions, actually, they are 4% lower on their pricing assumption of zinc in comparison to the spot. And on silver, they're 3 to 10% lower in comparison to spot. So pricing as well, they are factoring in softer prices from here on. And in spite of that, they're expecting a big EPS growth. On the sales volume, well, they're saying that will grow only by around 2% over the next few years because expansions will come on stream only by the second quarter of FY29. But they go on to note that by 2030, they have a very, very ambitious target out there. They're expecting strong cash flows in the vicinity, free cash flow of around 8,000 to around 14,800 crores per year over the next few years. That's a little higher than the 10,000 crores that we saw in the last few years. But on the ROE, they're factoring in much better numbers of 70 to around 85%. So put all this together, silver's been twinkling, and Jefferies believes Hindustan Zinc is well placed, even post the big run that we've seen in the recent past. Just one more point, Surbi. In the middle of this year, that's in June 2025, we here at CNBC-TV18 had put out this point with regard to the rise that we've seen in gold prices, and silver could potentially catch up.
Yeah.
At that point of time, silver was up only 15%, while gold was up more than 35-40%. And actually from there on, it's played out perfectly because silver has rallied more than 60% from there, while gold is up around 15-20%. So we had pointed that out. That could be a possibility. Happy that it's played out.
Absolutely. And that was, good foresight to put that out because look at the absolutely scintillating rally on both gold and silver this year. But for now, it's back to equities and back to corporates. BEML is the company that we are putting the spotlight on this morning. Now, the stock is down about 15 to 18% over the last 1 year. Q2 numbers of the company were below estimates. However, BEML has said in the past that it's expecting full year revenues to grow between 15 to 20% for the current year, FY26. So will that really happen? Well, let's discuss this and more with Mr. Shantanu Roy, Chairman and Managing Director of BEML. Mr. Roy, thank you for joining in. First of all, season's greetings to you. I'm hoping you're getting set to wind down the year in a good way. But, if we talk about the performance, and I don't think we've had a very detailed conversation after the second quarter. So let's just go over. Now, the issue is, I think, execution. There's absolutely no problem with the order inflow for BEML. Every month, every quarter, we keep looking at more and more order wins. But the execution has been lacking, which is why year on year, Q2, there was hardly any growth. Margins are flat. So will you be able to achieve this objective of 15 to 20% top line growth and 150 basis points margin improvement, which is what you had highlighted for the full year? Will that happen?
Hi, good morning. You very rightly pointed out, that order inflow is not a problem. Now let us look at, before I move on to the growth in terms of the top line and the margins, let us analyze and understand how the capital goods sector, which has certain elements of gestation period, how it works. So order inflow, absolutely, we are bang on target. And I expect in the next 3-4 months also, we will have some good order inflows, and we should be ending the year 31st March 2026 on a pretty decent number as far as order book is concerned.
Can you give us some numbers there as well? Because that's the best part, right? Because your order wins are so good across, public infrastructure, transportation, and of course, defense. So let's get the good part out of the way. Then we'll come to the challenging part. So you're likely to end this year with the order book roundabout where?
It should be 20,000 plus.
20,000 crores of an order book, end of FY26. Fantastic, sir. So now let's come to the execution. Why is not execution picking up?
Execution is picking up. It's not correct to say that execution is not picking up. Execution is picking up. Now let us look at how the capital goods industry operates. Especially now we have 3 diverse verticals. Where mining and construction is a very fast turnaround vertical, whereas the rail metro and the defense, it has a longer gestation period. When we started the year, we had 14,610 crores of orders, to be precise. Currently, if we look at a 20% growth margin, that is what we are aspiring for, we have the orders except a small chunk of orders, maybe 200 crores, which we expect from the mining construction and which will be executed in the current year. So for executing, for achieving the 20% growth in top line, we have all the orders in place. And it is another good thing is that they are all executable in the current financial year, especially in the rail and metro and in defense. As far as mining is concerned, in the balance period, we expect at least 1,000 crores of order inflow, out of which some 200 crores is required for execution in the current financial year for us to achieve the 20% top line. Now, why it has been flat? There are some reasons. The rail and metro orders that we received and which are now cleared for execution in the current financial year, up to the first half, that is the first 2 quarters, there were challenges in supply chain. The Bangalore Metro, which we rolled out 4-5 days back, we could have done it in the month of September itself, but some of the key supply chain partners, they could not deliver because of certain rejections. Same happened with the supply chain for defense as well. I've been already communicating that indigenizing the key critical components and aggregates, it is taking time to stabilize. And now we are at that stage where almost 90% stabilization has happened. So that's the reason we are quite upbeat that in defense, we will be able to execute our target, what we have planned this year.
So, sir, your supply chain, so just to understand this, the supply chain issues that you have highlighted in the past, you're saying that in the second half, most of them are resolved. Are you on track for 20% revenue growth this year?
We should be, yes.
Okay.
And margin improvement of 150 basis points, right?
If we have a 20% growth in top line, then margin improvement, 150 basis points definitely is going to happen. And now, as far as the supply chain is concerned, we have some critical component suppliers. As I said, 90% stabilization has happened. And in the next 2 to 3 months, it will be, we will reach 100% stabilization. And 25-26 will be the year when our supply chain would have stabilized. As far as the metro is concerned, this month itself, we are also planning to roll out the second metro of the for the Bangalore project. And we will be completing the 63rd train in the current financial year for the Mumbai. And we also expect to at least deliver 6 to 7 more trains for the Bangalore metro in the current financial year. Okay. Again, we could have done more had the supply chain supported us in the metro. In the metro, the supply chain is still to, for the Bangalore project, the supply chain is still to stabilize. Otherwise, we could have done maybe at least 4 or 5 more trains in the current financial year. Okay. So, the supply chain challenges will always be there. Okay. And we are on target to resolve those issues.
Right.
And that is one of the major bottlenecks for the execution, if I may say that. Otherwise, the company's focus is fully on execution. But another thing we must look into is, what is a normal execution? Normal execution is around 30% of the total order book, generally as a thumb rule. So if we end the year at 20,000 plus, so 25, 26 should 26, 27 should see a further growth. That's why we are also focusing on the order book pipeline, because most of our projects, the big projects, are coming from the rail and metro and from the defense, and which have a gestation period of at least 2 years.
Yes.
So we have to build an order book pipeline so that there is a sustained growth.
Got it. Just to confirm that point, but you're confident as of now that 20% revenue growth will be achieved this year, right, sir? Because you said that the margin improvement will be possible if there is 20% growth. So is there a risk to that 20% growth, or you're pretty confident?
We are pretty confident.
Good.
And,
okay.
The third quarter should be much better.
Got it. All right.
We are nearing the end of the third quarter, so it should be much better.
Got it. All right. So good to hear.
It should give an indication. It should give an indication.
Okay. Good to hear, sir. So we're bracing for a better showing in Q3, and you're confident about the year. Since you spoke about railway, I just wanted to ask you, what's the update on the Mumbai Railway Vikas Corporation tender? What kind of revenue, profitability estimates you're expecting? I asked you this because the total contract value, I believe, has been reduced to around 21,000 crores. Early expectations will be around 30,000 crores. So what are the expectations for BEML?
No, the contract value has not been reduced.
It's not been reduced. What is it, sir?
It is still 2,856 cars, that is 238 rakes. And the 21,000 crore that you're talking about is the car price, right? And there is a 35-year maintenance also. So when we talk about the total order book, it is, as a thumb rule, the car price into 2.04 a factor, we can use a 2.04 factor. So that is a pretty big order. As far as margins are concerned, you see that the tender is already out. It's a competitive bidding, and there are a lot of competitors. So on the margin estimates, it will not be correct on my part, to talk about the margin estimates at this stage.
So broadly speaking,
so pricing is a strategy, cost is a reality.
That cost is a reality indeed. So broadly speaking, this order book, our colleague Ria, who tracks the company very carefully, she points out that I think earlier you had indicated that your order book could actually be even higher than 20,000. It could be maybe 22 to 23,000 crores. So I don't know if that's a bit of a scale down. And also just give us a breakup. As you end the year, how much of this order book is defense? How much is going to be, transportation? What will be the nature of this order book as you look at the next year?
If I look at the current order book, it is 65% rail and metro, 30% defense, 5% mining. But again, mining is not very important to have a residual order book. And if we end the year at 20,000 plus, I can see it will be around 70%, more than 70% will be rail and metro. That is a mobility and transportation. Around 25% will be defense and 5% will be mining.
Okay.
Okay, all right. Thank you very much, sir. Great speaking with you, and more questions later, perhaps in the new year. All the best of luck, sir. Appreciate it.
Thank you very much. Have a wonderful new year.
To you too and your team as well. Thank you very much. We'll take a quick commercial break here. We come back with insurance very much in the focus on the other side. We have the former IRDAI members, Thomas Devasia and Nilesh Sathe join in. Remember, the cabinet has cleared the insurance amendment bill. And most likely, now the bill goes to Parliament. Likely today, we're still picking up, or maybe tomorrow. But now that's the next sort of course of action. We talked to both our guests on the other side on what this will mean for the sector and individual players as well. Stay tuned. Welcome back. This is Corporate Radar. Markets, of course, are a bit under pressure, about 0.4% lower. 100 points down is what you have. Well, the Cabinet has approved the Insurance Amendment Bill. It allows 100% foreign direct investment into the insurance space from the current 49%. The new legislation also aims to give more teeth to the insurance regulator, that is IRDAI. We have Thomas Devasia, former member, non-life IRDAI, Nilesh Sathe, former member, life at IRDAI. So we've got both sides covered. Gentlemen, great to have both of you here. Thank you very much for joining us. Prashant this side. Mr. Sathe, let me start by asking you about not what has happened, but what has not happened. So apparently, the composite license proposal is not part of the bill, and neither is the open architecture part of the bill. So composite is, I mean, essentially allowing life companies to start non-life business and vice versa. And open architecture, of course, is allowing agents to sell, other policies as well, not just one life and one general, as it is the case right now. So both apparently are not part of the bill. So just wanted your thoughts there, Mr. Sathe.
Yeah, I think some more discussion has to go into it because there was a lot of opposition on open architecture, especially by LIC. Even SBI Life was not in favor of open architecture. So they need to be convinced there needs to have more discussion on the subject before it is being introduced, because what way it is going to impact business of LIC. Mainly, LIC follow-on public offer is likely to be there, and open architecture should not impact their share price. That may be the thinking of government. So this is what, in my view, probably that is the reason why it has not been introduced in this bill. But maybe today or tomorrow it will come. As we have seen in case of mutual fund, the IFAs can sell mutual funds of any company. Same thing is likely to happen here, and nothing wrong in that. But then let us wait and see, because government may have some apprehensions in introducing the open architecture at this stage.
The company most impacted, of course, is going to be LIC, and perhaps a lot of opposition is the government company as well at the end of the day, in that sense. But you're saying, well, not today, but eventually it's going to come. It has to happen. The other bit is this composite license. What about that, Mr. Sathe?
Composite license till the end was what I understood was on the paper, but I am not quite sure why it has not come finally in the bill. I don't have any idea on that. But again, government might have thought that it may involve difficulty in implementation of it, because one company doing 3 lines of business, 3 separate sets of accounts may create some problem. Probably the IFRS and the risk-based capital that is likely to be implemented now, they may have thought that implementing it at this stage probably may disturb the industry as such. This is what is my view.
Yeah. So, by the way, for our viewers, I just want to say, this is what our colleague Sapna is picking up from Delhi, that most likely the composite proposal and the open architecture proposal is not part of the bill, which is going to be, which has been cleared and it's off the table for now. So, when that bill is finally presented in Parliament today or tomorrow, as we understand it, we'll have absolute specifics and we'll be able to be absolutely certain of it. But this is what we understand as of now. So I just wanted to make that clear. Mr. Devasia, just, same question to you. I mean, your opening thoughts, perspective on this?
Good morning, everyone. Nilesh, good morning to you too. My sense is that the government, in whatever they are planning to clear, are basically looking at what's critically needed for expansion of the sector in India. And to that way, perhaps the composite license, as well as open architecture for tied agents, is not seen as critical. Because if I look at it, a composite license would actually be just accumulation of 2 lines or 3 lines of business, which have very clear financial control deviations, governance, etc. And as Nilesh also alluded to it, it may be complicated to supervise and implement. With regard to tied agents, I believe the situation on ground does not change, because especially the tied agents of LIC, who are perhaps the best distribution force in the country, are already, they are basically family businesses. And there'll be other members who are already addressing other insurers for the simple reason of getting the best products out to their clients.
Gentlemen, morning. I have a bigger fundamental question that I want to raise before both of you. The penetration of insurance in India is so abysmal that the numbers actually shock me, even when I was searching for the latest numbers, right? Non-life penetration is 1%. And this is, I think, total premium as a percentage of GDP. That's the way it's computed. Life penetration has actually declined. It's gone down to about 3.7% from 4%, again, latest available data. So now, I don't know if this is a capital issue, and this is for a sector that came into inception much before mutual funds, right? The first financial products that we as Indians got to know were insurance products. And then these numbers, so something or someone has to account for it. I don't know if it's a capital issue. Is it a capital issue? And if it is, then will it be sorted now that there is 100% FDI? Because to me, as a layperson, as a customer, it doesn't seem to be just a capital issue alone. There's something else that's gone wrong with such abysmally low penetration. Mr. Sathe, your thoughts on this 100% FDI?
Yeah, no, 100% FDI was actually necessary because in majority of the jurisdictions, they don't have any restriction on FDI for insurance. So that was expected, and budget announcement was also there by Honorable Finance Minister. So it was certainly going to be there. And we have steadily increased it. See, why 100% FDI? Because we have seen in the past that with less than 100% FDI, you needed to have Indian partner to start business.
Correct.
And there are many industrial houses which are already into insurance. So finding a good, reliable, long-term Indian partner probably was a bit difficult also. So now, okay, if you find it difficult, now we are allowing you 100% FDI. Now you come and start your business here.
Correct.
So that may be the...
Correct. But sir, as you said, the point is that a lot of very deep-pocketed Indian institutions have already been running the business, whether it is large banks like SBI, whether it's HDFC, whether it's LIC. So therefore, Mr. Devase, let me get your thoughts in. I don't know if really capital is the issue behind such abysmally low penetration, and what changes with 100% FDI?
Okay, so the thing is, when we look at insurance penetration ratios, they're extremely, in my personal view, superficial and also a nominal measure. For the simple reason that when insurance premiums, if you try to bifurcate them, especially on the non-life side, you'll have a huge retail sector and you'll have a huge corporate sector. Corporate sector, the premiums are also increasing because of the underlying value increase, which is also fueled by growth, organic growth and inflation. So penetration, we need to have a new measure for it to actually understand the take-up. It is a capital issue, and I would welcome 100% FDI for the simple reason this is actually a capital-intensive industry when it comes to the exposures on your portfolio, risk exposures. And there are new exposures coming up like cyber risk and all that. There is no capacity, underwriting capacity at all.
Yeah.
So capital is very much required. And I hope the FDI rules amendment will also enable insurers to actually move capital freely between themselves. That said, with regard to why insurance penetration is low, it's also reflecting the disposable income of individuals and households.
So it doesn't have to do with the industry. Gentlemen, so what I get from you is that you're both saying it doesn't have to do with the way the industry has been running itself.
No, the industry requires new capital, requires a number of players, because then only will be the real penetration push that will come.
Let me.
Income does grow.
Yeah, absolutely. I mean, I think it's one of those things, right? I mean, you make more and you want to spend on these kind of things as well. Now, the other thing is, merger of the bill allowing merger of insurance company with a non-insurance company, right, Mr. Sathe? And from a listed perspective, there is this Max Life, Max Financial Services thing which has been discussed over the years. So just wanted your thoughts there, Mr. Sathe.
See, actually, when the Insurance Act was initially introduced, in the sense after 2000 when the sector opened, it was thought that mergers have to be between two insurance companies. Just as only two banks can merger, bank and non-bank cannot merge. There is a reverse merger now allowed, but it was not there initially. On similar lines, initially it was thought that only 2 insurance companies can merge, and accordingly, a couple of insurance companies have merged as well. But
Mr. Sathe, sorry, we want to, I'll just come to you. Just give me 30 seconds. I'll just make a quick mention. There are 2 listings on your screen. Wakefit is listed at 195 rupees per share. It's basically listed at par with the issue price. And there is Corona Remedies, which is listed with a premium of, with a big premium actually, some 30% premium on top of the issue price. So, listings continue. But as I was saying in the morning, maybe in the next 15 days or so, new issue openings, etc., perhaps a little lower, on the lower side, as we wind this year down. So Wakefit 187 and Corona Remedies about 36% higher is a super listing for that one, 1,450 rupees. So those are new listings. Mr. Sathe, go on, sir. Yes. And you're talking about the logic behind now allowing insurance merger with non-insurance companies. Go on.
Yeah. Because especially Max issue has been longing for a long time, because you know that for almost a decade this is going on, and finally it was thought that what is wrong in it? If reverse merger is allowed in case of banks and NBFCs, why two other than 2 insurance companies, 1 insurance company and 1 other than insurance company? I'm not saying non-insurance company, other than insurance company. Why they cannot merge? And there was a lot of thinking going on this, and finally it has been approved, which will help actually some of the sectors to grow also, because it's not a question.
Mr. Sathe, do you have a view specifically on Max Financial? You think the road is clear now once this goes through, or are there any pending issues?
No, I think the road is clear. Actually, this has been made so that the transaction can go through.
Okay.
I think so.
Ah, interesting. So then, the holding company discount for Max Financial should also come down.
Yes.
In that sense, right? So a positive from a share price perspective as well. I have more questions, and it's always a fascinating sector to discuss. So I hope you will come back once we have actual details. I want to emphasize once again, some of what we discussed, of course, is based off the reporting from our colleague in Delhi. And once the bill is cleared by the Parliament, pushed through, we'll have the actuals, and we will sort of, invite both of you and other experts, industry experts as well, to talk about this. Thank you very much, gentlemen, for joining us here on CNBC-TV18. 90 points lower, 25,960 is where we are at. What we'll do is we'll take a quick commercial break here. Up next, we connect with Nagaraj Sethi of HDFC Securities for some technical trading ideas. Stay tuned. Coming up.
Fly Emirates, fly better.
Welcome back. So it's a subdued morning, as the implied open was indicating. We got that gap down 100 points, and as of now, there are no buyers. But let's see. It's very early in the day, so we'll see. Let's ask Nagraj Shetty what the approach should be. Nagraj, it's been a market which is working in very tight ranges, tight goalposts. Would you be a buyer of this dip today?
Yes, obviously, markets still, though showing a nervousness at the higher levels of around 26,000, the overall trend, the reversal, what we have seen last couple of sessions is intact, and I'm expecting around 25,900 to 800 is going to be a strong support for the market, and eventually we could see Nifty bouncing back towards 26,000 levels and higher. The next upside target to be watched in the near term for the Nifty would be around 26,300.
Okay. Nagraj, what about individual stocks? What are you trading today?
I have two stocks on the long side. First one, Usha Martin. Chartically, Usha Martin has been in a consolidation phase over the last couple of weeks. The larger degree of uptrend remains intact. Higher tops and higher bottoms is there or visible on the daily, weekly chart. Currently placed to move above the consolidation. Currently trading around 448, 449. One can look to buy at this point of time. 475 would be the immediate target for the near term, and one can place a stop loss at 435. Second one is from a metal front, NMDC. NMDC was moving in a narrow range over the last couple of months and currently placed at the edge of breaking above the important resistance of around 78.50, 79 levels. The overall chart pattern is looking positive. I'm expecting after the consolidation, eventually this stock could give a decisive upside breakout of around 78, 79 levels. Currently trading around 77.90, 78, one can look to buy at this point of time. Immediate target would be around 83, and one can place a stop loss at 76.
Okay. All right, Nagraj. Thank you so much for that. By the way, I just want to point out that Wakefit is now down about 8.5%. Such a different listing, right? Just last week we had Meesho, and what a listing Meesho was. From 100, the stock went to 145, 150. Wakefit is the reverse. It's very, very subdued. But I guess we go back to that valuation argument, Prashant, that we were having earlier. I mean, at 80 times FY26 earnings, I mean, how much does it leave on the table, should I say, on the bed for this one?
It's a little sleepy this morning, right? Wakefit, 8% lower. And we'll have, actually what we'll do is we'll put up a valuation table, as we often do for many of these newer listings. On day one, where do valuations stand compared to, I mean, whatever is the closest comparable in that sense. Amber is what we're going to talk about. There was an analyst meet. Management is reiterating strong guidance. Upasana is here with that. Upasana, over to you.
Yes. Now, let's straight up look at the analyst meet takeaways. Now, management has reiterated their guidance, implying a strong 13 to 15% outperformance to the industry in consumer durable segment. Now, in FY26, company has given an overall guidance of 10 to 15% growth in RAC and 35 to 40% growth in electronic segment. Now, company is seeing a sequential improvement in the demand in consumer durable, while there is still channel inventory in the system for RAC, and mind you, 1st Jan onwards, the new energy norms will also kick in. Now, electronic division, the company says that the growth here will outperform the other segments led by new client additions and even acquisitions. And company has given a strong growth outlook in other segments over the medium term. Now, overall, if we look at the main focal point of the discussion was the company's electronic segment. So overall, we are seeing a positive commentary from their analyst meet, and certainly revival of demand is what the company has indicated.
Okay, all right, Upasana, thank you so much for that. Well, with that, we have to get into a quick break, but coming up on the other side, our special segment, it's the economy. Today, Lata speaks with Bhavesh Jain, CEO of credit scoring company Cibil, on the quantity and quality of loan growth after the GST cuts.
You want to talk business? Meet me in the On-Board Lounge.
Welcome to It's the Economy. Credit scoring company Cibil, we all have a Cibil score. They've published their latest report and it says credit demand and asset quality, that is all aspects of credit, have improved in the September quarter and continue in the festive month of October. Cibil finds that whether it is loan disbursal or the amount of defaults, PSU banks have done the best, and then NBFCs and then private banks. Cibil uses an index called Credit Market Indicator, or CMI, to measure the overall health of the loan market, that is demand, supply, customer behavior, asset quality. Cibil says that while this CMI has improved in the September quarter versus the March quarter, or the July quarter, the index at the moment is far lower in 2025 compared to 2023 and 2024. Now, why this? To understand all this, I have with us the CEO of Cibil, Mr. Bhavesh Jain. Mr. Jain, thank you very much for joining us. Let me start with that question. When I saw your CMI, your credit market indicator, you're saying that it was much better in 23-24 and not so good in 25. Why is that?
So, firstly, good morning and thanks for having me on the show, Lata. Yes, there are a few reasons. When we look at the year of 2023 and specifically September 2023, we had a base effect coming out of the COVID where the portfolio growth rates, as well as in terms of the consumer behavior, the percentages were significantly higher in terms of 2023 as compared to 2022. Now, when we look at the recent quarter of September 2025, it has improved significantly as compared to the previous two quarters. But also at the same time, we have to look at the slowness in terms of the balance growth, and there is a lower growth on credit active borrowers in 2025 as compared to 2023. These are the three main reasons for...
What do you mean by credit active borrowers? I mean, those who already have a loan?
Those who have a loan and who are making payments or looking out for a loan.
Okay. And, okay, let me come to the festive season. I mean, that's the big thing which I wanted to know from you. How much better is it? Is it likely to take this October, November, December quarter to the 24 or 2023 levels in terms of loan demand, in terms of customer behavior?
So, relevant question, I would say, Lata, because post the GST reforms and the announcement in rate cuts and the start of the festive period, we saw a significant spike both in terms of credit demand and credit supply. And which are the retail credit products which saw a significant growth? All linked to the festive mood, I would say. The vehicle loans, the two-wheeler, auto loans, consumer durable loans. If I were to say, these were the three major call-outs in terms of the credit demand picking up. And on the supply side, along with two-wheeler, auto, as well as in terms of your consumer durable, we saw a significant spike in terms of the gold loans. So these were the retail credit products which saw significant growth during the festive period as well as post the GST rationalization.
Okay.
And the entire October month, I would say from the last week of September to the entire October month, there was significant growth in terms of both the credit demand and supply.
Okay, now let me ask you an unfair question. I know you won't have November complete data. Your report is as of October. But any guess you can give us from what you know already, whether November showed a much better growth than previous November? Was it just a festive burst or has it continued?
So, Lata, the credit demand has tapered off post the festive period. So the significant spike we saw in the last week of September and October month, in November it has tapered off significantly.
Oh, okay. So we cannot be very sure whether the GST cuts will give us a sustained rate of growth. Maybe I will have to wait for Cibil's next report, or can you fill us in?
Yeah, so I would say we do expect, Lata, that in the end of the financial year, specifically March, we do expect the demand and supply to go up significantly again. Because historically, the financial year does bring in a growth in terms of both demand and supply.
Okay. Yeah. All right. Then in that case, it's a likely positive comment from you. Let me come to the other nuances of your study, which were interesting. You say the PSU bank's CMI was the best, much better than private sector, which is not the way stock market guys understand. Why did they do so much better? On what parameters?
Multiple things. One is that post-COVID, the PSU banks have been focusing a lot on mortgage loans and specifically on the housing loan. So they have been building nicely that book of housing loan over the last 2 to 3 years. The growth rates in terms of the portfolio balances have been on the higher side. Plus, in terms of because of the base effect, through the door population selection, all those parameters have added and helped the PSU banks where their growth rates are significantly higher. Their portfolio quality have improved significantly. So those are, when we look at the CMI 4 pillars, PSU banks have performed well on all the 4 parameters and hence their CMI is the best.
Okay, okay. Well, the other interesting nugget I picked up in your report is that semi-urban areas actually are doing the best, both in 2024 and in 2025. They are accounting for the highest share of loans of credit. Can you fill us in? I mean, what kind? Is this tier 2, tier 3 cities? Which geographies? Any detail you can give us on this?
Absolutely. So we have to look at few factors which has led for last 3-4 years in the semi-urban and rural location growth rate. One is the increased branch penetration of banks and NBFCs, the digital penetration, and most important is in terms of the headroom available for credit penetration in these geographies. And to your specific question, Lata, it's largely the tier 2, tier 3, tier 4. And if I have to call out one geography, a set of geography which would stand out, would be locations with a population less than 1 lakh. And this is very encouraging sign to see that credit penetration is really going down to the grassroots levels.
Okay. No, we visually see many of the tier 2, tier 3 cities look much better when we visit them. You know, when you look at Jaipur or Indore, I mean, the growth is very, very palpable when you visit the cities. So maybe a special study is needed to understand that, you know, it's not metro, but semi-urban, where perhaps India is growing the fastest. Let me come to the issue of what is not done well. Credit cards, they're in actual contraction. Isn't that a bit dangerous?
Yeah. So what's not done well for us in terms of the retail credit market? Yes, credit card, the originations is declining year on year, and we have seen it for last 3 to 4 quarters that the credit card originations are going down year on year in terms of the growth rates. But what's good in terms of the credit card is the portfolio quality have improved in the recent quarter. One. Second is in terms of the utilization levels have gone up, as well as the credit card balances have gone up. So yes, there is a concern in terms of the new credit card issuance growth rate, but the portfolio quality have improved, I would say. 2-3 other areas for us to watch out in terms of making sure that the utilization level is managed by the consumers on their credit card in their wallets.
Okay. So what you're saying is this is not a question of India's growth, retail growth getting challenged. It is more a cleaning up of portfolio.
Yes.
Okay.
Yes.
In that case, that's a positive. Where are you worried? I think you're worried about the small micro loans. That's where you're seeing higher defaults.
Yes. So, Lata, if you look at the aggregate retail credit portfolio, it has improved significantly. Okay, from the 2%, say, a few years back, it has come down in the latest quarter to 1.6%. Okay, so when we look at across the secured loans, whether it's housing, property loan, the portfolio quality or delinquencies have improved for good. Even on the unsecured side, personal loan, credit card, consumer durable, it has all improved. But there are few areas which I would call out. First one is micro LAP, which is the less than 10 lakh loan against property. Second is the small ticket housing loan, which is less than again 25 lakhs. And third is the commercial vehicle. So these 3 areas where actually the 90 plus coincidental delinquency have actually increased. Now, these are the 3 areas I would call out where the delinquencies have increased. Rest all portfolios, the delinquencies have improved. The aggregate retail credit portfolio has improved significantly.
Okay. Oh, that's very important. Aggregate credit quality, very good, but pockets of under 10 lakh MFI loans, LAP loans, and under 25 lakh housing loans are the only small areas of problem. We are completely out of time, but very quickly, your volume growth in origination shows, a fall, but value growth has done very well. So should we understand there is a premiumization? Fewer people, the rate of growth of loan taking is not high, but the same people are taking larger loans.
Yes. So we see a significant shift in terms of lenders going after high ticket loans, whether it is a housing loan, auto loan, or personal loan. The growth rates in terms of the higher ticket sizes is significantly higher than the lower ticket sizes. So we see a big focus in terms of higher ticket size, as well as in terms of existing to credit and existing to lender concentration going up in the recent times.
Okay, well, we'll have to leave it at that, but that's a very useful insights that there is a premiumization and there are more of the loans are going to well-off borrowers as well, that semi-urban is doing very well. Overall loan quality excellent. All that are extremely positive. I'm only worried about the fact that you say in November loan growth has distinctly shown a fall off the cliff. But we will wait for the next Cibil report on that. Thank you very much for joining us, Bhavesh Jain. We have to take a break on that note. Thereafter, it will be time for Chartbusters.
The Indian market opens with cuts on weak global cues. All sectors apart from the FMCG trade with losses. The Nifty gives up that 26,000 mark. The broader market too seeing deeper cuts.
Indigo's operations return to normalcy with the airline running over 2,000 flights on the 13th of December. The stock is now the top gain on the Nifty ahead of its inclusion in the Sensex on Friday.
Amber Enterprises rallies as the management reiterates its guidance of industry-leading growth, expecting 10 to 15% growth in the room AC segment and 35 to 40% growth in the electronics business.
Godavari Power is up close to around 3% as it announces that it will enhance the capacity of its battery energy storage system project from 10 gigawatt watt hours to around 40. The investment is also more than doubled to 1,625 crore rupees.
Home furnishings retailer Wakefit Innovation sees a subdued debut on the street. Stock lists flat, thereafter falls to a 10% discount to its issue price and now recovers and still sitting with a cut of 4% from its issue price. Don't go anywhere because the management will join us shortly on Chartbusters.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the market's, well, in a bit of a funk as we speak, though we've recovered considerably from the low point of the day. From trading closer to around 25,900, we're at around 26,000. But don't lose sight of the Indian rupee. That's at around 90.7. Could explain why some of these tech stocks are finding their form as well. Mangla, but we got a management waiting by?
We got a management waiting by, Nigel. We will monitor the markets and the rupee as well. But we'll monitor how home furnishings company Wakefit Innovations also performs going forward, because the listing was slightly subdued. It was flattish, slipping into losses soon after. Thereafter, it saw a bit of a recovery, but still sitting with a cut of 4% as we spoke. Chaitanya Ramalingegowda, who is the promoter and executive director of the company, joins us now. Thanks a lot, Chaitanya, for joining in. Be that as it may, the way the stock is listed, etc., it is a red-letter day for you and your team. So congratulations on being part of the secondary markets. Welcome to the markets, as they say. But now,
thank you.
With a lot of celebrations, a lot of responsibility also increases, because now the street has given its verdict. It's believed that maybe the value at which you offered the issue was pretty much a fair value. That's why we haven't seen a big jump or a big decline from its issue price. The important part is how much further can you grow from here? And I'm taking on from the last conversation that we had. You did say that your revenue growth, you don't have a problem. You will continue to open that 35 to 40 stores annually as well. But you left us with a bit of a tease. You said that there is a much higher headroom for margins. So if you could give us a sense on how much higher can margins go from here, because the first half margins were around 12%, which was a big jump from what we saw earlier. Can we see margins around that 15, 16, 17% in the near future? If yes, then by when?
Yes, definitely. As you know, furniture is a new category that we entered barely about 3.5 years ago. So this is a category which has a huge touch and feel element, and that is exactly the time we also went in for omni-channel expansion. Till that 3 year ago period, we were a pure online company, but now we've evolved into a full-fledged omni-channel company where customers can research anywhere online, buy anywhere offline, or vice versa. So that is going to continue. But when I talked about margin improvement, a lot of the juice is going to come from furniture. Like I said, because it's just a 3-year-old venture, plus we put up one of India's largest greenfield projects to manufacture furniture in Hosur. It's beyond Hosur. And that is where it's state-of-the-art, world-class, furniture manufactured by robots, completely automated. And that is where the utilization is steadily going up. And this factory has the potential to take furniture to 3x revenue from where we are currently. So that is a big fixed cost absorption coming our way, where we are sweating the fixed asset. Secondly, as the density of orders from specific pin codes is growing in furniture, supply chain cost, which is a large part of furniture's unit economics, gets better and better, because the truck and the carpenter spend more time in the consumer's home as opposed to being on the road going from home to home. So those are two big levers in front of us in terms of improvement for margins at a company level. Mattress and accessories are already a very mature business, and there again they will contribute another 1 or 2% margin improvement from their side. Although they are mature, there's still small headroom left there. So those are the three sources from where we believe that margin can improve further, quite sustainably, not a flash in the pan. And unlike a tech company, what we do pays off every quarter.
So you've given us a sense on margins
work.
from mattresses can increase by about 100 to 200 basis points. From furniture and furnishings, can we expect around 500 to 600 basis points increase?
Yes, that could be the range that we've taken, and we will be chasing over the next 3 to 4 quarters, and that is primarily because of all these utilizations of middle mile trucks, warehouses, and production facilities that I talked about.
All right, hi Chaitanya, good morning, good to see you in. This is Nigel on this side, wishing you, your team all the best, and we look forward to chatting up with you rather soon. Well, I want to press you a little bit more on the furniture part of the business. The furnishing part of the business, I think it's around 10% of your mix. So I think back of the envelope calculation will suggest that at peak revenue potential, what it can do, 360 to 400 crores. Will that be a fair estimate?
I have to clarify something for you. Furnishing and decor is the small ticket size items, which is the 10%. Furniture, which is essentially sofas,
that's 29%.
Wardrobes, bed frames, that is already about 30%, yes.
Got it. So, so the revenue potential you were talking about that can go 3x is on the furniture part of the business. Is that correct?
Furniture, correct.
Furniture.
Correct.
So that would mean that in the last year, you would have done close to around 360 crores, very, very roughly, in this part of the business. And the capacity that you have as of now could potentially take it closer to 1,000 crores. Fair?
Correct, correct.
Got that. By when do you think you can hit this optimal level?
The utilization is growing up every quarter, primarily because the growth rate of furniture category as a whole, with given the much larger TAM, is growing at about 25 to 30% year on year. Because of this growth rate, I'm talking about historically, because of this growth rate, we believe that this capacity is more than sufficient for the next 2.5 years or so. Because when we think of the next capacity expansion, we'll have to think 6 to 9 months in advance. So at that point in time, we'll have to take a call on whether we need more capacity and in which part of the country.
So basis what you're saying, furnitures can be about 1,000 crore business by FY28, just given the sort of utilization run rate and the growth rate you're projecting.
Correct. It should be in that ballpark, given the much smaller base and growing at a faster clip than mattresses.
Got that. So, 1,000 crores by FY28 comes in from furniture. Margins for that business, obviously, a lot higher. We are looking at some growth coming in your mattress industry as well. You said it's mature, but I'm sure, double-digit growth is what the industry is expected at. You will do slightly better than that, a couple of 100 basis points better than that as well. So, suffice to say, you could very well be about a 3,000 crore company in terms of revenue by FY28, given the growth in furnishings, furniture, and the steady growth rate in mattresses. And this compares with about 1,270 crores that you did in the previous financial year?
No, I think that ballpark is a little too aggressive. I think we should be growing at a company level. We should be growing in the early 20% kind of a ballpark, which we'll have to all the strategies that I talked about: omni-channel expansion, opening up the new category, premiumization of the overall category. All of those things will contribute to that estimated growth that we are projecting and working towards.
20% revenue CAGR is possible, and at the FY28 peak optimization level, what would your operating profits or EPS be? How should the street look at that?
No, I think it's safe to say that the margin headroom is another 5 to 7% easily in the next 3 to 4 quarters itself. I would not want to provide guidance for a 2 or 3 year period because there's so many unknowns that we have to discover as we go along.
Okay, got it. Final question before we let you go. Ad spends you've earmarked, I think, close to around, more than 100 crores odd for ad spends. I think it was around 7 to 8% of sales. Where do you see this number stabilizing at?
Similar number. We are not a company that is artificially propped up through just huge ad spends. So we believe on a large revenue base, 7 to 8% is a very good number to continuously sustain, because we want to build memory structures, build steady investments in marketing. So we think that is more than sufficient for a steady period of time.
Got it. All right. One more quick question. If I could ask you, squeeze it in, because look at our ticker and Sunny, so the rupee that has depreciated. And I think as a percentage of your raw material requirement, more than 35% is imported. So is there a currency risk out here? Or have you hedged the rupee? If you could help us out with that. And are you looking at basically reducing your dependence on imports to get rid of this rupee uncertainty as well? Your take?
Our raw material, like you said, most of it is sourced domestically. A small percentage is sourced internationally. But more importantly, we are always buying and keeping stock when the prices are very, very good, opportunistically, because we have a very healthy balance sheet. We use that capital to buy and keep rather than be subjected to the vagaries of rupee or vagaries of the raw material prices. So even if this is sustained, then we might have to decide what to do over the next 2 to 3 months. But if it's a short-term 2-3 month kind of a thing, we have enough and more raw materials to continue to operate at the current levels. But we as a company don't focus on hedging. We believe that is speculative, and so we don't do that. But we focus on this kind of a lowering of raw material prices on an average basis.
All right. You don't believe in hedging because you believe that is speculative. I would believe otherwise, because if you don't hedge, then you are speculating on the trajectory of the rupee. But be that as it may, that's a conversation for another time. Today is a celebration day.
The industry is quite different, where even if you hedge at that price, supply can be constrained. So we decided to do this approach over the last 10 years.
Take that point. Wish you good luck for the next few years. Hopefully, all your projected targets are met. In fact, not just met, they are exceeded and as well. And the street is delighted, just the way your customers are, basis the sleep that they get on your products. But now the shareholders need to be delighted with the sleep that they get on the gains that they make on your issue as well. Wish you and your team, once again, a very good luck. Come back on the other side of the short break. We will talk about the markets full tilt. Shivangi Sarda joins in with a quick view.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're tuned in to Chartbusters. You're on CNBC-TV18. Well, let's get a view on the markets. We have Shivangi Sarda, Motilal Oswal Financial Services, who joins in. Hi, Shivangi. Good morning. Good to see you in. What's your take? Markets a little lower. Buy the dip or stay away?
Very good morning, Mangalam and Nigel. Thank you for having me. So we've seen that the markets are, tiny bit struggling near 26K levels. And we've seen that there has been a good amount of bounce back because support-based buying is quite strong here at the 50 daily exponential moving average for Nifty. We've seen that overall India VIX has also cooled off, but there are some bit of call writers that are still present at the higher zones, which are building in some pressure for a fresh follow-up buying at these levels. But then again, we have gotten stuck into a range from the last 4 to 5 trading sessions, and we are looking at 25,800 as an important major support. And, if it sustains above 26,000 levels, then it could see levels of 26,200 and then lifetime high levels. But of course, we are witnessing some bit of a consolidation at these levels that has to be played out. So buy and decline to continue, but intraday swings will be there and pressure will be intact. But as we compare Bank Nifty, this index has been, relevantly stronger. And we've seen that from the last 8 trading sessions, it has actually consolidated in a very narrow band, held on to the important support levels. And while the Nifty index showed weakness, this index, did not bend that much, which is quite a positive, thanks to the private heavyweight banks, which have contributed to the lot. Overall, we are expecting good amount of momentum in the banking and non-banking NBFCs rather, and we are expecting 59,750 and then 60,000 odd levels for Bank Nifty with a support of 58,800 mark.
All right, Shivangi, you've given us your call on the indices. Individual stocks, is there anything that stands out?
So individual stocks, first up, of course, as we discussed about the strength in Bank Nifty. So I pull out Axis Bank from that space, which is quite resilient. And we've seen on a month-on-month basis from the last 4 months, the stock has consistently made higher lows, which suggests that any small declines are being bought into. We've seen that from the last 8 trading sessions, the price and volume have been steadily rising higher with a positive divergence of the RSI indicator. The stock is perfectly respecting its key exponential moving average on the daily frame as well, so indicating a positive trigger over here. So recommending a buy with a target of 1335 levels for Axis Bank with a support of 1260 levels. And the second pick on my radar is IOC. This stock has witnessed quite a lot of momentum thanks to the global cues. And after the consolidation of the last 14 trading sessions, it has kind of attempted to come out of this level, and 166, which used to be a previous resistance, is now, trying to surpass this levels and hold above it. We've seen that the stock has been trading in an upward sloping channel, and from the last 9 months, we've witnessed good amount of buying here as well. So this one's a buy here with the next, we're expecting the next targets of around about 173 here with a support of 162.
All right, take that point, Shivangi. Thank you so much for that. You leave us with a couple of stock ideas. Let's get you some more ideas for profit. This one comes in from our colleagues at Money Control Pro, and today we have Lekha Badlani, who's joining in.
Yes, so I'm positive on Craftsman Automation, as I think it's entering a strong multi-year growth phase driven by a couple of catalysts. One being their acquisition of DR Axion, which is helping Craftsman diversify its auto aluminium portfolio, which was previously skewed towards two-wheelers, has now shifted to a large percentage coming from passenger vehicles. Moreover, the capacity ramp up at Bhiwadi and Hosur, solid order visibility from domestic and export customers, and margin recovery at Sunbeam from FY27 onwards should further lift profitability of the aluminium segment. Secondly, its powertrain division is also poised for a structural upswing with non-auto applications and global outsourcing opportunities supporting medium-term margin expansion. The company's German arm, Frauenberg, and its new Coimbatore facility positions Craftsman squarely in the fast-growing data center stationary engine market, a vertical expected to scale to $100 million in revenue by FY29 or 30, with half of the order book already secured. Additionally, the industrial and the engineering business offers steady cash flows to the company, with margin tailwinds expected as utilization rises across its new facilities. At 32 times FY27 estimated earnings is trading well below its 5-year average, underpinned by the accelerating growth drivers and long-term optionality from the data center power solutions. Craftsman offers a favorable risk-reward profile, and investors can consider accumulating the stock on market weakness.
Well, good to see you, and as always, Lekha, thanks a lot for joining and giving us that update. Let's slip into a short break. We'll get you more on markets and stock-specific action on the other side.
Fly Emirates, fly better.
Welcome back. Even as we speak, the Nifty is making a recovery, attempting at a recovery. The mid-cap index, while at an index level, is down 0.4%. The advanced decline tells you that, the bulls are coming back. We still have the green line above the red one. That's a positive, and a bunch of these stocks are moving. So we have around, 1,400 stocks which are advancing. KEI Industries, on the back of that order win, that stock is higher. We're seeing some traction in Britannia as well. The FMCG stocks doing extremely well, but don't lose sight of PVR. Suddenly, there's this fervor around movies, and maybe the listing of Dhurandhar has done well for the cinema industry. And typically, as we move towards the year end, the plate looks fairly good as well in terms of releases. All of that in a bombed out stock now, reflecting it's a 7% up move. that we're seeing on PVR.
I think over the weekend it crossed the 300 crore mark, right? And this year I think there were very few films that managed. Sayara, I think, did it. Chava did it, and
now we have Dhurandhar. Have you watched it?
That's it. No, not yet. But I'm planning. I've got some pressure from wife. She says, when are we going to watch it?
I suggest after you watch the movie, why don't you do that viral step which is on? Right. What we do is, on that note, both Nigel and me take your leave on this edition of Chartbusters. But on the other side, you have the team of Trading Hour, which includes me, coming up next to take the market action forward. Thank you for watching. Good morning, you're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. As always, I'm Manglam Malu. With me, Hormas Patakia. Joining us from our Bangalore studios is Ritu Singh. Yes, the frontline indices, they're in the red, but nothing really to worry about. Why do I say that? Because from the lows, we've seen a recovery on the Nifty. The Nifty, which closed above that 26,000 mark on Friday, opened a shade lower today. From that decline, we've seen a dip being bought, and the Nifty has recovered almost, 80, 90 points from those lows. A large part of that recovery is led by the IT index. While all indices, sectoral indices, are in the red, the IT index has actually staged a massive recovery, currently at the high point, led by the weakness that we're seeing in rupee, which Ritu will talk about a lot more. And look at the advance decline ratio as well. Even as the indices have recovered from the lows, there are more stocks which are advancing than the number of stocks which are declining. That should make bulls feel happy. So we're down, but perhaps not out. Hi Ritu, good morning, happy Monday.
Good morning, happy Monday, Manglam. Down and not out. In fact, about 1437 stocks advancing compared to about 1361 declining, which is a bit of an improvement from how we saw the trading session start today. But yes, market's still under pressure, and rupee that you spoke about hitting an all-time low again at 90.70 is the level we saw today. We'll have to see if it swiftly makes that move towards 91. I think that's the next mark to watch out for, or whether RBI will intervene to stop that kind of a fall. Lots of buzzing stocks today. We've covered some of those for you, in trade today. But the top losers, look at CCL products, PNB Housing, some of the insurance names, the New India Insurance Company, PB Fintech, ONGC, some other names like Credit Access Grameen. These are some of the top losers in trade. But Hormaz is standing by with the key buzzers. Hormaz?
No reason to complain whatsoever, at least as of now. The dip getting bought into, and the broader markets too fighting to hold on to some resemblance of gains, or at least ensuring that the fall does not widen. We'll start off with WPIL today. Is the biggest single day gain that the stock has seen in the last 4 months. Is the 9% up move in today's session. The stock has seen 1 lakh or more shares trade for the first time in a month now. There are 1.8 lakh shares that have been traded. The 20-day average of just around 22,000 shares, so almost 9x of its 20-day average. The key move remains below key moving averages, but the important levels first to watch is the 50 DMA at 421 and the 200 DMA at 423. The stock has had a disappointing year so far. It's down 44%. It's turning out to be the worst year that the stock has had since 2008. The other one today is Reflex Industries. We'll talk about that in just a bit. 10% higher. It's a 30% recovery from the opening lows. The stock was up only once in the last 5 sessions going into today's trade. Well over 2 crore shares have been traded now on Reflex Industries. The 20-day average of just 10 lakh shares. Now, the stock still remains below key moving averages since the 7th of November. It has not managed to cross any of those important levels. And this one too, down 42% so far this year, turning out to be the worst calendar year since 2012. And lastly, Coffee Day Enterprises, again the biggest single day gain in the last 4 months. The stock had done well in 3 out of the last 4 trading sessions. Close to 20 lakh shares that have been traded on the stock today. 20-day average of just around 1.5 lakh. The 200-day moving average, it has moved above that now at 35.65. The 50 DMA comes up to 39. So that's the other important level to watch. The stock has done well this year, up around 60%, but was down 60% last year. So cancels itself out. Back to you guys.
All right, take that point. Cancels itself out. That's the view coming in on a bunch of these buzzing stocks. In fact, just look at PVR. The stock is up around 7%. Weekend reports of Dhurandhar did suggest that there was a good recovery, good collection. The movie's crossed over 300 crores in gross collections so far. Importantly, the line of movies which are slated for release in this quarter and towards the next quarter as well, looking good. So there is a fervor among people in in terms of going and watching movies, so to say. But is that so in travel as well? Looks like it. Luxury travel still here to stay. TBO Tech is one of those stocks which is doing well because the company held its analyst meet in Dubai last week. And we did have a bunch of brokerage notes coming in. Jefferies, for one, stands out because they retain their buy rating on the stock. They've increased the target price from about 1,800 rupees to about 1,950 rupees. And the key takeaways that they have, they say that offline agents, the business that the company is in, are still relevant amid rising luxury and experiential travel demand. The company is scaling artificial intelligence tools to empower advisors and partners. They have some of the important ones like Emirates and Hilton across the world. And key account manager investors are all tapering. So going forward from here on, margin turnaround is underway. So with these 3 key takeaways, what have they done to their estimates? If you look at their FY28 revenue, EBITDA and profit estimates. Profit jumps from about 200 crores to 544 crores. EBITDA jumps from 300 crores, more than doubles to 760 crores. All of this on the back of the revenue growing from 1,700 crores to about 4,300 crores, led by good gross GMV addition, gross merchandise value, and increase in take rate as well. So TBO Tech doing well, the stock holding up in the green.
All right, let's get some broader views as well, Manglam. JP Morgan's head of Asia Equity Strategy, Rajiv Batra, believes that the bull case for the Nifty by the end of 2026, that is next year, is going to be 33,000. He also shared the key triggers that will aid this kind of a growth. Take a look.
We saw some signs of it during the September quarter result, where we got close to 9% bottom line growth overall from MSCI India, surprising to most of the sell side over there. Now we are moving into a cycle where next 4 to 6 quarters you will be getting early double-digit kind of an earning growth number, and potentially even a surprise like ongoing quarter, and that leads to you towards almost 14 to 15% upside on a base case. In a bull case, you require a trade deal. And that's where the re-rating will click in. And with 15% earning growth plus close to around 14 to 15% re-rating, you get up to the bull case. But bull case require a trade deal between India and US. Any kind of a trade deal or a truce happen or relationship get fully normalized over there, definitely re-rating will be back on the tables. So if you look at again emerging market performance this year, 75% of a return for emerging markets or even global market could be explained through valuation re-rating. India has seen valuation de-rating because India's relationship US was not that great enough what it happened last year. So only driver left for India is either currency, dividend or earnings. Earnings was also missing. So let's suppose if earnings make a comeback at a 12, 15 or 13% handle, that's the short return you will get. On top of it, even if the relationship remain on the sideline, you can expect zero valuation re-rating. But in case if relationship get marginally better, 5%, fully better, maybe 15% re-rating you will enjoy. So that's the difference between base and bull case will be. But encouraging part is, as you can see for the past few days, talks have again started happening between the PMs and the presidents overall. We have seen in month of October the defense deal was being done and people are warming up to it. So you can say as a base case, the first line of post you want the 25% penalty tariff that was imposed on India for Russian oil import. That needs to come down because India's Russian oil import has come down. So if that tariff goes away, market will start pricing. Things are moving towards much more better level.
Rajiv Batra of JP Morgan there. Just before we take that break, pull up a lot of these pump companies and they have been doing fairly well since the last week. Shakti Pumps is one of them, and it received orders last week, and in line with Shakti Pumps, a lot of other companies also had received orders from the Maharashtra state company. So 11.5% higher on Shakti Pumps, and Vishnu Prakash Punglia, that too is one of those companies related to the Jal Jeevan mission. That too is trading with gains of around 4.5% today, recovered from the lows of the day, of course well below its IPO price of 99 rupees. So keep these pump companies on your radar as well. Take a short break. Market technicals on the other side with Somil Mehta of Mirae Asset Sharekhan.
You want to talk business? Meet me in the onboard lounge.
Welcome back. You're watching Trading Hour. The markets remain in the red. Sensex down about 200 points as we speak, and Nifty about 66. But the rupee has been in focus yet again, touching another fresh low in trade today. Now it has recovered a bit from there at about 90.63. But the fresh low it hit today against the dollar was 90.73 compared to the Friday close of about 90.41. Now, dealers have been talking about a large RBI sell position in the NDF or offshore market 1 month ago. That matures today, and that could be pressuring the spot rupee. But Lata is here with more. Lata, what are the reasons why we're seeing this fresh pressure? And that November trade data is also going to be key to watch out for.
Yeah, actually, it's yet another day and yet more FPI dollar buying. But yeah, the specific reason today, what makes it different from 2 days ago, is that this 1 month ago sell position that RBI entered in the NDF market was a 1 month sell buy, and that NDF market pressures the spot market. In the spot market, the Reserve Bank has been supplying dollars, but as in the past several weeks, it is not trying to defend any level. It's just offering once in a way. So the market is kind of reconciled to further falls. The demand has come from equity FPIs, but dealers are saying increasingly we are also seeing demand from debt FPIs. Actually, year to date, we are positive on debt FPIs. It's an inflow of $8 billion. But lately, dealers are saying there is a sell because people are seeing the currency bleeding, and that's taking down their profit. So some selling is coming from that quarter as well. And then the most important number that dealers are looking at is the November trade deficit. A CNBC-TV18 poll gave us a number of about 29-30 billion trade deficit. This compares with 41 billion, which was the October trade deficit. We put it to one-offs, the economy getting used to the US tariffs and the festive season gold buying. If it were to surprise in the negative and be way over that 30 billion that the market is mentally prepared for, then there can be further reverses, further attacks on the currency is what dealers worry. So important day to watch out.
Lata, thank you for that update there on the rupee. Of course, another low, another day. 90.72 is where the currency had depreciated to. Some recovery from the lows in 90.64, and that has had a bearing on a lot of these IT companies. The IT index recovering from the lows of the day, and that has contributed to the Nifty's recovery from the opening lows as well. But one stock that has been on the radar all through last week has been Hindustan Zinc. It had its best week since May of 2024, and it is now catching the eye of some analysts as well. Nigel is here to tell us more about that. Nigel.
Well, that's right. Jefferies has initiated coverage on Hindustan Zinc with a buy rating and a target price of around 660 rupees. They've highlighted a few factors and try to summarize it in 5 top factors. On the EPS expectations, they expect the EPS to rise by around 22 to around 29% in the next 2 fiscals, that is 26 as well as 27, and 7% in FY28. Jefferies, well, they go on to state that their estimates are around 9 to 31% higher than the street. Point number 2 on valuation. Stock is not cheap, trading at around 9.2 times EV upon EBITDA, which is above the 10-year average of around 7.3. They say that this is justified, going by the rising share of silver in the EBIT. On the price assumptions, actually, they are relatively lower in comparison to the spot rates. So on zinc, they are closer to around 4% below spot, while on silver, they're 3 to around 10% below spot. Moving to the volume growth assumptions, well, they're very, very timid on that front because they expect that the metal sales to grow at just 2% CAGR over FY25 to FY28 because the expansions will come on stream only in the second quarter of FY29. They say that the refined metal capacity will go up by closer to 34%, but that's 2 years ahead, as well as silver capacity will go up by closer to 4%. Finally, on the free cash flows as well as ROE expectations, they're expecting strong free cash flows of around 8,000 to around 14,800 crores per year over the next few years, while they're expecting ROEs to be in the vicinity of around 69 to around 85%. Put all this together, Jefferies initiating coverage on Hindustan Zinc and positive on the stock.
Take that point, Nigel. Thanks a lot for that. Meanwhile, we have Matrimony at the bottom of your screen. The board approves a buyback of up to 8.9 lakh shares, which amounts to about 58.5 crore rupees at 655 rupees a piece. And the stock's seen a bit of a spike, up around 2.2%. Remember, when the news of the board meet was announced, we did see a big spike on the stock as well. Take a short break, get you more on the markets and a lot of stock-specific action on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
$75 points lower on the index. The matrimony stock has given up all of its gains and has now slipped into the red after the buyback announcement that was made at 655 rupees. This perhaps is the lowest buyback price that the company has announced after the previous three buybacks. So two of them were in excess of 1,000 rupees. The last one was around 825. So this one being the lowest among the four buybacks that the company has announced. There's a fourth one, of course, that the company has announced. But good time to get in Manglam, who's jumped across to the F&O desk to get us the latest trends from there. Manglam.
Well, just the way I jumped across to the F&O desk, the market's jumped from lows as well. So you have the Nifty Bank, and the mid-cap index. Now, sitting with mild cuts, nothing really to worry about. Why do I say that? Because, today's low on the Nifty, 25,904. We've seen a recovery of almost 70 points from those levels. And at the same time, the range has been fairly well defined. Earlier, it was a slightly broader range, the 50-day moving average at the lower level to about 100, the 20-day moving average at the higher level. Now, you have today's low, which is an important reference point. So, 25,900 is an important support. So supports come higher by about 100, 150 points, while the resistance still, or the supply, is still around that 26,000 to 26,050 mark. What's supporting the index right now? The weakness on the rupee is actually, a benefit for the IT space, and the IT index is higher, and that's the reason why there is downside protection on the frontline index. The broader market too has seen recovery for the advances. So, the crisscross lines come up for you. They're split right down in the middle, even as the market's lower, with the advances actually slightly outnumbering the declines. And there has been no major spike in the India VIX as well. So the India VIX currently comes up for you holding around that level of 10.5, closer to 10. So all of this is a positive from a bull standpoint. The only thing that we're watching out for, whether the market sustains above this 26,060, 26,070 mark. Why do I say that? Because there are still call writers who are active at that level. So 26,000 call comes up for you, premium of 53 rupees, selling you around 2650 to 2660. It's if the Nifty crosses that is when these call writers will start feeling the heat. Put writers fairly active at the 25,900 mark as well, pointing out that today's low and a 50 point below that is an important support area for the frontline index. A lot of individual stocks on our radar. So NBCC has seen a fair amount of long build up today, and it saw some order wins on Friday as well. In KEI Industries and Siemens, both these stocks are seeing some shots being covered. Remember, Siemens was among the losers on Friday after management guidance that came in, but those shots are now getting undone, and as a result of which the stock is higher by about 1%.
All right, good time to bring in Somil Mehta. He's from Mirae Asset Sharekhan, joining us for a quick technical check of the market. Somil, what's your call at 11:24 now, and your top stock picks for the day?
Good morning to everyone. View remains positive. It's been a little disappointing today's move with the opening and a little, a correction. But I think the trend still remains positive as we are trading above the 40 daily moving average and weekly monthly charts showing high top, high bottom formation. Now, the correction which we have seen in the last couple of weeks has completed in a ABC corrective and taken support at 40 and 50 daily moving average. And that's a very good sign. And we have seen a very good recovery in the last two trading sessions last week. So the trend remains positive in the short term, medium term, both. Crucial level to watch out would be 25,830 and 25,800. So these are the two levels to watch out for on the downside. My target still remains 26,300 and 26,700 in the short to medium term outlook. So buy on decline should be the strategy. For Bank Nifty, very specifically, a small pennant pattern has been forming, a small consolidation is happening, and I'll be expecting this to break on the upside. Crucial support around 58,530. And the trend remains positive. Buy on decline should be the strategy. My targets would be around 60,500, 600 levels in the short to medium term outlook. So remain positive, and buy on decline should be the strategy for both. My two stocks would be IOC, showing good strength today. Ending diagonal pattern has broken on the upside. So the stop loss would be 162 and target would be 175. And the other one is TCS, has been a little, on the corrective side, but I think this is the right time to get into the stock for the target of around 3,400 and stop loss would be 3,140.
Somil, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. Indian Oil and TCS among those recommendations there. Indian Oil at the highest point of the day, now close to 2% higher. The oil marketing company is receiving yet another positive note from vendors today on valuation comfort. So yet another analyst citing valuation comfort for these oil marketing companies behind its bullish stance. Take a short break. Up next to continue our conversations with the markets, Dheeraj Sachdev of Roha Ventures joins in on the other side.
Fly Emirates, fly better.
Valorization and India Bonds presents Bond Street.
Welcome back. Let's focus on the bond space as we're speaking about the rupee being at record low. Is there an impact in the bonds market or no? And what can one do? Manisha Gupta joins in from the latest in the Niti Aayog report. Right, we'll try and repatch that connection with Manisha. In the meanwhile, just keep an eye out on a couple of these stocks which are spiking right now. An unusual beneficiary of maybe a weaker rupee could be some of these chemical exporters as well. So Aarti Industries for one is up 7% right now as we speak. Deepak Nitrite is the other one which has seen a recovery from the lows. Also see some traction on a couple of these banks. IDFC First Bank currently has moved higher. We're seeing Bandhan Bank move higher too. And as we move towards the winter part of the year, Varun Beverages, understandably, where this quarter is not particularly good for them for the India business, but does well for the South Africa business, has seen a bit of a spike. But I do believe we have Manisha back with us. Manisha, over to you. All right. So, okay, what we'll do is we'll discuss markets with Dheeraj Sachdev of Roha Ventures, who joins in to discuss the market fundamentals, more importantly, his top sectoral picks as well. Dheeraj, the street believes that consumption is likely to recover given the sort of steps that the government has taken, etc. I just wanted to know how much of that is in the price already. And secondly, with the rupee weakening, do you see that as a risk, a further risk of FII outflow over and above what we've seen already?
Yeah, hi, good morning. So specifically on the consumption side, I think we are seeing a host of segments within the consumption basket, and not all of them are equally valued. I mean, there are certain segments of the consumption basket which are overvalued while some offer opportunities. I mean, we are positive structurally because even the underpenetration or better credit or improving credit cycle, lower interest rates or better monsoons, and of course the policy initiatives like tax or interest rates or GST cuts. Now, there is a clear shift from unorganized to organized players across many segments of the consumption basket, which includes digital media or jewelry segment or value fashion segment, or even organized retail players within the alcohol beverages, etc. So in consumption basket, we are avoiding durables that are expensive on valuations and an FMCG segment which are facing D2C competition, particularly of late because of the online channels and has slower growth rates. So this is where the space is divided in the consumption basket. On the FII flow, I think we don't believe that the FII outflows, which has been over the last few months, is going to be the case going forward. In case rupee has already depreciated about 4-5%, it's quite possible that FIIs would like to come in maybe early part of next year or the whole of next year, and not only gain on the currency front, but also on the equity, given the valuations in some cases has corrected over the last few months. So we don't believe that FII outflows will have pressure because of the rupee.
Dheeraj, I was just reading your note where one of your points mentioned that there are some contra opportunities that are emerging in some of the good quality companies which are currently lacking growth. Or a temporary cycle at that. Does EMS fall into that, or do you still believe that even after the kind of correction that these companies have seen, they still fall on the expensive side?
No. Certainly EMS is not a contra opportunity. EMS is a well-discovered thing over the last couple of years, and the valuations have gone ahead of time. And the earnings are yet to catch up, and they're still expensive. So I think one has to take a longer term call on this business. While it is very structural, India's manufacturing cycle has started, and EMS companies will gain over the longer period of time. But valuations are so demanding, and I don't think it offers margin of safety. What we said on the contra opportunities is that there are quality players where they are passing through temporary growth issues. And because of that, the market has hammered them quarter after quarter over the last few or maybe last couple of quarters. And this may include some companies in the specialty chemical segment or a fewer manufacturing or capital goods companies where capex is done and the earnings growth will play out over the next 2 or 3 years. And that is where the contra opportunities we are talking about.
Good morning. Hi, this is Ritu. You're also a core overweight for you is also banks and NBFCs. There, of course, with the spate of rate cuts, a bit of margin pressure in the near term, but the larger, environment of regulatory easing we've been seeing from RBI, where do you see sustainable growth opportunities without a compromise on asset quality? And, the second sector is auto and the CV cycle, where you believe the up cycle is just about starting. Just give us your broad view on why you think the sector has legs and, some of the interesting names that excite you.
Yeah, so good morning, Ritu. See, I think India is clearly we all know that it's a capital-starved economy, and banking and financial services industries have become growth businesses. In a capital-starved economy, there are a lot of companies in the NBFC or banks who are offering specialized financing. So whether it is home financing or commercial vehicle financing or gold financing or even SME financing. And that is going to see a sustained credit growth over a period of time. So they are growth businesses as a sector as such. Only thing is that we have to be obviously cognizant there are a number of NBFC players and there are a number of banks. And those in the mortgage lending business ideally should be preferred, or those who have better strict risk control norms in place. So we have a plethora of opportunities for banks and NBFCs. And in this market, which has been slightly on the higher side in terms of valuations, banks and NBFCs do offer opportunities. In auto, what we are seeing is, again, there are a number of players and it's again a heterogeneous sector, but we are beginning to see a CV cycle on the uptrend. And this upcycle will help a lot of ancillaries which are exposed to CVs, whether it is tires or forging companies or axle companies, including the OEM companies themselves in the CV space. And also there could be better replacement demand that can come from new emission norms in CV. Besides the EV transition that is happening even within the MHCV, LCV spaces. So I think auto ancillary and auto.
All right, we take that point. Unfortunately, lost that feed. But just, before we go across to Manisha, pull up Wakefit Innovations. The stock listed with a slight discount, thereafter fell all the way down to about 10% decline from its issue price of 195 rupees. And now as we speak, the intraday chart of Wakefit Innovation comes up for you. It's seen a massive recovery from the lows, closing in on that 200 rupee mark. Remember, the management joined us today and they do believe that this 20% sort of revenue CAGR will continue for them. And they have a headroom of almost 500 to 700 basis points when it comes to margins as well. So near 20% margins by FY28, not out of whack is what the management said to us when we posed them this specific question. As you can see, opened flattish. Thereafter, there was a decline. That decline has been bought into. The stock now up 2%. But with that, let's go across to Manisha Gupta, who is with us on all things bonds. Manisha.
Well, thank you so much for that, Mangalam. When it comes to Indian rupee, well, yes, we've seen all-time lows onto that one continuing. When it comes to bonds, the awareness, the interest seems to be really gaining, as we've seen in 2025 as well. Very strong volumes coming in. Interestingly, the Niti Aayog also has released a report about deepening the corporate bond market in India. It has outlined a roadmap for the short term and a longer term as well. Well, the current market, when it comes to bond market, is 16% of GDP, and there are a lot of points put forth on how it can be increased by 2030 and 2047 as well, aligning into that Viksit Bharat. So some key challenges that the report puts out. One is about shallow secondary market. We have seen low liquidity and, price transparency is something that needs to be worked upon. Second is about the concentration of investors, because there is over-reliance on banks and limited participation coming in from MSMEs, retail and FPIs, and that needs to be increased. Third is about the regulatory hurdles as well, where overlapping rules and complex disclosures, also about procedural delays, is something that the report talks about tackling. Investor constraints as well, because investor norms are limiting institutional exposures in lower rated bonds. And then it also is about weak recovery, inefficient debt and recovery mechanisms, which the report says should be worked upon. So what are the proposed reforms in that sense? One is about strengthening the market, ensuring that infrastructure is developed in sense of single databases. There is better settlement systems and digital tools also are active in sense of market making. The second thing that the report suggests is broadening the investor base, introducing more benefit and incentives for first-time investors here. And then, of course, it is about enhancing the regulatory framework, creating unified market authorities, and simplifying the issuance processes. Couple of more things that the report suggests is, one,
innovation of instruments so that it caters to different investors' needs. And when it comes to bond markets, it also is about strengthening the legal framework, improving debt recovery, and also bankruptcy resolution. So a very, very interesting report, very opportune time as well. 2025 has seen very strong numbers, with markets anticipating that by 2026 end, you could be looking at the recent numbers perhaps doubling up.
All right, Manisha, on that note, thanks very much for joining in. We have to take a short break, but don't go anywhere, because when we return, there is a special discussion we had at the Motilal Oswal Wealth Creation Study that we'll bring you on the other side.
CNBC-TV18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the onboard lounge.
Welcome back. On to a special snippet from the Motilal Oswal Wealth Creation Study. Market veterans Ramdev Agrawal and Ramesh Damani spoke to CNBC-TV18's Prashant Nair about their wealth creation formulas and the importance of picking leaders to maximize the power of compounding. Listen to what they had to say.
Which of the, you say ROEs, tailwinds, leadership, and many more,
yeah,
as you stand with your experience and, I mean, you know,
Yeah, so-
everything you've done, what factor ranks the highest?
Yeah, so the leadership, because to finish first you have to finish. So if you want to do the journey of 4 to 16 and in 42 you want to be surviving, you make sure that businesses will be there. But businesses, the last to die, if at all it is failure, will be the leader. And the maximum people make, in fact, what happens is the leader company in this kind of situation, they're always expensive. They will always look expensive. If you think there is going to be boom in cement, don't apply your head. Go and buy Ultratech. Because they have multiple ways of making money. Like in banking, particularly lending, it's very risky. Everybody knew that HDFC is a great bank. By 2002-03, it was very clear. But a lot of people, they went to buy the sidees, all sidees. Somebody bought this, somebody bought that. And there is only one compounder out of the entire private sector opportunity, that is HDFC Bank. So you have to buy the leader, and I have seen time again. It is the leaders who make tons of money or maximum money out of that particular tailwind of a sector. So if you have a stock market tailwind like financials, so this time asset managements will boom. Now don't go and buy number 10th or number 12th asset manager. Go and buy the bluest and the biggest and the best managed. Those guys will do, downside, they may not be the fastest, but they will be there. They will make tons of money.
So out of all the factors, leadership in their respective industries is, you'd rate that the highest.
Yeah, once you have identified that this business is potential, the business itself has 15, 20%, 25% ROE kind of a potential, and there is a growth potential, then the company to buy or the management to buy is the leadership.
Don't buy the next HDFC Bank, buy HDFC Bank. That was
the next HDFC Bank is HDFC only.
Mr. Damani, how much weight do you put, sir, on sectoral tailwinds, high ROEs, some of the things that Ramdev said, when you are looking at opportunities?
Yeah, Prashant, Ramdev had this formula QGLP. The one I focus on quite extensively first is P. I'm very concerned the price discounts everything. So more than leadership, more than ROE, more than P, I'm looking at the price I'm paying for it. Sometimes even if I make a mistake, the price is the cigar butt example. You can still make money out of it out there. And generally I find that if you buy when a bull market is starting, an extremely underloved sector, which means the price is very, very cheap, you will end up making a lot of money at the end of the bull market out there. So almost obsessed. If you ask me about a company or pitch a company to me, almost my first few questions will be what is the market cap of the company? Because that gives me a good starting point. Is it 500 crores, is it 5,000 crores, 50,000 crores, And can I value or see the business at that market cap? So for me, it's P.
And P and, of course, the market cap relative to the size of the opportunity. How much?
As I see it, as I see it. If they're in a commodity business, I know the market cap should be this, consumer business should be this. But the market cap is an amazing filtering exercise, Some business I will not look at no matter what, because the market cap is too big for me at this point, for me to understand.
All right, we have to take a short break, but as we do that, the markets are seeing a bit of a recovery from the day's low. We'll get you more on the market action when we return in just a bit.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're watching us here on Trading Hour, and as we speak, we managed to somehow take the Nifty bank back into the green, led by SBI and a couple of these other private sector banks as well. There's been a good recovery for the Nifty, which has conquered that 26,000 mark as well. So both on my head as well as Horma's head, we have the markets which are recovering. Wonder whether that's on Ritu's head as well or not. But from what Horma's, me and Ritu, what we'll do is we'll wrap up on this edition of Trading Hour. Thank you so much. We raise our hands and hope that the market continues to stay afloat from the lows that we've seen from today's morning. Ritu, we're waiting for you to raise your hand. There you have it. All right. Thank you so much for watching. Take a short break. Come back. On the other side is Halftime Report.
Stocks get off to a soft start but are off the day's low even as several global uncertainties linger. Autos and healthcare drag while consumer durables and IT eke out some gains.
Indigo says it flew its 2050 flights to all its 138 destinations, barring 2 due to technical issues on December 12th. The airline adds that its on-time performance has normalized per its standards. The stock sees some gain.
Rupee is down to a fresh low of 90.73 per dollar, down 0.35% from its Friday close. The fall is triggered by continued selling of equities and bonds by foreign investors, dealers say. India's November trade data due today, and dealers fear that if the deficit is as large as October's $41 billion, then rupee may fall further.
The Cabinet has cleared the Insurance Amendment Bill that will now be introduced in Parliament, but CNBC-TV18 learns key clauses of composite licenses and open architecture may have been skipped to allow greater deliberation. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Bhutra. Well, it is turning out to be a session where we are seeing some amount of recovery from the day's low for the market, but nonetheless, it seems to still be a little tentative at this point in time. So we have the Nifty, which is just about lower by around 34 odd points. We have the Bank Nifty, which is just about recovered into the green as well. But what really stands out is the rupee weakness, which continues. So it's another record low that the rupee has hit in today's trading session. So that seems to be a bit disconcerting at this point in time. The advance decline ratio, a little bit on the positive side. So let's see how that sustains. As of now, around 2,100 stocks advancing to around 2,000 stocks declining. We do have the WPI data for the month of November, which is flashing on your screen. It is a deflation which has taken place, but it is much lesser in terms of the extent of deflation as compared to what we saw in the month of October, which was around 1.2%. We'll get Aditi Nair talking about that, but before that, Sonal, hi.
Hey, a lot of cues that we are tracking falling. Rupee, it is the WPI data that we are tracking as well. What's happening in the markets, of course, we'll discuss that in greater detail. The recovery is something we'll be tracking very closely because the Nifty is above the 26,000 mark. Let's get in Aditi Nair, who's the chief economist at ICRA, to talk about the WPI data that just came by. It's a deflation again, but of course, it's lower than what we saw in the month gone by. Aditi, is it in line with what you were expecting? And where do you think, what would the breakup look like for this one? What is the analysis suggesting?
Thank you so much. So basically, we were expecting a deflation of around 0.6% or so. So this is a little bit narrower than that. And I suspect that we may be very close to a break even by next month and then going into a small YY inflation in Q4. Broadly, if we look at the Qs, we've had the rupee depreciation being one of the factors that the landed prices of commodities would be on the higher side. And even, the commodity prices themselves have gone up in some cases. Crude, of course, has eased over the last couple of months, but other industrial commodities have seen a slight hardening. So I think these are some of the cues. And then, of course, food inflation is a smaller component of the WPI than it is of the CPI, but we have seen some hardening in vegetable prices as well. And that is something that we would track for the month of December.
Okay. Aditi, what is your sense in terms of how the RBI is going to read these inflation numbers as well, considering that it is in the context of a depreciating rupee?
So, a couple of different things, Ekta. First, of course, this is not the last print before the next RBI policy review. We will get one more set of data for December in January, both for the CPI and the WPI. So I think the trend continuing between October and December, that is something that the RBI will be watchful of. And in terms of the rupee, when the rupee weakens, it has a quicker and a larger transmission to the WPI than it typically does to the CPI. So I think that's something that the RBI and the MPC would keep in mind as well. The CPI has a much larger weight of food. and also of services. And both these tend to be more domestically determined and have much less of a component of transmission of the rupee weakness that comes in. So I think, this context needs to be kept in mind as we look at what the MPC may do in the February policy as well. And of course, just to add, there is also some element of base effects which is at play over here. And as the base effects normalize, we do expect both the CPI and the WPI to be inching upwards.
Okay, so over the next 3 to 6 months, you expect WPI to inch higher. What are some of the risks you are factoring in when you're coming to that number?
So as I said, we would expect now the WPI to be close to a break-even for the month of December, and then go into the positive territory in Q1. Earlier, we were looking at an sort of average WPI inflation of around 1% in Q4. And now, depending on how the rupee evolves, the trajectory that we see over the next few weeks, we will take a call on how the impact on the WPI would be. So that is broadly what we're looking at right now. Break even by next month, average of 1%, but a trend upward basically in Q4. And an average for FY26, which would be around 0.2% or so. Main things to look out for would be the commodity price movement, metals and crude oil, the rupee depreciation, and the impact of whether we have an sustenance of the uptrend in vegetable prices or the seasonal downtrend that we normally see in the winter months. Does that kick in soon as far as the food inflation is concerned?
Okay, we also have the trade deficit data, which is due today for the month of November. Aditi, what is your expectation considering that October was quite a fearful number?
Look, I'm hoping that we're going to get a much better number, somewhere around $30 billion. Couple of reasons for that. October was an aberration for two reasons. One, we had the gold imports, which really surged during the festive season. So I'm really hoping that that is going to sort of normalize after October. The second, we had the festive season holidays in October. And what happens is that in the festive season, the import demand tends to be high, but the export shipments tend to be on the lower side because factories are actually shut for the holidays. So it does tend to be, whichever month Diwali falls in, tends to be like one of the worst months in the entire year for the trade deficit. And especially when we get this kind of a blowout on gold imports, I think, it was inevitable that we were going to get a number that was so bad. So I'm really hoping that November we will have the reverse coming in. Gold imports will normalize, other imports will also normalize. And with the base effect of a higher number of working days for factories, exports will look a lot better than they did in the month of October. So I'm hoping that the trade deficit will print in the vicinity of $30 billion for this month.
Sure. Okay. All right, Aditi, we're going to leave it on that note. Thanks very much for joining in and taking us through that. So, Sonal, that's going to be something that the street will be watching because it was a $41 billion record deficit that we had hit in the month of October. And we had the gold imports, which had surged nearly 200%. So let's see whether or not, that comes through in terms of a decline.
Okay, all right. So we'll watch out for that big number. But for now, we'll slip into a short break. When we come back, we'll connect with the big listing of the day, management of Corona remedies on the other side.
Fly Emirates, fly better.
Welcome back. Well, let's talk about one particular company which has seen a strong listing. Branded pharma formulation major Corona Remedies has listed at an over 35 or maybe even 38% premium at this point in time. Do note that their women's health segment is a key focus. It's around 28.8% of sales. To discuss this and more on their second half outlook, we have with us Nirav Mehta, who's the promoter, MD and CEO at Corona Remedies, joining in. Mr. Mehta, thank you very much for taking the time out, and congratulations. It's been a good listing for the company. But let's get talking on the numbers now, considering that you closed FY25 with an 18% growth and margins of around 20 to 21%. Just give us a sense in terms of what FY26 is going to look like on a closing basis for the company, both in terms of revenue growth as well as margins.
So first of all, thank you so much for inviting me over here. Let me first welcome the new shareholders in the family of Corona Remedies Limited. And we at Corona Remedies, since last few years, we have been growing in terms of revenue and the profitability in both the ways with our four, core therapies: women's healthcare, cardiometabolic, urology, and pain management will continue to do so. We are in line with our performance in terms of revenue and growth.
Okay, so you'll continue this growth rate going forward as well, what you've seen in earlier years. Mr. Mehta, then let's split it up. Your domestic growth has come in at 16.7% CAGR versus an industry growth that we've seen at 9.2%. Will this growth rate continue for the domestic business as well? Which are the segments which are leading to growth, and what is the outlook for this particular segment?
Yeah, so if you look at this women's healthcare, cardiometabolic, urology and pain management, this sector are already been growing little better than the pharma industry, IPM. It's been little better than the IPM. And we are in that sector. We have been growing mostly been double than the IPM, because our basis today has been low. We have about 1.9% market share, in this industry, and long way to go. So we are, very, very optimistic and positive to grow with these therapies, and we will add new therapies also in this kitty.
Okay. Well, we do understand that, but we're trying to get down to, maybe some numbers, Mr. Mehta. Are you expecting to sustain this kind of outperformance in the domestic market? Are you expecting to sustain your margins at 20 to 21%, or do you expect further improvement? Give us a range in terms of what you're looking at and guiding for.
So, as far as our core therapies or core strategy is concerned, our aim is to grow a little better than the IPM. IPM is growing by, 8%. Our growth, aspiration is to grow by 1.5 to 2%, 2 times than the IPM. And as far as profitability is concerned, we have tried to, as revenue growth has been coming, somehow we have been getting the profit advantages, and that's been also continuing the same line as per the past year's performance.
Okay, so the target is to grow 2 times the industrial growth that these segments are witnessing, and generally
1.5 to 2 times.
1.5 to 2 times. That's the target that you have. You also said that you'll be adding some new therapies to the kitty as well. Will it be organically done, or will you be looking at some more acquisitions to add that to your portfolio?
Today it has been organic, so we are working with few other therapies like infertility, spine, rheumato, neuropsychiatry, dermatology, etc. We will try to unlock each therapies at the right time. To starting with, we are unlocking with the infertility in an organic manner. So, if you look at overall, we will grow about 1.5 times in the revenue, and similarly about 18-20% on the part of the PAT. EPS percentage growth will be in the line of 18 to 20%. That's our goal is.
Okay. Well, Mr. Mehta, I wanted to ask you, you have your cardio-diabetic segment as well, which is one of your key segments in the company. How exactly are you looking at, this entire weight loss market, considering that we do have semaglutide, which is going to go off patent, and many companies are also tying up exclusively with the likes of Novo Nordisk as well as Eli Lilly in order to launch a second version of the existing drug. Any of these opportunities that you're looking to capitalize on?
Yeah, so we have been absolutely excited with this new, GLP-1 market. It is going to be big as far as India is concerned and as far as world is concerned. There is a molecule called semaglutide, which has been coming in the off patent in the end of March 26. And we are working for this molecule to launch since last 2 years. Our R&D team is working hard, and we are, optimistic to launch on the off patent date as far as semaglutide is concerned with our mass division and class division. So we are very optimistic on semaglutide.
Okay, but are you not expecting a significant amount of competition on day one itself, and then that would just then be a volume game?
No, you're right, absolutely. But, if you look at the Indian pharma market, on our patent date, there are about 100 plus players have been launching the brands. And it's been quite normal. But as far as semaglutide is concerned, there are about 8-10 people will launch on a day one. So I think so there is a less competition as compared to the other off-patented molecule. And it is going to be a huge market as far as India is concerned, about 140 crore people. And, many obese and comorbid conditions. I think so this molecule has a wonderful role to play.
Okay.
So we are very optimistic.
The entire industry has been talking about it, so it'll be key to track how this market performs and what is the pricing game. And as Ekta pointed out, it could be a volume game as well. So we'll keep tracking those details. Mr. Mehta, thank you so much for joining in today with the insights on the business going forward and the other therapies as well. By the way, for the markets, there's been a further recovery. The Bank Nifty has surged from the lows, and the Nifty too is above that 26,000 mark. So we'll keep tracking that for you, because it's just a little bit away from those green levels as well. We'll slip into a short break now. When we come back, we'll connect with Dheeraj Nim, who's the economist and FX strategist at ANZ Research, as rupee is down to another fresh low today.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. Well, the other big story that we are tracking is rupee going down to a fresh low of 90.73 per dollar. It's down around 0.35% from its Friday's close. To discuss more on the trajectory going ahead, we are now joined by Dheeraj Nim, economist and FX strategist at ANZ Research. Dheeraj, good afternoon. Thank you so much for joining in. Is there any fresh trigger that we are seeing a further fall in the rupee? And also on the trade data that we'll be getting today, are dealers a little nervous ahead of that? If you can list out some of the reasons why we're seeing this continuous fall.
Well, thank you for having me on the show. Look, I think it's more of the same story. We have seen this trend of weakening in the rupee since there has been not much clarity on when the US trade deal would happen, which means that expectations with respect to the movements in the exchange rate have become rather one-sided. Now, what happens in such cases is that importers' hedging demand increases because everybody in the market is, so to speak, expecting the rupee to weaken, while at the same time, exporters remain at bay because they hope they will be able to realize a better price for their dollars later. So I think in such a situation, especially also when you have portfolio outflows continuing, we think that it is natural for the rupee to adjust. And the other contributory factor, of course, is that the Reserve Bank of India is not trying to give any particular direction to the USD INR exchange rate. In fact, they have been true to their word. They're just smoothing out the volatility. Now, coming to your second question about the trade deficit data, look, I think the trade deficit from a structural perspective has expanded. I mean, we expect it would be in the range of $30 to $35 billion. Of course, not as high as it was in the previous month, about $41.7 billion odd. There will be some correction to it for the underlying factors as festive demand would have lapsed and gold imports would have normalized a bit. But I don't think that particularly is triggering, the move in the rupee to a fresh record low. I think it's a part of the broader adjustment that we should see continue even in the months coming ahead till there is clarity on the US trade deal.
So Dheeraj, in your sense, what is the level that you are looking at for the rupee in the near term where it could probably settle? And maybe a near-term range as well?
Right. So I think Q1 generally in any calendar year tends to be better for the rupee from a seasonality perspective. So we've pegged rupee at 90 for Q1 2026. Of course, the risk is that USD INR could be higher than 90, given the current momentum and the current levels. But we do expect some appreciation is likely because of seasonality effects. But by the end of next fiscal year, we had pegged the rupee at 91.5. I'm aware that, those levels could be realized much sooner than we currently project. But I think the rupee weakness has further to go is the broader theme from a medium-term point of view.
Okay, 91.5 in the near term. But Dheeraj, do you think there could be some level at which RBI steps in, they become uncomfortable? Or do you think flexibility is going to be the policy going ahead as well?
Look, at least in the near term, I think flexibility is the way forward. When most of the factors that guide the balance of payments and the currency, therefore, seem to be geared against the rupee, so to speak, I don't think the Reserve Bank of India should try to fight the tide. I mean, of course, the dollar has weakened somewhat since, the last couple of weeks. That gives some elbow room for the RBI to contain the slide of the rupee. But at the same time, we think that the recent intervention pattern of the RBI being a little hands-off than it had been before suggests that they are perhaps open to a weaker rupee. Look, I must highlight that, at this point, the rupee's levels do have welfare consequences. I mean, you're looking at very, very elevated tariffs impacting exports of some very employment-intensive low-tech sectors. So, I mean, a weaker rupee would at least support the earnings for those exporters. Still, we know what tariffs would be after a trade deal happens. So I think that's important right now.
Okay, absolutely. That point is taken. Well, Dheeraj, we also have, the trade deficit data, which is due today. And that might be very critical in terms of assessing how exactly the trajectory of the rupee would be. If it's above $30 billion, the fear is that there could be further currency weakness. Are you looking at that data and what the impact could be in terms of the currency?
Yes, so two data points within the broader foreign trade data are worth noting. The first is, of course, the headline trade deficit. We expect it would be about $33 billion. Of course, in the last few months, the forecast errors have been large because of unexpected outcomes. But $30 to $35 billion, if you compare to India's trade deficit historically, is still very wide. So I think that by itself is a bit of a concerning aspect of the trade data. But within the export data, we would be watching out for what's happening to exports to the US. Now, within the last couple of months, I mean, the September and October data that we had seen an export recession of shipments to the US. Our fear is that that could deepen because in the first 2 months when the 50% tariffs kicked in, exporters were still trying to retain market share, say by giving discounts or say by rerouting shipments somewhat, or some of those factors, which could have helped in the immediate term, but it would be difficult to sustain those measures over the longer term. So our fear is that, if the elevated tariffs stay in the picture, then the export recession, which is the shipments to the US I'm speaking about, could actually deepen. And if that is the case, the fear of the market with respect to tariffs affecting both cyclical and structural growth in India could very well, acquire a more definite shape, if not anything else. And I think that could itself be also a pressure point for the rupee.
Okay, Dheeraj, thank you so much for joining us today with your insights and the outlook on rupee. It was a pleasure speaking with you. So that's the word coming in from ANZ Research. They could see levels of 91.5 on the rupee in the next year. But with that, we'll do one thing. We'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, for the markets, yes, there is a recovery which has taken place from the day's low, but one stock which stands out is Shakti Pumps. That stock is up another 11%. Remember that it's been in focus because of order wins that it has been receiving. It did receive an order just last week, which was worth over 400 odd crores. And then on Friday, it topped it up with a total value of around 2,000 pumps at around 71.25 crores, which is supposed to be executed in the next 120 odd days. So it is possibly the spate of order wins which is keeping the stock so active. As you can see, in the past 7 odd days, it's gained around 30 odd %. That stock up in double digits in today's trading session as well. But let's talk about another stock. Amber Enterprises is surging trade as the management has reiterated a strong guidance. Upasana is here with more details on that. Upasana.
Well, certainly, company recently held its analyst meet and the positive commentary is what we are seeing. And the company has also indicated a sequential improvement in its consumer durable segment. Now, coming to the key points first, the management has reiterated their guidance. They are implying a strong 13 to 15% outperformance to the industry in the consumer durable segment. For FY26 overall, Amber expects 10 to 15% Y-on-Y growth in RAC segment and 35 to 40% Y-on-Y growth in electronic segment. Now, coming to consumer durables, the company has stated that the demand has improved sequentially, while there is still channel inventory in the system for RAC. Mind you, 1st Jan 2026 onwards, new energy norms kicking. So that's also an important point to keep in mind. Now, electronic division, the second most growth driver of the company. Company has said that the growth in this will outperform the other segments led by new client addition and acquisitions. Now, company has also indicated industry leading growth in its AC segment, and it also has given a strong growth outlook in the medium term for company's non-RAC segment. And most of the focus of the discussion was on the company's electronics segment. So overall, certainly a positive commentary coming in from Amber Enterprises.
Okay, all right, Upasana, thank you so much for joining us with all those details. So EMS companies, they've been in focus. Amber on our radar because of the management commentary that has come by. With that, we'll slip into another break. On the other side, Manisha Gupta will join in with Philip Newman, the MD of Metals Focus, in our commodities segment. Stay tuned for that.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report. Precious metals continue to rise this year, with gold rising to a 7-week high recently, while silver holding steady around record high levels. Philip Newman, Managing Director at Metals Focus, tells my colleague Manisha Gupta that silver could hit $70 an ounce by next year. Let's listen into a piece of that conversation.
From our point of view, we are still bullish on silver for next year, even at these levels. We think that it could approach 70 next year. I realize maybe that doesn't look so far away from where we are today at about $62. But I think the important thing from our standpoint is that, given how quickly it has risen over the past few days, I don't think it'll be a straight line rally to that high that we see for next year. As you know, it's a pretty small market. A lot of volatility can happen. So we think that you could see, in the short term at least, perhaps a correction. But I think any correction could well also be, quite short-lived as well.
Philip, how are you also looking at the buying part of it? Because now this year clearly has been about speculative buying, short squeeze even, and then industrial demand, everything played up, including the supply deficit. Is it going to be a similar story next year?
Well, I think, it's quite possible that we will see at times the market remain tight. We are looking at the dynamics, how that's playing out in London. We've seen the resumption of ETF demand that will contribute to that tightness. But as you know, the Indian market has backed off. We're in a small discount at the moment. So that isn't taking silver from London, as it has been quite recently. So on the other side, that helps to ease the tightness. I think from an industrial standpoint, that's one we're keeping a very close eye on. Something like the photovoltaic market, which, as you know, is the single largest area of industrial demand. I think at these prices, that will be encouraging panel and module manufacturers to really perhaps ramp up their efforts to thrift on the use of silver. So I think that will still be a very good figure next year in terms of demand, but I think it could ease back from where we are at present.
Philip, also when it comes to the overall price volatility, that seems to have gone higher as well. As you mentioned, that India markets have seen a bit of a discount, but India also seems to be looking at almost the same number as last year in sense of imports. So would you say a 6,000 tons perhaps is a given right now?
It's possible. I think it's just to see how the market reacts. As you know, the price today is about, I think, 193,000. But we saw, during Diwali, there was buying into 200,000. But I think, as we've now moved past that, it'll be interesting next year to see how consumers react to these prices. We know that Indian retail investors tend to be naturally quite bullish. So will they be buying into the rally? Or will there come a point where they think, silver's had an incredible run, successive highs, maybe it's time now to book profits. And I think if that happens, then that maybe will be a question mark over the imports that we've seen recently.
Let's talk about gold then, and Philip, and we've seen 4,200 kind of be a number where it's pivoting around, consolidating even for the last couple of months. What is it that you think is going to be the future trajectory for this?
Well, given what we said about silver, then part of that is, it's further strength in gold. And you're absolutely right, Manisha, in terms of the prices consolidating. We would take that as a very strong positive, that the market is very comfortable from these levels. And again, even if we see a correction, we would think that will be short-lived, that will be bought into. And so we are positive for next year. We still think that gold could eclipse 5,000 before the end of 2026. Many of the factors that have driven prices this year will carry on into 26. And so, we're looking, a more dovish Fed after, of course, their cut yesterday. Question marks about Fed independence. And all that, of course, feeds into that moves about dollar negative, gold positive as well, plus diversification arguments, and there are a few other drivers out there. So I think we still feel quite comfortable with our forecast, as I said, beginning with a 5 for 2026.
Oh, well, yes. Philip, also when it comes to gold therein, the physical buying has been strong here too. Next year, apart from all the macros that you mentioned about, what do you see in sense of physical buying, whether it is about institutional, again, retail and the central banks?
Well, I mean, if we start with the central banks, the first 9 months of this year, the total was only about 13% lower against the first 9 months of last year. And last year was, close to a record high total. So I think for the full year, we could be looking at somewhere between, say, 800 or 850 tons. That is an exceptionally strong performance. And I think for 2026, we do think that central banks will still remain on the bid. So in terms of the price support that provides, the positive sentiment, I think that's certainly something we're looking for. I think for a driver, though, in terms of the upside of that 5,000 I mentioned, then you are looking for that continued institutional stroke hedge fund play to be there in the market.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, it's turning out to be a session where we are seeing some amount of recovery from the day's low. But like we mentioned, that the rupee continues to be weak. We have the Bank Nifty, which is just about holding its head above the water, so up around 55 odd points. The advanced decline ratio is looking a little tentative right now because when we started the show, it was on the advancing side. But now, as you can see, it's sort of on a parallel footing at this point in time, possibly going to crisscross soon enough. So as you can see, there is a little bit of a trending line which is closer to each other at this point. If you're looking at specific stocks from the frontline space, we have HUL, which is topping the list. So that stock is up around 1% at this point. Asian Paints from the FMCG space is not doing too badly as well. So that stock is up higher by around 0.5%. On the downside, it is autos which are taking a little bit of a hit today. So Eicher Motors, M&M, Bajaj Auto, all of these stocks are under pressure at this point in time. Even a couple of the metal stocks which had a good run last week are seeing some amount of pressure. So JSW Steel down around 0.7%. It's a wrap on Halftime Report, but stay tuned. Business Lunch up next with all of the top stories.
Stocks are off to a soft start to the week but are off the lows of the day even as several global uncertainties linger. Auto and healthcare sectors are the big drags while consumer durables and IT managed to eke out some gains.
Indigo says it flew its 2,050 flights to all its 138 destinations, barring 2 due to technical issues on December 12th. The airline adds that its on-time performance has normalized per its standards. The stock sees some green.
The rupee is down to a fresh low of 90.77 against the US dollar, down 0.33% from its close on Friday. The fall is triggered by continued selling of equities and bonds by foreign investors. Dealers say that India's November trade data is due today and that the dealers fear that if the deficit is as large as October's $41 billion, then the rupee may fall further.
The Cabinet has cleared the insurance amendment bill that will now be introduced in Parliament, but CNBC-TV18 learns key clauses of composite licenses in open architecture may have been skipped to allow greater deliberation.
Good afternoon, Yobitas here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Hi, Hormas. Good afternoon. I mean, the markets there starting the day with a little bit of a, hangover, but managed to recover from those losses, right?
Indeed, and we're still in the red off the lows of the day, and it's been the case for the last few days, right? Hovering between that 50 DEMA and the 20 DEMA. That's been the case for the index. It's a very narrow 300-point range at which the Nifty has been trading for over the last few trading sessions. 25,700 on the downside, still struggling to sustain above that 26,000 mark. Still there as of now, but it'll be interesting to see whether these levels sustain as we go into the close. The good part is that the Dow futures as of now are trading with gains, at least 150 points higher on the Dow futures. The US indices have been on a bit of a selling spree over the last couple of days because of the lingering AI pressures. Of course, the Nasdaq futures are not as high as the Dow futures are. They are up only around 40-45 points, but they are in the green nonetheless. And of course, the broader markets, they were the big talking point all through last week. The broader markets, the mid cap and the small cap index had a far sharper rebound compared to the Nifty across Thursday and Friday. The mid cap index as of now, off the highs of the day, is still around 170 points. The small cap index though is trying to move into the green.
Absolutely. But as you pointed out, the Nifty Bank is the only one that's sort of in the green there. So some of those banking names that are leading from the front, you've got IDFC First Bank, Canara Bank, SBI, some of those names, gaining between 1% and 2%. Also, those FMCG companies, they're doing well as well. HUL, Marico, Britannia, all of them between 1% and 2% in the green. But that auto pack seeing big cuts, Bharat Forge, M&M and Eicher Motors, all of them in the red. But Hormas, the rupee is on top of mind with everybody.
Oh, the rupee continues to be the talking point, right? Of course, they could take that as a positive that it's not turning out to be as big an overhang for the market as it had been when it started first to depreciate. But it's another record low for the currency today, 90.73 compared to Friday's close of 90.41. Now, the dealers spoke about a large RBI sell position in the NDF or the non-deliverables forward or the offshore market 1 month ago, which matures today, and that is pressuring the spot price. Lata is here with more on this. Lata.
Yeah, actually, it's yet another day and yet more FPI dollar buying. But the specific reason today, what makes it different from 2 days ago, is that this 1 month ago sell position that RBI entered in the NDF market was a 1 month sell buy, and that NDF market pressures the spot market. In the spot market, the Reserve Bank has been supplying dollars, but as in the past several weeks, it is not trying to defend any level. It's just offering once in a way. So the market is kind of reconciled to further falls. The demand has come from equity FPIs, but dealers are saying increasingly we are also seeing demand from debt FPIs. Actually, year to date, we are positive on debt FPIs. It's an inflow of $8 billion. But lately, dealers are saying there is a sell because people are seeing the currency bleeding, and that's taking down their profit. So some selling is coming from that quarter as well. And then the most important number that dealers are looking at is the November trade deficit. A CNBC-TV18 poll gave us a number of about 29-30 billion trade deficit. This compares with 41 billion, which was the October trade deficit. We put it to one-offs, the economy getting used to the US tariffs and the festive season gold buying. if it were to surprise in the negative and be way over that 30 billion that the market is mentally prepared for, then there can be further reverses. Further attacks on the currency is what dealers worry. So important day to watch out.
So rupee hitting new lows there. Thank you so much for those details, Lata. But moving on, branded pharma formulation company Corona Remedies listed at a 38% premium to its issue price today. Earlier, we spoke to the management about the company's growth outlook going ahead. Take a look.
As far as our core therapies or core strategy is concerned, our aim is to grow a little better than the IPM. IPM is growing by 8%. Our growth, aspiration is to grow by 1.5 to 2%, 2 times than the IPM. And as far as profitability is concerned, we have tried to, as revenue growth has been coming, somehow we have been getting the profit advantages, and that's been also continuing the same line as per the past year's performance. If you look at overall, we will grow about 1.5 times in the revenue, and similarly about 18-20% on the part of the PAT. EPS percentage growth will be in the line of 18 to 20%. That's our goal is.
Holding on to gains of 37% is Corona Remedies, a very strong listing today. Shares of almost 1,450 crores have already been traded on its listing day. But the other listing of the day was home furnishings company Wakefit, and it saw a subdued debut. Listed at its IPO price, fell at as much as almost 9% and then has recovered from the lows. Now, we earlier spoke to Chaitanya Ramlingegowda, the promoter and the executive director of the company, who spoke about the company's growth strategy going forward. Listen in.
But when I talked about margin improvement, a lot of the juice is going to come from furniture. Like I said, because it's just a 3-year-old venture, plus we put up one of India's largest greenfield projects to manufacture furniture in Hosur. It's beyond Hosur, and that is where it's state-of-the-art, world-class, furniture manufactured by robots, completely automated, and that is where the utilization is steadily going up. And this factory has the potential to take furniture to 3x revenue from where we are currently. So that is a big fixed cost absorption coming our way, where we are sweating the fixed asset. We should be growing at a company level, we should be growing in the early 20% kind of a ballpark, which we'll have to, all the strategies that I talked about, omni-channel expansion, opening up the new category, premiumization of the overall category, all of those things will contribute to that estimated growth that we are projecting and working towards.
A whole host of stocks were buzzing in trade on the back of news. Riya Bhatia joins us now to give us a roundup of all of those stocks. Riya?
Well, yeah, starting off with PVR Inox, which has been in focus after opening 5 new screens in Hyderabad, and the company has also been in focus on the back of Dhurandar's success, which clocked roughly 351 crores in box office collections. Moving on, Indigo has also been in focus after the company issued a statement saying that they have operated roughly 2,050 flights on the 13th of December across all 138 destinations, and on-time performance has also been consistently normal as per Indigo standards. Reflex Industries has been trading higher in today's session. The company has issued a statement saying that search operations initiated by the Income Tax Department on the 9th of December have been concluded late evening on December 13th, and the company has not received any communication, notice or order from the Income Tax Department till date, and this is contrary to reports suggesting adverse outcomes, which is why the stock has been trading higher in today's session. Amber Enterprises has also been in focus. The management has reiterated their guidance at a recent analyst meeting, implying a strong 13 to 15% outperformance to industry standards in consumer durables. In FY26, the company is expecting to clock roughly 10 to 15% YOY growth in the RAC segment and 35 to 40% YOY growth in the electronic segment as well. NLC India has been in focus after receiving an LOA from the NCR Transport Corporation for setting up a 110 megawatt AC grid connected solar PV power projects in Uttar Pradesh. Ashoka Buildcon has received an order worth roughly 1,041 crores from BMC for construction work, and KEC International has also bagged orders worth roughly 1,150 crores in its T&D segment. This is the largest order for its India T&D business so far. The last stock that we're focusing on is Bandhana Sphoorti. This one has also been in focus since a board meeting is to be held on the 17th of December to consider and approve NCDs on a private placement basis. And apart from this, GPT Infra Projects has also been in focus since the JV company has been declared L1 in an order valued roughly 1,739 crores.
Riya, thank you for all of those stocks that are in focus today. GPT Infra 2 trading with gains of around 2%. Moving on, Ramesh Damani, veteran investor and member of the BSE, has argued that decline of the United States is inevitable under President Donald Trump. He also shared insights about his investment criteria. Listen in.
I think the decline and fall of the American century is upon us. I mean, this is a country I worshipped, and for 100 years it's been the beacon for free markets. I think Trump has forever changed the political dynamics of America. And even if a new president comes, it won't be easy to change back. So my feeling is that it'll be like Great Britain. It was a power to reckon with, and ultimately they spent themselves out because of world wars, weakened themselves. And today it's a power, but still not one of the great powers of the world. It's really hard for me to say that, but I think America will follow the same trajectory. Concentration versus diversification. Unlike Ramdev, who runs a very concentrated portfolio, and he actually, I think it helps to know yourself and know your companies to run that. I run a very diversified portfolio. If Ramdev tells me an idea, I'll buy some shares. I may not make it a core position, but I'll buy some shares. But my criteria for judging my performance is very simple. Have I doubled my net worth over a 3-year period? And India is giving you that kind of opportunity to double your net worth. If you've done that, you're fine. What does it matter how you run your portfolio? There are many ways to skin a cat. So as long as my wealth is moving, doubling every 3 years, I'm on the right track. I'm not very particular about, I would like to be a more concentrated portfolio, but I don't think intellectually I'm equipped to do it, because I get very scared of making a big unsurmountable loss, particularly as I'm aging.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still with us on Business Lunch. The national capital is engulfed in a thick blanket of smog, with AQI readings in 4 regions exceeding the 500 mark. GRAP-4 measures have been implemented in the city with AQI readings maxed out. Visibility has also sharply dropped in the city, resulting in severe flight cancellations. Abhimanyu Sharma gets us more.
A fog alert has been sounded in several parts of northern India due to decreased visibility, which has impacted travel plans severely, which has also exacerbated the situation which was persisting due to a deterioration in air quality. The AQI has fallen, which has led to imposition of GRAP-4 restrictions in the Delhi NCR region. Travel plans have been impacted. Speaking about cancellations of flights at the Delhi airport, 61 flights till now have been reported as cancelled, and 5 flights have been diverted so far. Now, both the airport authorities as well as airlines across northern India are working to resolve these disruptions and to minimize delays to reduce any inconvenience to passengers. Some days back, a fog alert had been issued by Air India, and they had indicated that an option had been given to passengers for a complimentary reschedule or a full refund at no penalty for weather-related delays. Indigo has issued a statement and has indicated that some flights may experience delays and few may be proactively cancelled to prioritize safety and minimize waiting at airports. Now, it's a dynamic situation. It remains to be seen how it's going to pan out in the next few hours, in the next few days, even as action is underway, not just from the ministry's side, but also airlines and airport authorities are working to minimize delays.
Abhimanyu, thank you for that update there, and some flashes on your screen from SBI. The Appointments Committee of the Cabinet has approved the appointment of Rajiv Ranjan as the Managing Director at SBI. He is currently Deputy Managing Director. Take a short break. More news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Now, in some somber news, Australia is mourning after its worst gun violence in nearly 30 years as a deadly shootout at a Jewish celebration in Sydney's Bondi Beach has left 16 people dead. Police say that the two alleged gunmen were a father and son duo. The 50-year-old father was killed at the scene while his 24-year-old son remains in critical condition. Officials have described the attack as a targeted anti-Semitic assault. Around 40 people remain hospitalized, including 2 police officials.
Ukraine's President Volodymyr Zelensky has proposed abandoning NATO ambitions in exchange for Western security guarantees during peace talks in Berlin on Sunday. The move marks a major shift as Kiev seeks to end the war with Russia without ceding territory. Take a look at this report.
Ukrainian President Volodymyr Zelensky has offered to drop his country's bid to join the NATO military alliance in exchange for Western security guarantees. The proposal came ahead of 5 hours of peace talks with U.S. diplomats in Berlin on Sunday. It marks a major shift for Ukraine, which has fought to join NATO as a safeguard against future Russian attacks, and even has the aspiration in its constitution. The shift also meets one of Russia's war aims, although Kiev continues to hold firm against ceding territory to Moscow. U.S. envoy Steve Witkoff said a lot of progress was made in Berlin, though full details were not divulged. Ukraine said Zelensky would comment on the talks on Monday once they were completed, with officials considering the draft documents. A Reuters source said German Chancellor Friedrich Merz made brief remarks before leaving the two sides to negotiate. Other European leaders are also due in Germany for talks on Monday. Russian President Vladimir Putin has repeatedly demanded that Ukraine drop its NATO bid, pull troops from the remaining parts of the Donbas region that it still controls, and remain neutral with no NATO forces on its soil. Moscow sources said earlier this year that Putin also wants a written pledge from Western powers to halt NATO's eastward expansion, ruling out membership for Ukraine and other former Soviet states.
The Nifty is almost on the verge of turning positive now. 26,034, so back above the 20-day moving average, just a smidge. They briefly moved into the green, but still now looking to cross that flat line and move higher. Some trade data on your screen as well. Merchandise trade deficit has declined, and the overall trade figures should also be on your screen. So that has declined from 31.9 billion to 24.5 billion. The trade deficit has now declined 23.2% to 24.5 billion from 31.9 billion on the same period last year. So trade data figures coming in. We'll get you more details as the day goes by. But we take your leave on this edition of Business Lunch. Arundhati and I say thank you for watching. Midcap Radar on the other side.
afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ekta Batra. Hey Ekta, good afternoon. Well, we have recovered quite a bit from the lows, almost a 120-point recovery, though the mid-caps continue to be under pressure. But the advance decline ratio, that's in favor of advances, but it continues to be the tracking point because the market breadth was not doing so well last week, but has made a comeback now.
Hi Sonal, yes absolutely. So let's see where it goes from here on, because the Nifty is also just about lower by around 20 odd points. So maybe there could be some amount of buying at lower levels which could get us back into the green, but let's see whether that sustains. The Bank Nifty also holding up with a gain of around 85 odd points at this point. These are top stories. Stocks get off to a soft start but are off the day's low, even as several global uncertainties linger. Auto and healthcare drag, while consumer durables and IT eke out some gains.
Shares of Amber Enterprises rise in trades as the management reiterates its guidance, implying a 13 to 15% uptick in their analyst meet.
Reflex Industries surges in trade as the company clarifies the search operations by the IT department. Company says it has not received any communication notice or orders from tax authorities.
Shares of Federal Bank rise in trade as UBS maintains a buy call on the stock, but they've raised the target price to 310 rupees a share. The brokerage expects improvement in operating trends that is likely to accelerate in the medium term.
And Shakti Pumps continues to rally in trade. The stock is up nearly 30% in the last 3 sessions on a slew of order wins.
Okay, all right. Those are the top headlines that we are tracking. We'll discuss some of them in greater detail through the course of the show. For now, as you pointed out, the mid-cap side of things under a bit of pressure. But if we talk about the sectoral movers, we do have some gains coming in from the IT pack, FMCG, PSU banking index, and the small caps also in the green right now, outperforming the moves in the mid-caps. The auto pharma index is under some pressure. But, you know, a larger part of these moves are coming in from individual names as well. And, of course, we'll talk about them. But yes, largely it continues to be consolidating at these levels after that recovery that we saw from the lows.
Yes, absolutely. And in fact, let's get going on our first segment of the day. In our segment Mid-Cap Movers, we have Hormuz, who is here to take us through all the mid-caps that are moving around in trade at this hour. Hormuz, over to you.
Good afternoon. And there's some recovery from the lows, but of course continue to be confined in that range, be it the benchmarks or the broader markets. So start off with some of the gainers then in today's session, considering that we are recovering from the lows of the day. And you look at Praj Industries, now that has surged to the highest point of the day, 8% higher on the stock now. Action Construction Equipment, NBCC, Aarti Industries is among the top gainers among the broader markets in today's session, all of them seeing gains of anywhere between 5 to 6%. The newsmakers is a very interesting list because PVR Inox is among the top gainers. Is off the highs of the day though, still holding on to gains of around 3.5%. At one point was up almost 7.5. Matrimony's buyback was not very well received by the street. The price is the lowest among the earlier 2 buybacks as well. So Reflex Industries has had a very sharp rebound from the lows, 14% higher on the stock. And Geojit Financial, after the block deal that took place earlier in the day, 15% equity changing hands. The stock is now up 10%. There's a very sharp recovery from the lows of the day. Some of the others stocks moving around in the broader markets today are those that have been extending gains. You mentioned Shakti Pumps in the headline. That continues to move higher now, 13% in today's session as well. Transformers and rectifiers, yet another day of gains. We spoke about it earlier on Bazar, is 11% higher on today's trade. GMDC continues to move higher, as does Godavari Power. Stocks that are doing well on the back of strong volumes. And Nuvoco Vistas is another name that has continued to move higher in the last few sessions. KEC International off the highs of the day, but Kajaria Ceramics and TBO Tech holding on to those gains on very strong volumes. And lastly, stocks that are, can't say bucking the trend, but are in the red today. Shaily Engineering continues to extend losses, 6% lower now on the stock. CCL Products, VLS Finance announced a buyback recently. That's down 5%. And Embassy Developments, that too is trading at the lowest point of the day, 6% down for Embassy Developments.
All right. Thank you so much, Hormuz, for joining us with all those details and stocks which are on our radar from the mid-cap space. Let's now move on and invite Swaroop Mohanty, who is the VC and CEO at Mirai Asset Investment Managers, to talk about the Outlook 2026 on different asset classes and a lot more. So, Swaroop, good afternoon. Thank you so much for joining in. Always a pleasure speaking begin with you, and I can't believe you're already talking about 2026. It's been a year which has been too quick, but at this time we're also talking about rupee at a record low. But you are saying 2026 is coming with good outlook for the equity segment. A lot of factors contributing to that. Considering what we are seeing with rupee currently, do you think the other things also hold on, and this is something which could reverse in 2026 for equity markets?
Hey, thank you so much for having me. Yes, 2026 onwards, not just 2026, I believe 2026 onwards will be a very different era of investing from an investor's perspective, because clearly the underlying regarding each asset class has changed. I mean, look at the statement yourself that rupee at 90 changes a lot of things for a lot of people across the world and across the country too. I mean, today in the 30 years that I've been in the industry, the first time I'm seeing gold reserves at a sovereign level more than dollar reserves, just saying that the dollar may not be the same as what it was. And it brings a very strong commodity play back into everybody's portfolio. If sovereigns continue to buy gold, why shouldn't I be buying gold? So hence my first question, is it right to sort of say that gold should remain a hedge in a financial portfolio? Is something all of us need to think. Over the last 3 years or 4 years, the kind of listings that have happened in the Indian stock market, more of the listings have been on the mid and small cap space. So the erstwhile thought that bulk of your or core of your portfolio should be large cap, by virtue of just wanting to own the length and breadth of the market, now completely is changed, because you need to own more mid and small to get to these new industries. I mean, the asset management business, say, is completely in the mid-cap space. The hospitals which are unfolding in this organized sector is in that space too. So, and traditionally we've bought a lot of large caps in the past. In the last 3 years, we've just bought small caps a lot. So maybe 2026 is the year to accumulate. 2026, accumulate mid caps is the point I'm making. And the third most important part, I think the investor base has changed dramatically. When you look at the young investing, I'm pretty sure they will look at very different products, and just look at the investor flow into assets over the last 2-3 years. Their view of what used to be a risk-averse investment environment during my era of investing is moving to risk-seeking with the younger ones coming in. So when you look at these 3 points at the backdrop of investing, I think 2026 onwards, the review of the portfolio will look very different. And I personally believe behavior towards your allocation of money is more important than which asset class you choose, because the rules of each asset class has changed.
Okay, the rules of each asset classes change. Mr. Mohanty, thanks very much for joining in. That's actually a very interesting point that you brought up, that I think people are just now looking at not only equities, but a mix in terms of the assets that they should have in their portfolio. So in that context, what would you probably advise in terms of how much equity should be? What other assets are you probably advising to have in your portfolio?
I mean, the erstwhile rule of the blanket rule that I would read across social media would be 10% to gold as a hedge. I'm questioning that to start with. I think gold will surely move towards the core of the portfolio. Almost 30% of the individuals in India, or 30% of money of individuals in India is locked into physical gold. Maybe some part of that should start getting into digital gold, and it's a better way of owning that same asset class. If the sovereigns are owning gold, then you should also own it in this space, is my personal opinion. Second, when you look at equity, and it's a factor of your risk profile, I think you have to now graduate more towards mid and small. The erstwhile cliched advice of 70% large cap is not holding good anymore. I think you have to move more to a 50-50 sort of allocation. 50 towards large, the core of the portfolio, and 50 to mid and small is the new sort of way of looking at investing, because the number of stocks that are available in mid and small are far bigger than what they used to be just before COVID. So that rule needs to change also. And I think some of the rule-based options that you are getting on the factor side is something which you can sort of add to the core of the portfolio to make your portfolio more balanced than it depends on your return projection. But The great part is you are getting a plethora of schemes available from the asset management industry, and how you mix it and form your portfolio is going to determine the wealth creation process rather than just sticking to one asset class.
Oh, absolutely, because portfolio allocation basis the risk and goals is something that we talk about very often on the channel as well with all of you. Swaroop, what kind of earnings growth are we targeting? Because that was something which has been a concern. We've been talking about valuations as well. Are all these things going to be a key factor in the recovery that you're going to see in mid and small caps?
Yeah, I see, finally, it's all about earnings. And if you look at our same view in the beginning of this year, we had seen nothing to support that. Hence, we had said that 2025 should be a year of accumulating money. Till we don't see clear sights of that, I fear that will be the view for 2026. Now, please understand, at the end of the day, there is to buying and there is to not buying. At this moment, in a growth economy like India, not buying is a bigger risk. So you have to continue accumulating all these assets. By virtue of flows to the industry, I just want to make a simple point that people have bought a lot of small caps up to the run-up of 2025, maybe to balance your portfolios. The segment which did not see flows is mid-caps, and I think that's something which should be looked at much more constructively in 2026 than we had in the past. And don't go by trailing returns. It's a new world altogether because of the number of stocks that are now available in that segment. And please understand, these are better balance sheets than the smaller companies. So I would stick my neck out and say, accumulate mid caps a little bit more than what you did in the earlier last 2-3 years, and it'll help you build a far stronger portfolio.
Okay. All right. We're going to leave it on that note. Thanks very much for joining in and giving us your 2026 outlook. That's Mirae Asset Management talking about the markets and the outlook that they have going into 2026. We'll take a short break, but we'll get you Vinay Rijani for a technical check on the other side. So stay tuned for that.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. Well, for the markets, like we mentioned, it's just about consolidating with a little bit of a negative bias at this point. The Bank Nifty is doing better. So let's welcome Vinay Rajani from HDFC Securities to talk about the technicals of the market. Vinay, hi. Welcome to the show. Well, how would you approach the Nifty just about holding at 26,000? What would your strategy be intraday?
Yeah, good afternoon. So after opening more than 100 points down, Nifty has recovered smartly and trading near its day high. And Nifty has now again reclaimed its level above its 20 days EMA. The only small resistance which we see for the Nifty is around yesterday's high. That means Friday's high, which is around 26,060 odd level. So above that level, Nifty will see a momentum coming back. And overall, the positive thing is that for last two trading sessions, breadth of the market has been continuously improving. The sectors which did underperformed started performing well, and some sort of recovery is there. So yes, there has been some improvement in the breadth of the market, and that is a positive sign. The any level about 26,016 Nifty, which happens to be the Friday's high, we may see a level of a new all-time high, which is about 26,330. So yes, bias is positive. Many sectors and stocks are participating well, and today's low becomes the strong support for the Nifty, which is around 25,900. So with that stop loss, one can expect Nifty to remain firm, and about 26,060, I'm expecting a new all-time high.
Okay, new all-time high, expecting that number soon. What about individual names? What's on your radar?
So some stocks have really got the momentum, and one of the stock which I like from the large cap, you can say a mid cap space, that is UPL. So UPL has broken out from the downward sloping trend line, and the primary trend has been bullish for the stock. So I think this stock is headed higher. So around 764 one can go long. I would suggest a stop loss at 745. On the higher side, I'm expecting a target of 790. The second stock I would pick from the FMCG space. So FMCG is the space which I think is the next momentum play for the traders. I think this has not performed till now, but today there has been some sign since morning that FMCG stocks are rebounding from the lower level. So Godrej Consumer is looking strong from the FMCG space. Around 1159 one can go long. I would suggest a trading stop loss at 1140. On the higher side, I'm expecting a target at 1195.
Okay, all right. Thank you so much for joining in today and taking us through those picks and levels to watch out for on the Nifty as well. Step into another break. When we come back, we'll get to you more on the markets and talk about stock-specific action. Stay tuned for that.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, for the broader markets, there are a lot of stocks which are buzzing around at this point in time. So we have NBCC, which is up around 6% at this point. Remember, it's been a good gainer this year. It's gained around 24%. Interglobe Aviation is seeing a bit of a comeback today, so up around 2.3% currently for Interglobe. Remember, that stock has lost around 15% of its market cap in just about a month. Couple of others which are moving today include IDFC First Bank, which is up around 2%. Newland Labs, where there was a report which came in from Novama. That stock is up around 1.6%. And a couple of others such as Federal as well as Canara Bank. But Sonal, you're looking at Reflex Industries.
Okay, so this is a company into refrigerant gases. We don't talk about it often, but today the stock is in focus. It's higher by 18%. Remember, it fell 18% on Friday, but there is a clarification which is coming in from the company. They say there were certain search operations which were initiated by the Income Tax Department from 9th of December to 13th of December. But company so far has not received any communication, any notice after the search from the Income Tax Department. This is contrary to reports which is suggesting adverse outcome from this income tax search. They say that there is no outcome yet. They will keep the stock exchanges informed whether or not there is an outcome from this particular search. Now, do remember there were reports because of which the stock fell 18% on Friday that there have been an adverse remark from the IT department. There is a demand that has come by as well, and that is the reason the stock is surged from the lows. But do remember, there's still no finality on what the order is from the Income Tax Department, right? So it is still a wait and watch scene when it comes to Reflex Industries. The other update that has come by is that SEBI has imposed penalty on Anil Jain, who's the promoter, chairman and MD of the company. It is a 10 lakh penalty because he was involved in insider trading, gave information which was price sensitive to some people, and that led to unlawful gain of 12 lakh. While 12 lakh looks like a small amount, the fact is that he's the promoter and chairman and MD of the company who was involved in such activities, and that's why important to note that important development as well for the company. The stock is hard in trade today, but remains to be seen what the outcome from that search is and what is the notice that Income Tax Department gives to the company. So that is the stock on our radar today. But with that, we have completely run out of time on this edition of Mid Cap Radar. Stay tuned, finding alpha when we return.
Hello and welcome to Finding Alpha. I'm Nigel D'Souza and we are joining in from the Mumbai News Center. Well, the EMS sector was once a market darling, but has hit rough weather amid issues at Keynes as well as Peugeot Electroplast. The big question is this just a temporary shakeout or are we set for a deeper reset? Well, to help us out with all of those answers, we are joined by Praveen Sai, the research analyst at PL Capital, who joins us on the show. Hi, Praveen. Thanks a lot for joining in and welcome to the show. Well, the top sector has been the EMS space, and we've got a few queries for you.
Sure. Thank you for having me over here. And definitely we will discuss all the concerns and the way forward opportunity to that.
All right, Praveen. So let's get straight to the point then. If you could just help us out with a few details first, just to start off with the basics before we get into, stock-specific action. Tell us how large is first the global EMS industry. If you could tell us how much China constitutes of it, how much India constitutes of it, and I would be guessing that India on a smaller base is actually growing at a faster clip. So help us out with those basic details first.
Sure. So first talk about the global EMS. It's quite a larger as compared to China or even India. So that is around $1145 billion market, and that's growing at around 5 to 6%. Whereas if I look at the China, which is again growing at a faster pace than the other countries, and that is growing at a 10 to 12%, which is around 30% of a global market. The pace from the last, post-COVID, if you look at, that's a continue.
Right.
And now we are started catching up. Right. So we are, if you look at our market as compared to China of a $366 billion, we are nearly around $55 to $60 billion.
Okay.
But the important is for us, the growth. Okay. We are growing at a 30 to 35%. And as a percentage of a global, we are just 4 or 5% of that. Again, with the China, we are again nearly around 15% of that.
Correct.
Whereas the lot of government incentives, government focus on this sector. And I believe this growth rate to continue at a 34-35% CAGR for the next 3 to 5 years continue.
All right. So we've got a fair idea then. The globe is there. China accounts for close to 30%. And India, as a percentage of China, ballpark would be close to around 20%, if I got that number correct.
Right.
A few years ago, how much was it?
India.
Yeah.
India is, as a compared to China, we were nearly around 1-2% by 22.
Okay, so we have seen a big growth then, and clearly that China plus one strategy is actually playing out because India is growing at 30% and China is growing at 10%, though their base is much larger. That said, this opportunity is very large and some of those numbers will come back up for our viewers on the screen. But how much of this opportunity is by the listed companies? Because, that's where the interest will be for a lot of our viewers.
Yes, you are right. So if you look at and bifurcate our EMS industry, largely it is contributed by the mobile manufacturer.
Okay.
Mobile EMS players, and very few are listed.
Correct.
And if I look at as a listed space, major companies contribution nearly around 18-20% of our entire EMS.
Okay.
Currently contribution is.
So 20% of that $55-60 billion.
Yeah, right.
Okay, got it. And in terms of the size, if I have to look at it, it's around 9 lakh crore approximately, the total size.
So currently, if I look at our industry, industry is by end of this financial year would be around 5 lakh crore. It's expected to reach to 9 lakh crore in the next couple of years.
Got it. All right. So that's the growth trajectory that we are looking at. Give us a few more details. You briefly mentioned about, mobile phones. And if I look at a chart, mobile phones or consumer electronic appliances, they constitute bulk of it. But there are other areas of interest. If I look at lighting, if I look at automobile, industrials as well, they constitute the remaining of it. So do you expect that to contribute meaningfully over the next few years? And also just clarify this, non-mobile, non-consumer appliances, do they give better margins?
Yes. So the first thing is whether this non-mobile, non-consumer is expected to grow at a faster pace way forward. Answer is yes.
Yeah.
Because all the companies, even in the listed space, they are exploring the automobile, industrial, even we had seen for the smart meter. Everyone is going in beyond this mobile and the consumer electronics. Why? Because the margin profile is much superior. So just to give you some numbers on that, consumer fetch around 4-5% of margin, EBITDA margin, as compared of auto of a high single digit, If I go to the EVs, that is of a double digit. Then if I go to the industrial, that is again of 15-20%. So that is the another alpha what the EMS companies are looking for from here onwards.
Okay, all right. So moving to non just mobile, not just consumer electronics, there's a bigger margin tailwind in these sort of spaces. And if you could help us out with a couple of names of companies who are focusing more on this. Keynes, I think.
Yeah. Keynes is more in the industrial and auto. Then Sirma is also moving out of the consumer. They are moving to the industrial and auto. Then even the Avalon, that's industrial, is on the higher side. So we will talk in the later that apart from the vertical, there is a further opportunity in lies as well.
Okay, all right. So let's leave that for the time being. And as you said, we'll revisit the stock-specific action. But I want to focus on a couple of big opportunities. One is PCB and the OSAT opportunity. Let's start off with PCBs first. India today, I think, is largely involved in PCBA, which is PCB assembly, if I remember correctly, rather than manufacturing. So how do you see the core PCB manufacturing ecosystem scaling up here in India? What is it at and what is it headed to?
So PCB is a very small portion right now for us because PCBA is a largely around 36,000 odd crore market. That's morely PCBA, not the PCB. PCB is just a 9-10% of that. And in that also there is a lot of import happening right now. While government focus and the incentivizing this segment very largely. So now if you look at whether it's Keynes or Amber or Sirma, these kind of players are putting up their capacities in the PCB manufacturing, the way forward. And a lot of capex they are doing to backward integrate actually.
Right.
So I believe the further opportunities also for the EMSs lies in the backward integration like this.
Okay, all right. So, just to clarify further, do you expect Indian companies, to shift focus towards, say, multi-layer, HDI PCBs, rather than, I think, as of now, they're doing what? Single or double layer PCBs. Is that the movement?
Yeah, you are right. So right now we are more in the single and the double layer. So way forward multi-layer or because the growth for the multi-layer SDI is huge. Whatever the electronics in the EV space or the iPhones are coming in, that requirement for the multi-layer or the SDI. So I think the more focus for all the companies who are doing the capex is more on that front.
Yeah.
And the way forward growth also defines on that.
Got it. So you're saying as of now, the total PCB market in India is around 36,000 crores. And that is moving to around 67,000 crores approximately.
Yeah.
PCBA. And PCB will be a larger constitute now out of that. So rather than just assembling it, we are going to be producing and manufacturing the PCB as well. Is that the way we should look at it?
Yeah, exactly.
Got it. Let's move to OSAT then. That I think includes, OSAT includes chip testing. It also includes packaging. Could you tell us how large is this market currently and what is the long-term growth outlet of OSAT?
Yes, OSAT is you can say that's another, the driver for the backward integration of the entire EMS space. And now we are building our ecosystem with a lot of government support, especially in this segment. Right now, it's a very small, around 300 odd crore market, not a big then. Expected to do, reach to around 20,000 odd crore by next 2 years. And why I'm saying? Because the government has approved 4 or 5 major plants in the OSAT facility. So the Keynes is one of them, CG Power. Then the Tata is investing in the fab facility as well as OSAT facility. Then we have a Macron also investing there. So these all are, and we had seen in the past, in the last quarter, we had continuously watching that the government is quite involved in that. They are visiting the facilities, looking after the chip produced from there. So I think this is one of the big driver for EMS, the way forward, how we are building our ecosystem right now. And also, it's a more important for a backward integration for entire EMS space.
All right. So OSAT is around 300 crores, you're saying, which is expected so around approximately $35 million approximately.
Yeah.
And that's expected to go to around $200 million.
Yes.
Very, very roughly. So
roughly,
going from around 300 crores to around 1,800 crores approximately. Would that be a fair estimate on OSAT?
Yeah, correct.
Okay. And PCB, as of now, all the PCB requirement is mostly imported?
Right now, it's not the entirely maximum of the PCB.
85-90%?
Yes, right.
85-90%, and now we're getting into the manufacturing or making of the PCB. Got that. Could you tell us in the near to the medium term, though, will these chips that we require for the OSAT facility continue to be imported, or do you see scope for domestic sourcing as well over a period of time?
Very difficult actually, because this is a more technical, I can say, over here. So first, everything start with assembly.
Yeah.
So first assembly, and then after we move to the another level of whether it's IP ownership, designing and all. So we don't have a capability as a country, I can say.
Yes.
Definitely in the long terms, we can expect the ecosystem will get created and all. So far, right now, if I summarize, we are more in the OSAT facilities, and some couple of fab facilities are coming in the country.
Got it. And I think we should get some of the breakup of all the capex actually, which Praveen has helpfully given us. Tata Electronics is the big one in there. Now, I want to ask you about a couple of concerns. The PLI benefits, that's I think going to expire somewhere in 2026. Could you tell us how significant is this as a risk to the EMS industry? And more importantly, they were getting PLI benefits. How much of that was actually being passed on to the customer as it is?
Yes, so the PLI incentive, I believe, has started to facilitate, scale up the business. And I believe government has somewhere succeed in that.
Okay.
And if I quote Dixon over here, they had mentioned earlier that around 0.6 to 0.7% of their sales in the mobile, they absorb the benefit of the PLI. Around 3 to 4% they pass on to the end consumer.
Okay.
Now, once the PLI will get over, what I believe is the detrimental for the large player is the efficiency what they improved or the scale they had achieved. Thirdly, their backward integration.
Yeah.
So these all will give them an upper hand or the benefit the way forward. Even though the PLI will be not there, they are the beneficiary of them.
So you don't see this as a big, as a big headwind for the companies, because you're saying that they're getting a PLI benefit, and bulk of that benefit is actually being passed on to the ultimate consumer or the customer. So they're only keeping around 0.5%, which, if at all, that will be the hit to their numbers.
Correct. That is the only hit, 0.6% around in their margin.
Doesn't it reduce the competitive intensity though? Or do you think it's only to that extent, so not much?
It's not much actually.
So you wouldn't view it as a big risk then, the PLI benefit expiring?
Yeah, it's not a big risk, I can say here, because it's ultimately whatever the increase in the prices, they will pass on.
Okay. Let's get straight to the point then. We have got, we'll keep flashing the graphics on the screen with regard to the size of the industry, the PCB opportunity, the OSAT opportunity as well. But let's talk about stocks. They have all seen a big correction, right? Valuations in the EMS space, though, they remain quite elevated, if you compare it with any of the other sectors as well. According to you, give us that one stock which you're most bullish on at current levels post the recent correction.
So I am more positive on the Amber Enterprises.
Okay.
And the reasoning is they are quite diversified. I segregate this EMS in the two ways, that's contract manufacturer and the PCBA players or the PCB manufacturer.
Okay.
So if you look at Amber, they are well penetrated in all the segments. So they are a RAC contract manufacturing as well as they are non-RAC contract manufacturing of component. They are in the venturing out very aggressively in the PCB manufacturing. They are doing the PCBA for the consumer as well as wearable, industrial. They are doing so. They are well diversified. To somewhere, whatever the risk in any of the segment, they will pass through very easily. The way forward, I believe, and I'm very positive on the RAC industry as a whole as well, because the penetration level is low. The one season will not, the only detrimental to the segment.
Okay.
Way forward, when the seasonality will improve, definitely being on 27 to 28% of a manufacturing market share, they are going to get benefit of that.
That 27, 28% is a percentage of?
Manufacturing of the RAC.
So they are covering so much of it. And that number a few years ago was how much for Amber?
For Amber, that has increased from, I can say, from the last 5 years in the 10% around.
10%. So they've come a long way then, and you believe that they're diversified. So your top, the stock that you're most bullish on, I think, is Amber from your coverage list. But let's focus on the stocks actually that derail the entire sentiment. Investors, they have raised some concerns on Keynes. Their management has come out, they have put some clarification as well. Do you see this as an entry opportunity? And what do you make of this risk with regard to their smart metering business? You know, the cash flows as well weren't adding up. So your view on it, entry opportunity or stay away?
We can't negate that what the Keynes has delivered so far. Their order book is very strong, 8,000 odd crore. Whether they are diversified in terms of vertical, yes, they are well diversified in the vertical wise. In one thing just to highlight, in the last 5 years, if you look at, this company their revenue get driven by the one single client.
Okay.
So average out, if I look at, around 15% of a contribution from the single client they had received. And in the year like a 24, when the 26% of their revenue came from the single client.
Okay.
And that's the same thing happening right now with the smart meter. One of the client contribution is on the higher side. And we all know the smart meter has a stretch, working capital.
Yes.
And somewhere they are, in between they are in actually. The way forward, I can say that as per their order book, the diversification of the vertical is very high. It's not like a smart meter contribution is on the higher side. That's going to go down from here. And the other automobile industrial is going to go up further. So I think the risk related to the working capital will go away in the year to come for them. That is another risk related to the cash flow, one. Second thing about their capex plan. Now they are doing a very efficient way, I can say, going to the OSAT and the PCB manufacturing.
Got it.
So those are going to play out by next year or so, 27, 28. That is another driver for them. So on the business side, I have no risk, I can say. Definitely what happened to the, the stock or what happened, in the last couple of days or you can say in the last 15 days.
Yes.
Definitely one of the reason is quite notable. And the company has addressed that.
Correct.
So I believe from here onwards, sorry to interrupt, I believe here one should look at, because technical know-how, they are very good.
They're diversified, smart metering business will contribute less, and you believe that they'll fix this issue with regard to their cash flows. Am I getting that correct?
Yeah, right.
Got it, Praveen. We have lots more to ask you. For the time being, though, we'll slip into a short break. You come back, we'll continue our discussion on the EMS space. We'll also pull in a couple of viewer queries. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. And as we have been telling you, we have been drilling down into the macros as well as the micros of the EMS segment. That said, Praveen, let's continue our discussion then. Let's focus on a stock, PG Electroplast, right? It was one of the standout performers, big wealth creators in the recent bull run. However, the management went ahead, they sold some stake, and then they cut their guidance. Street didn't like it. Your view on the name?
One thing, PG is not under coverage, but if you look at as a contract manufacturer, and especially in the RAC, they had did very well. They had grown. Definitely there is a miss in the guidance, and that's because of a seasonality, what I believe, because RAC is a very seasonal product, and there is a seasonality impact as well as client got impacted, and so as this company. Whereas so far their guidance for the entire year, growth of a double digit in teens, mid-teens, their growth rate is. Definitely this year is a challenging year for them, because in the RAC industry, you also see the compression in the margin because of a RM price. Correct. Because the one, our currency movement, another is copper prices is up, and the third is the new table change. So all these things are definitely going to impact those who are largely dependent on the RSC.
Correct.
And so as for this company, what I say, but eventually, as I said in the earlier conversation, I am very positive on the RAC industry. RAC industry is expected to go from a 15 million to around 31 million by CY30.
Okay.
So in that front, those who have the capacity to manufacture so as of a PG, definitely going to get benefit. One. Second thing is they are also diversifying their business. So what I had seen, even though that's not coverage, what I had seen in this company, they are diversifying from the RAC to the other consumer durable manufacturing even.
Correct.
So those diversification will reduce the dependence of this company over the RAC.
Okay.
So the way forward, and definitely the stock has a corrected, valuation has a corrected, as an entire sector valuation has a corrected. In that front, it's once things will settle down, definitely it's a company to look at.
So you're saying that you're more positively inclined post the recent correction, and they have had issues, but you're saying the way ahead could look brighter, and as you've been telling us, you're quite positive on the RAC industry.
Right.
That's right? All right. So that's addressed with regard to PG Electroplast. I've got a query actually that someone's written into me. They're asking me, what about the cash flow problem? The cash flow problem was limited to Keynes, I think so. And that's what, spurred the entire, people started getting nervous on that front. You believe that can get fixed, right? You had addressed it earlier, I think so.
So basically, I'll just, mention that the cash flow is a problem of growth, what I call it. Because if you need to grow, and that is a very evolving sector, you need money or a capex to grow your business. So definitely looking at the size of these companies, they are doing a massive capex right now. Even those are some funded through the government, some are getting funded by the debt or equity, definitely. But having said that, this cash flow is not a very big problem as a sector as a whole, if I look at, if they are managing and diversifying their business well.
So it was a Keynes specific problem, and the management says that they'll fix it, and you believe that, that's possible as well.
Yes.
Got that. We have Vivek Gupta, who writes to us from Noida. He has around 250 shares of Amber Enterprises at 2,200 rupees. Since 2023, he wants to know the long-term prospects of the stock. Well, Vivek, Praveen just told us that we should get the plate up of all the stocks that he has under coverage. And Amber actually is the one that's one of your top picks, right?
Yeah.
Right, Praveen?
Perfect.
So he should continue to hold on to the stock?
Yes.
Since he's got in at 2,200.
Yeah, that's a very good level he has.
Got it. We are just to flirt a little away from EMS. I want to ask you, within the consumer electronics segment, which is the sub-segments or companies that you currently find most attractive? We have to just digress a little way from EMS. What do you like? Voltas, LG LG just listed as well. What do you find most attractive over there?
So in the consumer durable, in the white good space, currently I'm liking LG Electronics.
Okay.
And it's a recently listed event. It's a more diversified. And it's not only the diversification, they are the market leader in most of the product where they are actually in.
Right.
So whether it's a refrigerator or washing machine or the RAC or the TV, they are in. And the most important is they are not only the market leader, one of the market leader in each category, they are largest premium contributor in each segment.
Yes.
So the premiumization is also one of the big card for this company to grow, or the margin to be maintained over here.
Okay.
Next leg of a growth, what they are guiding for their AMC business,
Yes.
that is the scaling up eventually. They are going aggressively in the B2B business, HVAC business. They are going on, taking a support from the, the parent company in terms of the product, expanding very exponentially, expected to grow in that particular segment. So, and also they are building their capacity in the south, and that south plant will start with the RAC manufacturing. In fact, they also guided their export opportunities also lined in, and this plant is going to contribute to the export market as well.
Okay.
So I think there are a multi-lever in that particular company. From here onwards, that's a trading at nearly around 41 times FY28 earnings, looking very attractive.
Looking attractive, much higher than the IPO price, but it's come off a little bit from the listing price. LG Electronics is one of the top stocks you have from the consumer appliances segment. Well, Praveen, thanks a lot for joining in and giving us an insight into your view on the EMS space. Appreciate you joining in here on Finding Alpha. Well, as we wind up, I just wanted to pull up Praveen's picks for you on the screen, the stock recommendations, the official call that he has on the stock, and the valuation picture as well. As Praveen says, the globe is growing at mid-single digits. China is growing in double digits, but India's EMS industry is expected to grow at 30 to 35%. So there's a long runway, and he's sounding more optimistic on the space, with Amber being the stock that he likes the most. That's all the time we have on this edition of Finding Alpha, though. Thanks a lot for joining in. Hopefully, you've learned a little bit more on the EMS space.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng, the Taiwanese index, most of them, the tech-heavy led indices are seeing some steep corrections.
It's going to be tabled in the parliament maybe as early as Monday.
25,750 on the Nifty and 58,850 as far as the Nifty bank goes. This marks itself as a fresh low on the currency. Mid-cap index is down a third. The small-cap index, I think, is starting slightly lower as well.
Indian markets may not have done much, let's say, but global markets, especially other emerging markets, have done pretty well.
We've evolved into a full-fledged omni-channel company where customers can research anywhere online, buy anywhere offline, or vice versa.
More stocks which are advancing than the number of stocks which are declining. That should make bulls feel happy.
But lately, dealers are saying there is a sell because people are seeing the currency bleeding.
We were expecting a deflation of around 0.6% or so this is a little bit narrower than that.
Our growth, our aspiration is to grow by 1.5 to 2%.
Some gains coming in from the IT pack, FMCG, PSU banking index, and the small caps also in the green right now.
Well, that is the day so far, and it has been a bit of a dreary day without too much action, without too much activity, and down 35 points to show for it with 60 minutes to go for market closing. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surbi and Rima with me. Good afternoon.
Hi, good afternoon. But I guess the saving grace is at least it's not been a slam dunk. I mean, we opened 100 points lower.
Yeah.
At least from there, we've not retested the lows of the session so far. But guys, the bigger headline really is the rupee. I mean,
once again.
I mean, 90.71 on the screen. And
I think it went to 75 also.
Yeah. So that weakness is just unchecked one-way move, one-way direction of travel. And we'll talk more about it as we go.
Absolutely. And I think, maybe just look at the rupee rate. If you can pull it up, as Surbi was saying, there you go. So not at the day's, dollar rupee, not at the day's high, but not very far away either. So 90.71. That is the intraday. Yeah, that is the intraday that we've seen today. So about 1/3% stronger against the rupee, the dollar that is so far. Market breadth, by the way, is positive, but I mean, 1,600 stocks are higher, 1,400 stocks are lower. If I look at the Nifty, of course, is not doing very much at all. Sectorally, maybe just a quick look. FMCG is up about 0.5%. PSU bank index is up about 0.4%, and the IT services index is up a little bit, by about 0.25% or so. That's it. Capital market stocks are all down sharply, 1.5% lower. I think there is a SEBI board meet. Today is the 15th, right? I mean, I think later this week there is a SEBI board meeting. Not sure if there is nervousness before that with regards to, on the F&O side, will they propose or at least come out with a discussion paper of some sort? There's some talk around that. Autos is another index which is down 1%. So that is a bit of a sharp cut coming through. Pharma is down 0.5%. And so on and so forth. So yeah, I mean, not a great looking screen, but not too bad either. And at this point,
just one more trend to highlight: a lot of the recent IPOs, suddenly there's kind of profit taking, almost universal profit taking. Look at Physics Wala, look at Urban Company, look at Acus. Acus also had a very good listing last week. There's Bluestone Jewelry, so on and so forth. Many names on the IPO screen. Wakefit. Right from the morning has been very sluggish, still down about 2% on Wakefit. One outlier to this overall weak IPO trend or weak recent listing trend is actually Corona Remedies. That's the one that's done fairly well, and we'll talk more about both of these issues as we go along.
Absolutely. Let me just quickly run you through what's coming up here in terms of the show itself, right? So it's directionless, not too much, as I kind of just highlighted. Rupee is, I think, the number one topic we will hit with Lata in just a bit. In the next 2 minutes, less than 2 minutes, we'll go across to Lata for, some clarity, some understanding of what's at play. We've got Wakefit, which listed, as Surbi just pointed out, and one from the pharma formulation space, which came to the market. So we'll get you some details on both those in just a bit. Amber is higher after the management and the analyst meet has reiterated strong numbers going forward. So details there. We had the management of BEML earlier in the morning. Stocks up about almost 4%. So some details out of what they said. Stocks basically done poorly over the last 6, 7, 8 months. It's not really done anything at all. So that's the lineup here over the next 60 minutes or so. How should you position yourself? Mitesh is here with exactly that. Mitesh, what would you recommend? What would you advise our viewers do?
Good afternoon, Prashant. So I think, the market confirms that it's still, raised and not willing to break down as yet. The other thing is that we are also not seeing strength beyond 26,200, 300 zone. So I think this is a market which, when the index trading, you should be using range strategies, try to buy near the lower end of the range, try to move profits around the upper end of the range. But the action could be on a stock specific side, and I have two recommendations right now. Buy on ABB with a stop at 52.54 for targets of 5,335. And Ambuja Cement is a buy as well. Keep a stop below 546. Look for targets in the range of about 570 to 575.
Thank you very much for that. On the large cap screen, Interglobe Aviation is your top gainer. That's up about 2%. Shriram Finance got a leg up after Bloomberg reported that MUFG, the Japanese company, is set to be near a deal for a minority stake buy in Shriram Finance. This has been reported multiple times. There's been chatter around it, but the stock moved up and now it's cooling off once again. And sectorally, strength is seen in FMCG. HUL, Tata Consumer on the buyers list, at ITC, Asian Paints also in the grey now. But the one grabbing the headline is rupee. Rupee yet again touched a fresh low against the dollar, hitting 90.75. The Indian currency, as we speak, has recovered a tad bit after the November trade deficit came in lower than expectations. Lata joins in with the numbers and the details.
Yes, it started off as another very weak day, and the fall was almost 0.5%. Was also not a fall accompanied by other EM currencies. 90.79 we saw, at 90.80 was a very important level where there are a lot of options written, we understand. The relief came because of the November trade deficit. November trade deficit, very important to note, $24.5 billion is the trade deficit. You know the number in October, 41.7 billion. So it's almost a halving of the trade deficit. And if you looked at our own poll was expecting 30 billion. So even compared to the poll, it's like 24 billion is a very good number. If you took goods plus services, then the deficit is only $7.5 billion, $7.28 billion. In the month of October, it was almost $22 billion. So that again looks very positive. The worry is about goods exports. Services exports have come as good as last month or last year. But goods exports was what we were worried, because dumping in Asia, US locked out for us. But goods exports are up 20% year on year for India. It's about over 38 billion against 31 billion year ago and against 34 billion in the month of October. More importantly, exports to the US are up by 1.3 billion. That was the one which we were worried about. Looks like if you take out all the exceptions and then the ability of Indians to compete in some areas, the export hit is not very much. So dealers are very happy to note that the fall in the deficit has come because the goods exports have done well, not just services exports, which were anyways doing well. But is that the end of pressure? No. The pressure continues because of the overhang of the trade deal, nowhere in sight yet, as well the FPI's non-stop selling. Every day you think that the market didn't fall so much yesterday. Will we get a good FPI number? And it is a sell. In fact, dealers are telling us they're selling out of bonds as well. Until now, at least bonds year to date is a plus $8.5 billion. But lately they've been selling because they're losing out on the currency. And therefore there is a worry. I mean, our worries have not gone away. There is also additional day-on-day pressure. Month ago, NDF market interventions by RBI are maturing today. That cast further pressure. RBI is supplying dollars, but it's not trying to protect any level. And that's why the weakness is not going away. There is a temporary relief.
Yeah, we remember discussing this debt outflows, that becoming the latest headache. I remember on Friday also we had the expert with us, that FPI outflows. Anyway, by the way, FPI outflows for December have totaled 18,000 crores already. One is only hoping that these foreign fund managers start going on their Christmas holiday. That's the only way, I guess, the selling will stop. But yeah, I mean, that debt situation is something we need to watch carefully.
No, it's actually the inside FDI which is going out. We should worry about Prudential going out. We should worry about Hyundai and LG and FD. What came as FDI is going out.
Yeah, yeah. Okay, all right, Lata, thanks so much for that. So our eye on the screen, today's low so far is 90.78. Let's see if the currency can pull back a little bit from those lows. We also have, by the way, Nigel joining in, who's been finding alpha in the EMS space today. Good one, Nigel, and good to have you here.
Well, Surabhi, I don't know whether you listened into the conversation, but the big takeaway, in terms of the growth for EMS is the global EMS industry is quite large, but it's growing at around 5 to 6%. China is growing at around 10 to 12%, and India is expected to grow at close to around 30 to 35%. So India, as a percentage of China's EMS market, well, we were very, very small, 2, 3, 4, 5%. Currently, India as a percentage of China's market is close to around 20%. So we have come a long way. And, we had Praveen Sai of PL Capital, who believes there's a longer runway ahead. He sounded more optimistic and believed that the valuations as well had come to decent levels for companies that are going to give this sort of growth. So, do tune in on to our online channels as well to have a relook at that with regard to the EMS space, as well as we drilled it down to stocks. That said, we have Deepan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Deepan. Good afternoon. Good to see you in. Let's have a word from you on, on the EMS companies itself. What do you like out there?
Nigel, good afternoon, and thank you for having me on your show. I think go for the market leader only. Dixon has come off significantly from its highs, and now I think the valuations also are reasonable. After trading at 100 times plus, it's available in the 50, 60 times range. And end of the day, I think growth remains pretty decent. It's a great play on backward integration, which means that margins will also expand over the next few quarters or so. So I think that's the largest player and amongst the best play in the EMS space. Having said that, it's a company which we and our clients are interested and invested in, so our views could be biased. But broadly, I think investors should look for corrections in the EMS space to increase their exposure, because it's one of the few high growth industries within India. And certainly India has an advantage, and a lot of government incentives also have been given.
Okay, Deepan, hi, good to have you in. Since we're talking EMS, actually, by the way, we have Upasana joining in on Amber Enterprises. Amber held a call with analysts, and I think the commentary has been fairly well received by the street. Upasana, fill us in on the specifics. What are some of those targets looking like? What is Amber saying for the foreseeable future?
Well, certainly. Now, as mentioned by you, Amber recently held its management meet, and the comments are quite positive. They believe that there is a sequential uptick in their consumer durable segment as well. Now, overall, if we see, the management has reiterated their guidance, implying a strong 13 to 15% outperformance to the industry players in consumer durable segment is what they have said. In FY26 overall, Amber expects 10 to 15% Y-on-Y growth in RAC segment and 35 to 40% growth in its electronic segment. Now, coming to consumer durables, as mentioned earlier, the demand has improved sequentially is what the management has said, while there is still channel inventory in the system for RAC, and mind you, 1st January 2026 onwards, new energy norms will kick in. Now, electronic division, which is the second biggest growth driver for the company, here company said that it will outperform its other segments led by new client and even acquisition. Now, company has indicated industry leading growth in its AC segment, and it has said also that it has given a strong growth outlook for its non-RAC segment as well. Now, most of the focus of the discussion was on the company's electronics segment is what we are seeing. Certainly a positive commentary and sequential uptick in its consumer durable segment is what they've indicated.
Thank you very much for that. Deepan, you spoke about Dixon. You like it. It's a part of your portfolio. But any thoughts on Amber?
Yeah, well, that's also a part of our portfolio. And these corrections are good opportunities. I think if investors have missed out on them. But Amber, especially, the issue with Amber is that it is very much focused on the air conditioning market, and that tends to be quite volatile and linked to the weather patterns. So while the long-term prospects are great, one should expect a lot of volatility in Amber's earnings as well. So from that point of view, I prefer Dixon because there's a great deal of stability in their earnings and good scope for backward integration, which may increase the margins. But Amber also prospects are pretty decent. And I would say that, it's a great play on the air conditioning industry. But you need to have a 3 to 5 year type of a horizon for the company to, reach its full potential and, deliver decent returns.
Okay, that's Amber. Deepan, little short on time, but let me ask you about today's listings. If you had a closer look at these companies, this Corona Remedies and Wakefit, any thoughts?
Corona Remedies, very interesting. I think nice high growth company, pure play on Indian pharma market, reasonable, slightly premium valuations, but very decent growth and focused on women's healthcare, which is kind of underpenetrated, less competition, I think. So positive on that company. And Wakefit, I think it's a company worth watching. Again, that's a segment which is very high growth. But I would like to prefer companies which are solid into profit, and Wakefit is just about getting over there. So it's on our watch list, but Corona Remedies certainly is like a nice, play on consumer demand for pharmaceutical products and healthcare products.
All right. Deepan, I wanted your view on silver, and how to play it. There's only one listed place, which is Hindustan Zinc. But I know you like to stay away from these material, metal kind of stocks. What about Vedanta, though? In a year which is talking about being quite subdued, they had a tailwind. They have indirect exposure to silver via Hindustan Zinc. And aluminum is looking up, which is the largest part of their SOTP. Your view on Vedanta from here on, it's 550 rupees. It's up 25%, in this year itself, which has actually been quite a weak year for equity markets. And they have the dividend bonanza as well that's coming in. It's played out, or do you think there's more to go?
Well, Nigel, I'm slowly getting influenced by you as well, and I'm getting more and more optimistic on metals. And the reason for that is that we are talking about rupee depreciation, but these companies are clear beneficiaries of rupee depreciation, because be it zinc, aluminium, copper, they are all traded in US dollar, and these companies also, they have benchmarked their revenues to the US dollar prices for these commodities. So I think we should see great times for these metal companies. And no doubt stocks have rallied, but you may see surprised on the kind of profit that they can generate. And all the Indian companies, be it Vedanta, Hindalco, Hindustan Zinc, they're all steadily expanding their capacity. They have the benefit of domestic market as well. So, I'm getting more and more positive on these companies, including steel companies as well. And if you look at 10-year return, I think pretty decent, comparable to some of the other high growth companies.
Okay, all right. Deepan, over the last many years, I recall you being very negative on cement as well as on metals. Now, gradually, cement, I think you've started sounding a little bit more positive.
I'm getting wiser by the year. What can I say?
And today, after a while, I think after many years, you're sounding a little optimistic even on metals. But point well taken. And just with regard to Vedanta, in the middle of this year, there was a Viceroy note that came in, and they pointed out various factors. And we are at CNBC-TV18 only put out the fundamentals with regard to the debt in Vedanta Limited's books and Vedanta Resources. And from there, I think the stock is up close to 35%. It saw a sharp downtick. But thanks a lot for joining in. We have noted your view on all these stocks, Deepan. Have a good rest of the day. For the time being, though, I'll tell you what. We'll slip into a short break. On the other side, we have N. Jaikumar, Group CEO and MD at Prime Securities, who's joining in.
Welcome back. The bulls are really trying to fight back, and let's see if they manage a positive close, because the Nifty is now just 15 points into negative territory. The Bank Nifty is already flashing green. So this is a good recovery from that opening gap down. Not bad at all. Well, let's figure out where the buzzers are then. Today's movers and shakers, as always, with the Hormuz. Hormuz, what do you have your eye on?
Well, the broader markets are seeing some movers that have been smashed all through the year, and they are trying to end the year on a high, at least, if not any better. Praj Industries is one such name. The stock has alternated between gains and losses for the last 6 sessions. Today's gains, though, the 12% advance is the biggest in a single day since November of last year. So almost a 13-month wait for this kind of a move on Praj Industries. The volumes today are the highest in the last 3 months. More than 1 crore shares have been traded on the stock today. The 20-day average of just around 5 lakh shares for Praj Industries. The stock has now moved above its 50-day moving average of 332. The next is 100 DMA is slightly away at 373, but it's moved above a key level nonetheless. But the stock is down 60% so far this year, and it's turning out to be the worst calendar year that the stock has had since 2008. Now, Shakti Pumps is the other one. We've been speaking about this in the last few sessions. Now, third straight day of gains. The stock has moved 33% in the last 3 trading sessions ever since it snapped an 8-day losing streak last Thursday. And the stock has had 2 crore plus shares being traded for 3 days in a row now, and the volumes are set to be the highest since August of last year. We had close to 3 crore shares that have been traded on the stock today. The 20-day average is around 26 lakh shares. The stock has now moved above its 50 DMA of 739, and as a result of this 3-day up move, the stock has trimmed its year-to-date losses down to 35%. ION Exchange is the other mover today on the upside, snapped a 3-day losing streak, the biggest single-day gain and volume since July of last year. The stock has had 13.5 lakh shares traded today. The 20-day average is just around 1 lakh shares. The stock has moved above its 50 DMA, which is around 376, and the next level on the upside is the 100 DMA at 406. And the stock, just like Praj Industries, has been beaten down 42% lower this year, the worst calendar year performance since 2011. And lastly, Aarti Industries has been moving higher since the start of the trading session, the biggest single-day gain in the last 7 months. Volumes the highest in nearly 2 months. Over 1 crore shares traded today. 20-day average of around 4 lakh shares. Now nearing that 50 DEMA of 378, 100 DEMA at 385. So keep an eye out on these 2 important levels for Aarti Industries.
Hormuz, thanks very much for that. So that is what's buzzing. You know, I'll just put up Shakti Pumps as a stock. Was a big wealth creator, and then of course kind of went flat for the last 12 months plus. And then, you know, this waterfall decline where it basically halved, literally halved, very, very quickly, right? And, you know, got to the 500 kind of handle. And from there, it's come up to about 750 odd rupee levels. So painful, I mean, journey. Even for those who actually got in earlier and who've sort of seen the upside, for a stock to half from the highs. And then, I mean, this recovery over the last 3 days, I mean, you know, it's been quite a ride. As Hormuz pointed out, some orders, etc., over the last week. And there are more tenders with regards to solar pumps, which I think there's a central scheme. There are states, etc., which are awarding orders as well. So business is there, but the stock, of course, has done what it has. N. Jaykumar is with us, Group CEO and Managing Director at Prime Securities. Jakes, good afternoon. Great to have you with us here. Thanks very much. I know, Jakes, you have a view on Interglobe, which has been stabilizing last 3 days, Thursday, Friday, and of course today it's up a little bit as well. So that is another one which has gone through a fair bit of, you know, drama, pain for flyers and consumers, and of course we'll see what happens from here on. What's your view, Jakes, on Interglobe?
My own personal feeling is that a number of things built into the pricing earlier, which included you know, things like a monopoly premium, the premium for, you know, if you just see the way social media was littered with articles about how they manage their business, including, you know, cutting costs, no carrying of microwaves, and so on and so forth. This whole thing had gone to a crescendo of how wonderful this airline was in fact run, when the reality over the last 3 to 4 years was that you had a whole bunch of multiple rounds of selling by insiders, notably one of the 2 promoters, whose stake has now gone down from 40 to maybe about 3 or 4%. So the whole idea here is that if you just see reality vis-a-vis the perception build-up. And I think it's pretty shocking that you had the board to come and make, some comments about why they believe that they haven't, in a sense, erred in various things. They've come and sought to allay, fears that people have had. Whereas the reality is that the two founders have said nothing whatsoever during what I consider the biggest ever crisis that they've had. Now, the most important thing to my mind is whether the minutes, etc., of the company actually ever revealed that they felt this was a huge thing which they had to respond to and which they should have done. And in fact, if there's anybody I can say who probably was aware of what the implications of this kind of a FDTL implementation would have been the founders. And I think this ought to have found pride of place in minutes of the meeting, of various board meetings, including the response, including analyst calls, etc. And all that we hear is at the end of the day, they've essentially ended up, quote unquote, not doing too much, and now waiting for the government to actually reverse course on the implementation date. Very disappointing to my mind. And while I don't want to cast aspersions on the timings of the sale vis-a-vis radio silence on every other front, but quite honestly, this calls, I think, for a far greater scrutiny that you had one of the two promoters on the grounds that he and the erstwhile promoter did not kind of see eye to eye and therefore virtually sold out their entire holdings at a time when there was almost no mention of the implications of such a huge change about, flight rosters, etc. So to my mind, all is not well. I feel the only reason the market is pricing it as attractively as it is even today is that it's about to enter the Sensex one of these days, I'm told. And my own assessment is the best of the days, to my mind, are way behind Interglobe. And I think, these could well turn out to be great levels to exit the stock. The fact that the founders have exited is, or at least 50% of the holdings of the combined founders has reduced, is a matter of some concern, whatever be the ostensible reason or purported reason for that.
Jakes, if I can come in, there are other players, right? For example, can others, I mean, you know this far better than anyone else, that markets at the end of the day will look at prospects ahead, right? Now, when you say the best is behind, are you saying, well, there will be other players who perhaps will emerge stronger than they've played before? In what way, shape and form do you believe? Or you think there's a P multiple compression ahead, or you think there's more action? What do you think?
I personally believe that the government may not have expressed it in so many words, but I believe that this couldn't have gone down even remotely well with the way passengers have been treated and the way this whole thing has been handled. So I believe that in terms of incremental expansion on routes and clearly in terms of market shares that they own, today that will, over the next 2-3 years, I think come down. Other players will come in for sure. And I think any of the dispensations that might have been offered to Indigo in the past, in terms of being sole, monopoly flights on certain sectors, a lot of that will go away. You could argue that, and the other thing is also a government-controlled sector. There are price caps being talked about. There is nothing which indicates to me that this incident is over and done with. And my own assessment is that we're going to have backlash of this, maybe because it was not expedient. And in some sense, the government hand got called on this, that they couldn't actually go ahead and implement what they believed in, what the ministry believed in. And to that extent, I think it's unfortunate, but it also tells you how difficult it is to manage, what is seen as a utility with one player being so dominant. And, I think that's pretty much the way I'd like to summarize it.
Sure. So to sum it up, Jakes, for people who've seen this 20% drop on Interglobe, and that's what one of the brokers actually called out. I think it was Elara. They put out a report saying that this near-term noise does not cloud the longer-term options and possibilities for an airline like Indigo. Basically, after 20% fall, is it worth looking at again, Interglobe?
Absolutely not.
No. Okay. Because of all the issues that you've outlined already. Got that.
I clearly believe the best is behind them.
Okay.
And I think there'll be many, many more questions to answer and address in the days and months to come.
Fair. Got that. So that's clear on the table. Jakes, one more sector which is in the spotlight, that's insurance, because of this big insurance amendment bill that's all set to make its way through Parliament now. What's your sense? Obviously, this 100% FDI is the big headline. We're not quite sure if other reforms like open architecture and some of the other important steps, whether those actually go through or not. But if you were looking at long-term investments into insurance, does this change your view in any way? And would you look at life or non-life, both or neither?
Actually, this will have to be a bottoms-up play. I mean, the fact that tailwinds have been there for the sector right through, few players, well-capitalized players at that are there. And both in life and non-life, there are extremely well-entrenched players. So I think, this is a growth area and multiple things. I mean, whether it's insurance connected with investment or pure insurance or foreign flows coming through, higher stakes by overseas players, there's plenty happening in this space. So to my mind, the best-in-class, the largest insurance company in India, without actually making a disclosure that, we may have interest in that, but I think LIC is probably, as good a buy as any others, and some of the big private sector ones as well. So I think the insurance space will attract more money and certainly strategic capital.
Okay, all right. Jakes, we'll leave it there. Shorter conversation, but I think useful to get a perspective and a good one there. Thank you very much for being here on Closing Bell today. Well, I think the capital market plays, some of the BSE, etc., right there at the bottom of the screen. And there is some more pressure on the rupee, which has emerged. So 90.75 now. Let's go across to Nigel, who's standing by the F&O positioning and the data. What does it tell us? Nigel, over to you.
Well, not too bad, right, Prashant? Because from the lows of the day, we've seen a bit of a recovery. I recollect earlier this morning, we had said that the 25,900 mark actually is an important support level. And from there, actually, the markets have bounced a little bit. And what's leading the way, actually, in the last few months has been tech. Remember, year to date, if you just plot a chart of the Nifty IT index as well as the Nifty, you'll see that tech actually is a rank underperformer. It's down 10% for the year. But I'll tell you what, the last 3 months, actually, if you just look at that graph, tech has actually started outperforming, which is good news because at least one end of the market that was weak, that's finding its form. But the one that's really been finding its form is the Nifty Bank. Yet again, even in today's trading session, the dip got bought into. That one's trading in the green. It's up close to under 150 points. So you have both your batsmen in top form. That's the tech index as well as the Nifty Bank. Well, both of them are playing their part, which is helping the Nifty, in fact, hold at these levels of around 26,000 odd. The Nifty PCR, well, that's moved to around 1.2. At the start of the trading session, it was around 1.15 or thereabouts. So holding at around 1.2. In terms of the options area, there appears a bit of a strategy at place. You put up the 26,000 put, 26,000 call. Just combine the premium. It'll be ballpark close to around 160 rupees or thereabouts. So just plugging that in, just for tomorrow's expiry, well, you're factoring in a number of close to around 25,850 on the downside, and on the upside, 26,150 for those that are playing this particular strategy and looking to eat into the premium. So that's going to be the important range we're looking at, just getting into tomorrow's trading session. And finally, there's one stock that I'm looking at from the broader markets, Bandhan Bank. The total open interest as a percentage of market-wide position limit, that's at around 82%. It's been holding around there actually from around 11 a.m. Today. So we'll have to keep an eye out on that. Maybe by tomorrow it dips below that 80% odd mark, and then maybe it comes out of the F&O band. So that's a stock I'll keep on my radar. It's one of those stocks that potentially can exit the F&O band in the next few trading sessions. Back to you guys.
Okay, all right. Nigel, thanks for all the F&O cues. We'll take a quick break on that note. But we come back with some final trading calls for the day.
Welcome back. Well, markets holding, around the flat line, which is a pretty good outcome, actually, going by the start of today when all the Asian markets were actually trading in the red. So, just want to plot out a few stocks, actually, from the broader markets. I've seen a bit of an up move. Misho, I think we should get that stock up for you. The stock was trading in the red when I was doing my FNO link, and that one suddenly seen a big spike up. So I think that one should come up for you on the screen. Get that up for you. Misho is the stock that I'm talking about. Move to the high point. Mitesh Thakur of Bonanza Portfolio joins us on the show. Mitesh, give us your fresh trades.
I have BTST and Britannia. I think, after consolidation is trying to break out, so good setup over here. Keep a stop at 60.20 or just below it and look for a target of 60.70.75 for tomorrow. And the other one is Coal India, BTST here, with a stop at about 382 or just below it and a target of 388.
Okay, all right. Mitesh, thanks for that. Those are quick trades coming through. Let's get some details about the two listings today. Wakefit is one, Corona Remedies is the next. So go back to Hormuz, bring him in on what he's put together for us. Hormuz, take it away.
Tale of two contrasting stories today. One having a very successful listing and the other not so. And Corona Remedies, after for a change IPO that saw very hefty subscriptions, has justified that kind of subscription. It listed at around a 40% premium and has managed to hold on to those gains mostly. Still had trading around 35% higher, among the more successful listings this year. And it's now shares worth almost 1,700 crore have already been traded on Corona Remedies today. That's almost well over 20% of its overall market cap. And among the most subscribed IPOs as well of this year, the IPO was subscribed well over 100 times, in fact, even 130 times. And the management spoke to us earlier in the day. They mentioned that their plan is to grow 1.5x in terms of revenue and 80 to 20% in terms of EPS. And they aspire to grow 1.5 to twice the industry growth. Now, on the flip side, Wakefit had a very topsy-turvy listing, and it has had that kind of a day through and through. It listed exactly at its IPO price of 195, then fell almost 9%, then recovered from the lows and traded with gains, and now has given up all of those gains and is back in the red, is Wakefit. Now, the IPO was shares almost around 800 to 850 crore have been traded here on Wakefit, and the IPO was subscribed 2.5 times. The retail portion was subscribed a lot more, 3.2 times being the overall subscription. We spoke to the management earlier in the day as well, and they mentioned that the furniture business is going to be the key margin driver for the company, and that capacity expansion can result to 3x revenues from current levels, and they expect the furniture business to do around 1,000 crore revenue by FY28, and on a company level they are expecting the revenues to grow in the early 20s. So a tale of two contrasting listings, of course, but it remains to be seen how the time goes by. Still the first day, but a good day for Corona Remedies nonetheless.
Oh yes, absolutely. Point well taken, Hormaz. Thanks very much for the details. Quite helpful over there. Well, let's welcome in Sudeep Bandyopadhyay into the conversation. Sudeep, great to have you in. Happy Monday to you. So let's start with these two new companies that have made their debut on the street. Do you like either of them?
Well, Corona, definitely. There is absolutely nothing not to like, Survi. I think it was a very good issue. The kind of oversubscription it attracted was but natural. And I'm sure, going ahead also, it will continue to perform and outperform the market. It's a fantastic company, well established, fabulous track record. And remember, it's not a new company. It's been an established company for a long time. After that, they came for the market IPO. I look at the fundamentals, look at the commentary. I think it's one of the good companies which have got now listed. And it's good for Indian capital markets if companies like this, which were unlisted, now can become listed. As far as Wakefit is concerned, it's a new gen company. They were into mattresses and all that, and now they're moving into furniture in a big way, expecting furniture to do wonders. So there are a lot of new things which they're trying to do, and hopefully at some stage they will find their feet and do well. But today the valuation, at which they did the IPO, I think didn't hold because there were a lot of question marks on the valuation, and I think that's why we did see that correction. I won't recommend anybody to buy at this stage Wakefit. I will rather wait and watch and see how they perform in the market, after the initial lock-in period gets over, and also the next quarterly results, and probably the one after that also I will want to see before I recommend a buy in Wakefit.
I think Wakefit came at 80 times trailing multiples, so expensive to begin with, and the stock has been flat since morning. But Sudeep, we've seen a correction in many of the other recent listings, like an urban company, which almost went up to 200 rupees at one point of time in the post-listing excitement and euphoria, now down to 122. Physics Wala, again, holding up above the issue price, but it's come off. At what point would you look to buy, say, an urban company or Physics Wala? When will it start looking attractive to you? Do you have any levels in mind?
Look, as far as urban company is concerned, I have started liking it. I mean, when it got listed, I think there was a lot of euphoria around it, and it shot up. Obviously, the valuation wasn't justified. 200 rupee was definitely not a justifiable valuation, but at around 100, 120 levels, it is definitely worth looking at it from a long-term perspective. Remember, they have entered only few markets in India. Now, India has hundreds and hundreds of markets which they can penetrate going forward. What they've been talking about is the incremental cost of new market entry is not that much. They've been again and again saying that. And if that assumption is correct, I think going forward with expansion, they will continue to deliver the numbers much better than what is being even expected today. It's a service which is definitely in demand. We all understand the need for the service, and I think this is a genuine problem they are trying to meet. So I'm hopeful on urban company from a long-term perspective. Yes, whether you buy at 123 or you wait for it to correct a bit more and buy. If you're a long-term investor, it doesn't matter. Just go and buy and hold it. As far as Physics Wala is concerned, I think I would rather wait and watch. I think, they're the first edutech company which attracted investment this current calendar year. Edutech was a bad name post Baiju and what all happened there. So yes, it set a trend by bringing edutech back in limelight. But I think the valuation was too rich, and that's why it did see the correction. I will wait and watch, look at the numbers, how they pan out in the next quarter and the quarter after before I take a call.
Okay, all right. Sudeep, stay on. We'll have more questions for you in just a bit. But right now, we do have to take a very quick break. Back with more stock updates in just a moment.
Welcome back. Well, let's focus on a couple of other names then. We're still in conversation with Sudeep Bandyopadhyay. Sudeep, what do you make of these capital market plays? BSE did a swift 2,000 to 3,000, but that's coming for some profit taking. It's down close to around 3.5%. What's your view on this name?
Well, if you're looking at long term and if you're definitely looking at NSE listing in the near future, I think BSE is definitely a good play. Remember, the entire NSE post-listing will be traded in BSE, and that should be one stock which I think BSE will be in a position to benefit out of because of the sheer trading volume and the excitement. And it can't trade in NSE. So this is a unique advantage BSE will have. Of course, when the price reaches a certain level, there will be profit booking. So I'm absolutely comfortable with that. Having said that, I will say if you are a aggressive investor and can wait for some time, you can still enter BSE at this 2,600, 700 levels. But if you are conservative, don't touch it because the kind of P multiple it trades at is absolutely avoidable.
Got it. All right. And what about NSE? You have a view there as well?
Well, as and when it gets listed, I'm sure there will be a lot of excitement. We will see the multiples reaching at some stage near BSE, but then things will start cooling down. We have seen what happened to NSDL where it got listed. CDSL was always, had listed much before that. So there will be some excitement when both of them will be listed, but things will settle down the way NSDL and CDSL has settled down to a comparable, I'm not saying identical, but a comparable multiple.
Sudeep, any thoughts on Shakti Pumps and what's transpired with the stock price over the last 2 years or so?
Well, I think the excitement is because of the orders they are going to get and have got. Prior to that, they had a lull period and the stock got beaten down mercilessly. But the current excitement is predominantly on the back of the new orders they're getting. Also, there is an expectation that the budget will refocus on agriculture in a big way, and that will give a boost to all these pump companies. So that's pretty much what it is. The valuation at which it was quoting before this run-up, I think was really, really attractive. And that's what suddenly with this new contracts coming in, that catch-up rally is happening.
Sudeep, thank you for joining in. Just 2 minutes to go to wrap up trade. The Nifty defends 26,000 by the close of trade, but it turned out to be a very quiet, sluggish sort of session. We managed to recover more than 100 points from the day's low, which was 25,900. So there was recovery on that, but if you look at the intraday chart, still on the flatter side. Rupee was the big headline as it continued to hit new record lows. It's 60.75 against the dollar. That's the new low. The advanced decline ratio split right down the middle, maybe marginally in favor of the advancing side, 1,500 gainers to 1,400 decliners. Sectorally, strength was seen in FMCG, buying also visible in PSU banks and IT. So a bit of an up move towards the end of trade. So to just run you through some gainers, Interglobe Aviation stabilized today, 2% up move on that. Trent HUL in the FMCG pack led with gains of over 1%. In IT, it's Wipro, HCL Tech right on top. Infosys also up and about. Shriram Finance ends in the green but came off from the session highs. That's up close to about 0.5%. On the way down, autos on the back foot. M&M, Eicher Motors losing 1.5 to 2%. Bajaj Auto struggling a bit. Oil and gas names like ONGC weak. And then predominantly, I think it's autos, because if you go down the curve, even Maruti Suzuki was down about 0.75 of a percentage point. And HDFC Bank was a bit of a drag, and that put pressure. But despite that, the Nifty Bank managed to close flat.
Yeah, at least some green on the Nifty Bank. In the broader market, the indices are very flat. The mid-cap index 0.2% lower. But as always, there's action beneath the surface. Some interesting movers actually on the upside. Misho, out of nowhere, last 10-15 minutes of trade, it's gained about 5.5%. Then there is Ather Energy, 6% higher. NBCC, 5.5% higher. ACE, Action Construction Equipment, 6%. And something like a Edelweiss Financial found takers today, 5% up here as well. Transformers and rectifiers, 8%. And Shakti Pumps, Prashant was just referring to the stock, 17% of an up move on Shakti Pumps. So interesting movers in the broader markets. On the losing side, some of the recent listings like Urban Company, Acus, Bluestone Jewelry, they've been on the way down. Today's listings, one up, one down was the kind of day. So Corona Remedies has been a total hit. It's ending the day with a gain of 34%. Solid gains coming in over there. But Wakefit Innovations, not that charged up, 2% lower on day one. By the way, I should mention Vodafone Idea. A lot of excitement about whether the government is ready to offer some reprieve to Vodafone Idea on the AGR dues. The stock was excited in the morning, but then the excitement fizzled out. It's closing down to 2.5%. Bell has gone. Final tally. The adjusted close of the Nifty above 26,000, 26,027 to be precise. So flat Monday. Let's see what the next 4 days bring. But for now, it's a wrap from the team that puts Closing Bell together. Thank you for watching. Stay tuned. Markets Forward coming up next.
D Street recovers from intraday lows to end flat, snapping a two-day gaining streak. Market breadth remains slightly positive. Nifty Bank outperforms.
Rupee hits a record low in early trade but recovers later. India's trade deficit narrows just to over $24 billion in November as exports rise and imports decline.
Corona Remedies makes a strong debut, lists at a 36% premium over its issue price. Meanwhile, Wakefit sees a muted listing. Stock ends 3% lower in trade today. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra. With me is my colleague Mangalam Malu. Mangalam, good afternoon. Well, we recovered a fair bit from the lows of the day today, ended above that 26,000 mark. The mid-caps, they were also lower in trade today. They were down around 70 points, but the market breadth was in favor of the advances today. Nifty, FMCG, PSU Banking Index, IT did really well. We did have some losers as well in the broader markets. But yes, we snapped that two-day winning streak, and that is what the day looked like today.
Yep, that is what the day looked like today. What was interesting, however, is that we were down, but perhaps not out. Why do I say that? Because yes, the Nifty opened lower, thereafter went further lower as well, closer to that 25,900 mark. From there was a near 100-point recovery. We ended about 19 points or 20 points in the red, but we ended above that 26,000 mark and very close to the 20-day moving average on the frontline index as well, led by both the IT index as well as the banking pack. Let's tell you what we have lined up for you on the show today. We start with the top movers and shakers of the day. PVR Inox shares, they rallied on the blockbuster performance of Dhurandhar as well. Amber Enterprises Management retains their bullish growth outlook, while Keynes Technology ended in the red after a strong rally in the previous couple of sessions, which followed a big decline that we saw earlier as well. And last but not least, all the key events that you need to watch out for tomorrow's trading session. So let's start with all the movers and the shakers. Hormaz is standing by at the wall to tell you what moved, what shook.
Topsy-turvy, but a range-bound session at least for the index. There was one pocket that was sulking all through the day, though. That was the auto space. And Eicher Motors, Bharat Forge, Sona BLW, all of them seeing losses of anywhere between 1 to 2%. On the flip side, the FMCG index did fairly well for itself after the underperformance on Friday. Britannia saw a bit of a rebound, as did HUL and Marico, gains of 1 to 2%. The newsmakers is an interesting list today. PVR Inox, as you just mentioned, off the highs of the day, but still ended with gains of close to 4%. Reflex Industries after the management clarification, and that's almost a 30-35% reversal from the lows of the day. Almost 17% higher, recovering everything that it lost on Friday. Shriram EPC after an order win, and Geojit Financial after that big block deal that took place earlier in the day, ending 8% higher. It'll be interesting to see who are the buyers in that transaction. A lot of the beaten down names on a year-to-date basis have done well in today's session. Shakti Pumps continues to move higher, third straight day of gains for the stock. ION Exchange still down 40% for the year, Prat still down 60% for the year, and Vishnu Prakash Puglia 5% gain in today's session, but still remains below its IPO price of 99 rupees. And lastly, some of the losers in the broader markets, Matrimony's buyback did not impress the street, stock ending 5% lower. VLS announced a buyback earlier, stock down 4.5%. Embassy Developments and PTC Industries too featuring among the top losers in the broader markets. Back to you guys.
All right, thank you so much, Hormuz, for joining us. So those were some movers and shakers in the market today. But the other big story that we are tracking is rupee again hitting a fresh low, with the dollar hitting 90.75. But the Indian currency recovered after the November trade deficit came in at $24.5 billion, much lower than the $41 billion in the month of October. Lata Venkatesh is joining us with more details on this one. Lata?
Yes, it started off as another very weak day, and the fall was almost 0.5%. It was also not a fall accompanied by other EM currencies. 90.79 we saw, and 90.80 was a very important level where there are a lot of options written, we understand. The relief came because of the November trade deficit. November trade deficit, very important to note, $24.5 billion is the trade deficit. You know the number in October, 41.7 billion. So it's almost a halving of the trade deficit. And if you looked at our own poll was expecting 30 billion. So even compared to the poll, it's like 24 billion is a very good number. If you took goods plus services, then the deficit is only $7.5 billion, $7.28 billion. In the month of October, it was almost $22 billion. So that again looks very positive. The worry is about goods exports. Services exports have come as good as last month or last year. But goods exports was what we were worried, because dumping in Asia, US locked out for us. But goods exports are up 20% year on year for India. It's about over 38 billion against 31 billion year ago and against 34 billion in the month of October. More importantly, exports to the US are up by 1.3 billion. That was the one which we were worried about. Looks like if you take out all the exceptions and then the ability of Indians to compete in some areas, the export hit is not very much. So dealers are very happy to note that the fall in the deficit has come because the goods exports have done well, not just services exports, which were anyways doing well. But is that the end of pressure? No. The pressure continues because of the overhang of the trade deal, nowhere in sight yet, as well the FPI's non-stop selling. Every day you think that the market didn't fall so much yesterday. Will we get a good FPI number? And it is a sell. In fact, dealers are telling us they're selling out of bonds as well. Until now, at least bonds year to date is a plus $8.5 billion. But lately they've been selling because they're losing out on the currency. And therefore there is a worry. I mean, our worries have not gone away. There is also additional day-on-day pressure. Month ago, NDF market interventions by RBI are maturing today. That cast further pressure. RBI is supplying dollars, but it's not trying to protect any level. And that's why the weakness is not going away. There is a temporary relief.
Okay, all right. Thank you so much, Lata, for joining us with that analysis. To take this discussion forward, we are now joined by Sudeep Bandyopadhyay of Indi Trade Capital and Jay Thakkar of ICICI Securities. Gentlemen, good afternoon. Thank you so much for joining in. Before we talk about the fundamentals, Jay, let me come to you. We did see a fall today, but a recovery from the lows as well. What are the next important levels to watch out for on the Nifty now?
Good afternoon to you, Sonal. Sonal, I would say that the range for the Nifty has been pretty narrow, and that's been like 25,700 on the lower side to 26,000. Although we have seen the Nifty, in fact, again closing about 26,000 levels today as well. And despite being on the negative side, it has closed or managed to close about 26,000 levels, which is quite important going forward, as closing about these levels clearly indicate that the Nifty has a high probability of reaching towards 26,300 at least by the next weekly expiry, right? And if we look at the cumulative OI or the open interest for the option side, the highest put open interest is at 26,000 levels. So, Sonal, till the Nifty is holding well 26,000, adding the probability of a bounce back till 26,300 and thereafter 500 is higher. Nifty will turn negative, or an alternate view from positive sideways to negative will only be below the levels of 25,700. So until those levels are held, I think one should maintain a bias sideways to positive. And similarly, as far as Bank Nifty is concerned, 58,500 to 59,000 range out there, Sonal looks quite positive. Until that range is held, the probability of Bank Nifty inching towards 60,000 is quite high. 60,000 is critical level for Bank Nifty, as there are 26,300 for Nifty. So further, momentum or bullishness on Bank Nifty would be about 60,000 levels only. And for that, the private sector banks have to really provide a breakout, as those have been trading quite sideways. From here on, Sonal, the sectors which can support would be private sector banks, Nifty, IT, FMCG, metals. I mean, these are the couple of sectors which I think can help Nifty to provide a breakout on the upside and move higher in the direction of 26,300 to 500 levels.
All right, Jay, we'll also welcome Sudeep. Sudeep, two stocks that did well today, Amber and Dixon Tech. These were not particularly well bid over the last 1 week or so. They've been fairly, sold off and selling off. Good comments coming in from the Amber and management. Dixon too, recovering from lows. Do you think after this recent correction of almost 30% from the highs, these are attractive levels, or maybe you'll wait by?
Well, Mangalam, definitely they are moving towards a zone where they become attractive. From my point of view, it's simple. If a company can grow at 40-50%, they can definitely command a multiple of 50-60. I think that's the situation where they are coming. And the management commentary does indicate that. Overall, the industry reports which are also coming out indicate that Indian EMS space can grow by 30-40%, continue to grow by 30-40% in the foreseeable future. Under the circumstances, the better ones will probably grow higher than that. And obviously, a multiple of 50-60, I think would need to be accepted. Let's put it this way. So I would say that if you are a little aggressive long-term investor, there is absolutely no harm in buying into these stocks, even at current levels. Though the multiple valuation looks outlandish, but considering the growth possibility and growth path which they have, I think that's a value you have to pay if you want to be in it.
right? So it's not just price to earnings, it's more like price to earnings and growth. PEG ratio is something that you are pegging your conviction on Amber and Dixon with. But the stock that did well today, PVR Inox, gained about 4%, supported by strong box office performance coming in from Dhurandhar. Total collections crossed 350 crore rupees after the second week, with optimism around the company's upcoming film releases as well. Ria Bhatia joins in with that. Ria.
Well, yes, Mangalam, as you were saying, PVR has done very well in trade today, and this is on the back of Dhurandhar's box office performance. Now, trade analysts have estimated that the total net collections have crossed 350 crores, and this will possibly also head towards 500 crores in the future. Apart from this, this is only the third film to have hit a triple century in 2025, and going ahead as well, on the 19th of December, Avatar Fire and Ash is set to hit the theatres, and that is also said to be seeing strong advanced collections. So for PVR Inox, Q3 is said to be a very good quarter for them, and this could also lead to some upgrades for the FY26 estimates.
Thank you so much for joining us with all those details, Ria. So that's PVR Inox. The stock ended higher in trade today. Let's get back our guests. Sudeep, first up for the questions for you. PVR Inox, there was a debate earlier that maybe we would not see a lot of these collections coming in from theatres because of the demand that we are seeing in OTT platforms. What do you have to make of PVR Inox now at these levels? Or if not this media stock, anything else that you like in the space?
Well, I think, it was a little too early when we were writing off theatres. I think the space coexists for both the mediums to coexist. Theatrical releases as well as OTT, so I think that's what is pretty much getting displayed. A movie like Dhurandhar will definitely do wonders for the PVR's numbers in this quarter. And there are the forthcoming releases also, the way they are stacked up does look good. So I don't think we should write off theatres this way. I think they have still a long way to go. So yes, we are positive on PVR. I think it's kind of a stranglehold on the market, and the quality of releases which are coming should see good numbers from them.
All right, good numbers should come in for PVR Inox. Jay, from a chart check standpoint, do you think it's reversing its earlier downtrend and perhaps it's on an uptrend?
Well, Mangalam, I would say it's not that a clear trend. It's just a like is what we are seeing right now. So I would say rather those who are stuck at the high levels could exit.
All right, those who are stuck at the high levels could exit. Have you watched the movie?
I'm yet to see that, Mangalam, and I would like to see it maybe probably coming weekend, or maybe during the Christmas vacation period.
All right, maybe that is what the analysts are estimating as well. The 350 crore goes up to 500 crores by virtue of people like you and others watching it. Sudeep, you said you watched it. You raised your hand.
I did watch it. So I'm a part of that 350 crore.
Take that point. All right. Let's go across to, Upasna, who joins in with the news on Amber Enterprises. We alluded to, what could have led to that up move, but let's get into the details. We have Upasna joining in with what the management said in the analyst meet.
Well, positive commentary is what we saw today, and the stock certainly reacted on the back of that positive commentary. Now, management has reiterated their guidance, implying a strong 13 to 15% outperformance to the industry peers in consumer durables. For overall FY26, the company expects 10 to 15% YoY growth in RAC segment and 35 to 40% growth in company's electronic segment. Now, consumer durable demand has improved sequentially is what the company has emphasized, while there is still channel inventory in the system for RACs. Now, electronic division, which is the second most biggest growth driver for the company said that the growth will outperform the other segments led by new client additions and even acquisitions. Company has also indicated industry-leading growth in its AC segment and believes that the growth outlook for the non-RAC segment is likely to be much stronger in the medium-term time frame. Now, most of the focus of the discussion was around company's electronic segment. So overall, certainly a positive commentary, and we saw the stock surging on the back of this positive news.
Thank you so much, Upasna, for joining us with all those details. Jay, there's been so much happening in the EMS space. From a technical perspective, any stock which comes on your radar?
Well, see, overall, this stock, this sector we have seen, broadly, it has we have seen a good amount of selling coming in, especially when I look at the stock like Amber, we've seen clear shorts getting built up out here. Sonal, we have seen short covering also happening since past couple of trading sessions. The stock has also taken off its crucial weekly swing of 6,700. So now I believe that till 6,600, 6,500 levels are held, there's a good chance of further short covering coming in this stock. And if it moves beyond the levels of 7,000, then probably going forward 7,500 can't be ruled out as well. So from here on, at least from the short term point of view, from the short covering point of view, the risk reward is on the long side.
All right, risk reward is on the long side. With that, we thank both, Sudeep and Jay for joining us on the show and giving us your views on a whole host of sectors, stocks as well. Just before we let you go, Sudeep, do you like the consumption space?
I do like quite a bit.
The FMCG pack was doing well today.
Yeah, I think it's high time FMCG starts doing well. Look, there were a lot of challenges FMCG faced. Rural demand problem, urban demand problem. I think this festive season and in India festival continues till about February. So this is the phase where I think we will see a lot of consumption pick up. Look, to expect GST rationalization to benefit consumption was little unrealistic. That will benefit consumer durable. But the overall traction of the economy should help FMCG. And that's exactly what is happening during this festive period.
Okay.
Any one particular stock that you want to recommend?
Well, HUL I've been recommending for quite some time. It has moved up quite a bit. But I think one can look at Godrej Consumer also because they have a international business as well. And that's also have started doing well. They have started filling the gaps in the portfolio. And we are positive on Godrej Consumer from a long-term perspective.
Okay, all right. Gentlemen, thank you so much for joining us with your thoughts and insights on individual names and the markets going forward. With that, we'll do one thing. We'll take a short break. When we come back, we'll talk about the top corporate voices along with the key market events to watch out for on the other side.
Welcome back. You're watching us here on Corporate Voices. The top corporate voices that we had on our channel today on Markets Forward. Corona Remedies listed at a premium of 36% to its issue price. Speaking to CNBC-TV18, the MD and CEO, Nirav Mehta, said that the company aspires to grow 1.5 to 2 times more than the industry, driven by deeper penetration across key therapy areas. Also expressed optimism about the GLP-1 market.
Wakefit made a muted debut on D Street. The stock ended over 1% lower. The co-founder of the company said the company's furniture business will be the key margin driver going forward. he said ongoing capacity expansion in furniture could help the segment deliver up to 3 times revenue growth.
Right, and defense PSU major BEML expects strong order inflows over the next 2 to 3 quarters. Speaking to CNBC-TV18, Shantanu Roy stated that the company is likely to end FY26 with an order book of upwards of 20,000 crore rupees.
And before we wrap, we bring you some key market events to watch out for. Our colleague Upasana is standing by with the key events to focus for tomorrow's trading session. Upasana.
Well, first up, let me start with the global economic cues. US will be reporting its unemployment rate and even S&P Global PMI data. UK unemployment rate and Japan S&P Global PMI data will be out tomorrow. Now, let us look at the key stocks that will be in our focus today on the back of corporate action. Canara Robeco AMC to consider interim dividend, Fusion Finance, both to consider fundraising by issuance of NCDs via private placement basis. Vikram Solar will also be in focus as the board will consider and review various business divisions. Now, on the IPO front, KSH International opens for subscription tomorrow, while on the flip side, ICICI Prudential AMC closes for subscription. Now, let us look at some of the key important events for tomorrow. European Commission is expected to reverse EU's effective ban on sale of new combustion engine cars from 2035. Now, WTO General Council meeting in Geneva also begins tomorrow onwards till 17th of December. And lastly, IPL auction begins and the 2026 Indian Premium League auction is set to kick off tomorrow. So all in all, looks like quite a power-packed day tomorrow.
Power-packed day indeed, Upasana. Thank you so much for that. With that, we are out of time on this edition of Markets Forward. Thanks so much for watching. Back with more news and updates. Stay with us.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Rupee hits a record low in early trade but recovers in later. India's trade deficit narrows to just over $24 billion in November as exports rise and imports decline. Commerce Ministry says India and US are very close to a framework but stops short of prescribing a timeline. India proposes a preferential trade agreement with Mexico to avert the newly proposed 50% tariffs on goods from Asia. Sensex and Nifty end marginally in the red despite a late recovery. Financial stocks buck the trend with the Nifty bank index ending in the green. Authorities invoke stricter pollution control measures as air quality in Delhi remains severe for the third straight day. Construction is banned, primary schools go hybrid. UK, Canada and Singapore issue advisory to citizens to stay indoors. The Union government will table a new bill to replace the Mahatma Gandhi National Rural Employment Guarantee Act. The proposed legislation hikes the guaranteed working days to 125 per year from 100. Also mandates that most states will now bear 40% of the cost. Proposes that Union government will determine the state-wise normative allocation for each financial year based on objective parameters. Flipkart receives NCLT approval to shift the domicile of its holding company from Singapore back to India. Gets set for a potential IPO. The e-commerce major had mentioned earlier this year that it was working towards relocating its legal base to India. China's retail sales post the worst performance since COVID restrictions. Factory output slows to a 15-month low. President Xi Jinping warns officials against chasing reckless GDP growth even as the economy appears to have stalled. 15 people are dead after a terror attack on Jewish people at Sydney's Bondi Beach by a father-son duo identified as Sajid Akram and Naveed Akram. Australian Prime Minister promises stricter gun control after licensed firearms were used by the shooters. A heroic bystander named Ahmad El Ahmad, who tackled one of the gunmen and got shot in the process, is recovering in hospital. Ukrainian President Zelensky offers to drop his country's bid to join the NATO in exchange for security guarantees, but rejects Washington's push to cede territory to Russia. Zelensky met Trump's envoy Witkoff and son-in-law Jared Kushner and European leaders in Berlin to discuss peace plans. 45-year-old Nitin Nabin appointed working president of the BJP as the party signals a generational shift. The five-time MLA from Bihar is expected to be formally elected in January, ending months of suspense. All right, the top story this evening. It was a roller coaster ride for the Indian rupee today. The currency hit fresh lows in the morning but recovered in late trade. The rupee plunged to a new record low of 90.79 against the dollar. But trade deficit narrowing to just over $24 billion in November lifted sentiment in late trade, sparking a recovery. Lata Venkatesh is here with more on the rupee and the trade data. Lata.
Yes, it started off as another very weak day, and the fall was almost 0.5%. It was also not a fall accompanied by other EM currencies. 90.79 we saw, at 90.80 was a very important level where there are a lot of options written, we understand. The relief came because of the November trade deficit. November trade deficit, very important to note, $24.5 billion is the trade deficit. You know the number in October, 41.7 billion. So it's almost a halving of the trade deficit. And the if you looked at the our own poll was expecting 30 billion. So even compared to the poll, it's like 24 billion is a very good number. If you took goods plus services, then the deficit is only $7.5 billion, $7.28 billion. In the month of October, it was almost $22 billion. So that again looks very positive. The worry is about goods exports. Services exports have come as good as last month or last year. But goods exports was what we were worried, you know, because dumping in Asia, US locked out for us. But goods exports are up 20% year on year for India. It's about over 38 billion against 31 billion year ago and against 34 billion in the month of October. More importantly, exports to the US are up by 1.3 billion. That was the one which we were worried about. Looks like if you take out all the exceptions and then the ability of Indians to compete in some areas, the export hit is not very much. So dealers are very happy to note that the fall in the deficit has come because the goods exports have done well, not just services exports, which were anyways doing well. But is that the end of pressure? No. The pressure continues because of the overhang of the trade deal, nowhere in sight yet, as well the FPI's non-stop selling. Every day you think that the market didn't fall so much yesterday. Will we get a good FPI number? And it is a sell. In fact, dealers are telling us they're selling out of bonds as well. Until now, at least bonds year to date is a plus $8.5 billion. But lately they've been selling because they're losing out on the currency. And therefore there is a worry. I mean, our worries have not gone away. There is also additional day-on-day pressure. Month ago, NDF market interventions by RBI are maturing today. That cast further pressure. RBI is supplying dollars, but it's not trying to protect any level. And that's why the weakness is not going away. There is a temporary relief.
Right. Thank you, Lata. So, as Lata mentioned, a key overhang for the rupee is the uncertainty over the trade deal with the US. Commerce Ministry officials say both sides are very close to a framework agreement aimed at dealing with reciprocal tariffs. But the officials stopped short of prescribing a timeline. Now, India has also engaged with Mexico after the country recently announced a 50% tariff on goods from Asian countries, including India. Exports worth $2 billion to Mexico will be impacted by the new tariff. The Commerce Ministry believes the new tariffs are not targeted at Indian supply chains and is hopeful of signing a preferential trade agreement with Mexico compliant with the WTO rules. Let's talk about stock markets now. Dalal Street recovered from lows to end the day flat, but with a slight negative bias. Sensex fell 54 points while Nifty fell 20 points, holding on to the 26,000 mark. Banks batted for the bulls with the Nifty Bank Index ending in the green, while mid-caps fell in line with the blue chips. Now, home furnishings brand Wakefit made a muted debut on Dalal Street. The company's stock listed at par with its IPO price of 195 rupees a share. It ended in the red on day one. Remember, Wakefit's IPO was subscribed just over 2 times, led by retail investors and qualified institutional buyers. Staying with listings, pharma player Corona Remedies made a strong debut. The stock listed at a 38% premium to its issue price of 1,062 rupees a share. The company's IPO was subscribed 144 times. Walmart-owned e-commerce major Flipkart has got the green signal from the National Company Law Tribunal to shift its holding company domicile from Singapore back to India. This is a crucial step for the firm that is preparing for an IPO in India. The nod follows Flipkart's disclosure earlier this year that it was working towards relocating its legal base to India to better align its corporate structure with its core operations and business footprint, which are overwhelmingly domestic. The big national headline: the national capital woke up on Monday to another day of dense smog, with air quality in the severe category for the 3rd consecutive day. Now, Delhi's air quality index stood at 456, marking the season's 2nd worst reading so far. Stage 4 of the graded response action plan is in force in the national capital. The entry of trucks and other heavy vehicles has been curtailed. Schools have also been shifted to a hybrid model. Abhimanyu Sharma with this report.
A fog alert has been sounded in several parts of northern India due to decreased visibility, which has impacted travel plans severely, which has also exacerbated the situation which was persisting due to a deterioration in air quality. The AQI has fallen, which has led to imposition of GRAP 4 restrictions in the Delhi NCR region. Travel plans have been impacted. Speaking about cancellations of flights at the Delhi airport, 61 flights till now have been reported as cancelled, and 5 flights have been diverted so far. Now, both the airport authorities as well as airlines across northern India are working to resolve these disruptions and to minimize delays to reduce any inconvenience to passengers. Some days back, a fog alert had been issued by Air India, and they had indicated that an option had been given to passengers for a complimentary reschedule or a full refund at no penalty for weather-related delays. Indigo has issued a statement and has indicated that some flights may experience delays and few may be proactively cancelled to prioritize safety and minimize waiting at airports. Now, it's a dynamic situation. It remains to be seen how it's going to pan out in the next few hours, in the next few days, even as action is underway, not just from the ministry's side, but also airlines and airport authorities are working to minimize delays.
Right, Prime Minister Narendra Modi has departed from Delhi on a 3-day nation tour covering Jordan, Ethiopia and Oman. The visit begins in Jordan at the invitation of the King and coincides with the 75th anniversary of diplomatic relations between the two countries. In the second leg, the Prime Minister will travel to Ethiopia from December 16th to 17th, marking his first ever visit to the country. The final leg of the tour will take him to Oman from December 17th to 18th. The Ministry of External Affairs said that India and Oman share an all-encompassing strategic partnership rooted in centuries-old ties of friendship and trade. India's wholesale price index continues to tread in the negative territory for the month of November. According to Commerce Ministry data, food inflation contracted 2.6% against a 5% contraction in October. Similarly, vegetable prices contracted by over 20% compared to nearly 35% contraction in October. China's factory output growth slowed to a 15-month low, rising 4.8% year-on-year. Retail sales, a key measure of consumer demand, increased by just 1.3%, marking their weakest performance since China abruptly lifted COVID restrictions. Investment activity also remained under pressure, with fixed asset investment down 2.6% in the first 11 months of the year, driven by a prolonged slump in property investment. The latest data underscores the urgent need for new growth engines as China heads into 2026. Meanwhile, Chinese President Xi Jinping has criticized inflated growth figures and vowed a crackdown on what he described as reckless projects pursued purely for superficial results. He said, and I quote, "Those who act recklessly and aggressively without regard for reality, impose excessive demands or deploy resources without careful consideration must be held strictly accountable." End of quote. He also called for a more targeted and scientific assessment system, warning that inefficient investment where projects are abandoned soon after completion must be prevented. The global AI race is no longer one-sided. Google's Gemini is rapidly gaining ground by leveraging scale across its ecosystem. And with Go founder Sergey Brin back in the office and actively driving the Gemini push, the competitive dynamics are shifting. Rachna Dhanrajani joins us now. Rachna, how exactly is Gemini changing the market?
Well, Google's Gemini is no longer playing catch-up in the global AI race. It is now steadily and structurally gaining ground on OpenAI's ChatGPT. Launched in late 2023, Gemini has expanded its share of the global AI chatbot market to around 14% by December 2025. This is up from single digits a year ago. ChatGPT still leads with over 70% market share, but the growth trajectory is clearly diverging. Gemini's user base has surged to 450 to 650 million monthly active users. This is up from under 100 million in 2024. Between August and November alone this year, usage grew nearly 30%, even as ChatGPT's growth slowed to low single digits. Now, analysts say Gemini is now adding users at 6 times the rate its closest rivals, and that the difference lies in distribution. Unlike standalone AI apps, Gemini is embedded across Google's Search, Android, YouTube, Gmail and Workspace, giving it default access to billions of users. With 2.5 billion Android devices globally, even light daily use drives scale as one can imagine. So technology has been a key inflection point. The November 2025 launch of Gemini 3 saw Google top most modal reasoning benchmarks, improve accuracy and add real-time audio and video to the bot. Gemini is now trained and deployed entirely on Google's in-house TPUs, cutting inference costs and power use versus NVIDIA-dependent rivals, and that advantage is pretty much showing up in enterprise adoption. Gemini's APIs are estimated to be around 60 to 65% cheaper than comparable OpenAI models. This has helped Google's enterprise LLM share jump from 7% in 2023 to over 20% in 2025, and all of this is backed by scale. Alphabet has guided up to $93 billion in AI capex for 2025. Most of it is earmarked for data centers, networking and custom chips. This has made Google one of the world's largest AI infrastructure investors. The momentum has clearly rattled rivals. OpenAI internally declared a code red, according to reports, reflecting concern over Google's distribution within its ecosystem. There's also a symbolic shift inside Google. Co-founder Sergey Brin has returned to hands-on technical work and is now a core contributor to Gemini. ChatGPT remains the market leader, but Gemini's rise shows that this is no longer just a model race. It's a battle for scale, cost and ecosystem control. And on that front, Google's giant is clearly awake.
Right, thank you, Rashna, for that update. On that note, we'll take a short break. Coming up next, government set to table a new bill to revamp the Rural Employment Guarantee Scheme. Details in a bit. Welcome back. The winter session of Parliament continues amid a standoff between the government and the opposition. The Finance Ministry's request for supplementary grants was taken up by the Lok Sabha. There were fireworks in the House as members clashed over electoral reforms and the functioning of the Election Commission. The government also tabled a slew of new legislations, but the Insurance Amendment Bill, which proposes to raise the FDI cap to 100%, is yet to be tabled. The bill is likely to leave out composite licenses and the open architecture clause. The Union government will table a new bill to replace the Mahatma Gandhi National Rural Employment Guarantee Act. The proposed legislation would be renamed Wakefit Bharat Guarantee for Rozgar and Ajivika Mission Gramin. It proposes several changes to the scheme, including increasing the work days and change to the funding structure to impose higher financial responsibilities on state governments. Sapna Das is here with more. Sapna, how will this new legislation change the rural employment scheme?
Well, it's quite a dramatic overhaul of the Manrega, so to speak. So first of all, let's start with the funding part of it. So two aspects over here. A, the government is now officially declaring the fact that the rural guarantee scheme, the new Avatar, the new bill that we're talking about, that's going to be a centrally sponsored scheme, which means that the states will also have to pitch in quite a lot of money. So 60-40 is a general sharing, equation under all centrally sponsored schemes. For the northeastern states and the UTs, of course, the central will have a higher share. 90% of the funding will come from the central government funds and 10% by the state. So that's one aspect. The second, equally important, or rather more important, is the fact that under the new bill, the funding for rural unemployment, that now basically moves from demand-based to normative-based. So normative-based funding means that you have to have certain very clear-cut parameters on the basis of which the funds will be released to the state governments. Now, this is very, very important. So far, what had been happening was that Manrega was a demand-driven scheme. So as and how there used to be an additional requirement by state governments, they used to come up with the demand to the central government, and after due examination, the money was either released or released in tranches or not released, depends on the scenario. But here it's very clear that leeway with the states is not really going to be there. So on both these aspects, state governments will have to really watch out that they're actually asking the money for what it's going to be really spent on. And even that is not going to be defined. There are going to be 4 very clear categories on which funds for rural employment are going to be released. Basically, waterworks, extreme weather situations, core rural infrastructure and livelihood-related infrastructure, rural infrastructure. So on these 4 parameters, so all in all, it's quite a big sweep, under the new bill that we're talking about. However, the good part of it, or rather, the pros and cons, to balance it out, the number of guaranteed employment days for rural India, that goes up to 125, which is a jump. Apart from this, a 60-day pause, a mandated pause in the Manrega 125 day. That kind of thing is going to be there. This is going to basically ensure that during the peak harvesting and sowing season, there is no dearth of agricultural labor, because a lot of labor goes to Manrega and they are busy with those works. So, when you have the peak agriculture seasons coming up, there's a dearth of labor. So here also the central government has made this good, has made this provision wherein there will be a 60-day pause, and those workers will also come under the they'll be able to, work under the agriculture sector. And those 60 days are going to be in addition to the 125 days of guaranteed work. So actually, you're talking about 300 odd days. So I think that's very, very positive for the rural unemployed as well as for the farmers. But on the funding part, that's where the big one is. And we'll have to wait and watch and see that once this bill gets enacted, or rather it becomes an act and it's rolled out by the state governments, they have to do it within 6 months of the central government notification. We'll have to wait and watch and see what happens to those funds allocated for rural unemployment. Thank you.
All right. Thank you, Sapna, for that comprehensive update. Shifting focus to another big national story we are tracking. 45-year-old Nitin Nabin has been appointed the working president of the BJP as the party signals a generational shift. The 5-time MLA from Bihar is expected to formally succeed incumbent BJP chief JP Nadda in January. Santya Gora joins us now. Santya, please take us through Nabin's appointment and the signals the party is trying to send.
So the BJP on Sunday made yet another generational shift in its organization by appointing Nitin Nabin as its working president. So who is Nitin Nabin? The BJP's new dark horse and in all likelihood a potential successor to JP Nadda. So 45-year-old Nitin Nabin is the son of late Naveen Prasad Sinha, a veteran Bihar BJP leader with roots in the Jan Sangh. Coming from a strong political pedigree, Nabin began his political journey during his student days and went on to become the state president of the Bharatiya Janata Yuva Morcha. His father, Naveen Prasad Sinha, was an MLA from the Patna West constituency, now known as Bankipur. Following his father's death due to cardiac arrest in 2006, Nitin Nabin contested the by-polls and won. Since then, he has represented the Bankipur constituency, winning it for the fifth consecutive time this year. Known for his organizational skills and grassroots connect, Nitin Nabin was inducted into the Nitish Kumar government in 2021 as a cabinet minister handling the road construction and urban development portfolios. His first major national level responsibility came when he was appointed the BJP's election in charge for the 2023 Chhattisgarh Assembly elections. The party's grand victory in the state significantly boosted his standing within the organization. During the recent Bihar Assembly elections, Nabin's proximity to the BJP's national leadership further underlined his growing importance in the party. As with several recent BJP decisions, Nitin Nabin's elevation has come as a surprise. He is known to be in the good books of Prime Minister Narendra Modi and Union Home Minister Amit Shah. His strong ideological alignment with the BJP and the RSS is also seen as a factor that helped the national leadership bring the Sangh on board with his appointment. Nabin's elevation underscores the BJP's emphasis on generational change and signals to its cadre that loyalty and organizational work matter.
All right, thank you, Sandhya, for that update. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18. Thank you for watching.
presented by Policy Bazar.
CNBC-TV18, the Policy Bazar Insurance Show.
India is under digital siege. In 2024, the country ranked amongst the top 10 globally affected by ransomware attacks, according to a report by Cyberint and Checkpoint. From crippling data breaches in hospitals to multi-crore ransom demands in BFSI and the manufacturing sectors, cyber attacks are no longer rare, they are routine. According to Finance Ministry, high-value cyber fraud cases in India jumped more than 4 times in fiscal 2024, causing losses of around $20 million. In this escalating threat environment, can cyber insurance truly act as a business enabler, not just a safety net? What role can it play in India's digital resilience journey? Let's explore right here on the Policy Bazar Insurance Show, securing your business through cyber insurance. And to do that, joining me today on the show are Eva Saiwal, Head of Cyber Insurance at Policy Bazar for Business, Manu Lavanya, Chief Operations Officer, COO at Axis Max Life Insurance, Najm Bilgrami, National Head, Liability Lines, Tata AIG, and Geisha George, President, Product and Underwriting, Commercial Lines and Reinsurance at Liberty General Insurance. Thank you, ladies and gentlemen, for joining us today on this important episode. Let me start with you, Eva and Manu, both. Starting with Eva, India was amongst the top 10 countries globally hit by cyber ransomware in 2024. Now, just these big numbers, how has this changed the conversation around cyber risk and at the leadership as well as the board level, according to you?
Thanks for having me. A great question, first of all. And see, over the years, we have seen that ransomware has elevated cyber risk to the same level as financial risk and operational risk. It is no longer a technical conversation. It is strategic, boardroom level conversation about the survival and stability of the business. Over the last years, Indian boardrooms have had a bit of a wake-up call. And when India showed up consistently among the top ransomware hit countries, it suddenly became very clear that cyber incidents are not rare events which is happening to someone else. Basically, it can happen to you anytime, at scale, and across any sector.
Manu, to you to start off with, amongst the senior leadership at various managements, has it changed, and how effectively has it changed around cyber risks and the need to protect the business against it?
I think there's a significant shift in how the board is looking at some of these incidents and the need for the enterprise to be protected by future cyber risk. Initially, if I remember, the board would be more worried about, quote unquote, are we compliant? Slowly that conversation starts shifting from are we compliant to how resilient we are, how fast can we recover. In the board meetings and even in senior executive leadership meetings, it is not uncommon for terms like RTO and RPO to be discussed fairly regularly in terms of what is our response capability once a cyber risk incident happens. It becomes even more acute, Yash, in the event of DPDP Act, where loss of customer data, for example, which may be associated with a cyber incident, also had its own very deep implications on the financials and the reputational risk of the company.
You know, to come to you, Najm, for the next question, for many, cyber insurance is still perceived as a reactive tool. In your understanding, can it actually evolve into a proactive business continuity partner, which is integral when it comes to risk monitoring, forensic services, and breach response?
When we are talking about cyber in the threat landscape of an organization has moved on top, leaving exposures like political risk, leaving exposures like natural calamity, inflation, terrorism behind. It has become the major concerns for organization. Now, to address this exposure, insurers have started taking a very different approach, which is very different from the traditional approach of insurers providing indemnity, wherein they provide the financial assistance at the time of loss. In cyberspace, they have actually trying to become the partner for the organization, wherein there are a whole lot of pre-placement services, post-placement services, and incident response, which they are extending it to the clients to address this exposure not only at the time of incident, but even in the context of improving the quality of the exposure, becoming better risk on a day-to-day basis. Because when we are talking about cyber, it is one of the ever-evolving risk which we are talking about.
To Eva, come to you. I mean, just to understand this thing better, as to what could be the extent of damage, could you share certain examples where lack of cyber protection has led to a complete collapse of, systems, processes in large organizations?
Yeah. And I would just correct it. It would not be only large, it will be all-sized company. And we've actually seen several situations where cyber insurer has been the difference between a company facing weeks of disruption and between getting back quickly on its feet. So there is one example that one of the case that we handled here in Policy Bazar for Business was that it was a manufacturing company based out of NCR area, and whose operational environment was completely frozen because of a ransomware attack. Their plants were at standstill because they had a cyber insurance. Forensic were deployed immediately, and negotiations were handled by professionals, and their business interruption losses were also covered. So what could have easily become like a multi-week shutdown and a large financial burden was contained within a couple of days, and it actually saved the company a lot of financial loss also. I'll give you another example. We've also seen like a small fintech company that suffered a credential attack on their customer accounts, and the insurer breach coach took over within hours and worked alongside their internal security team and helped them isolate and neutralize the intrusion before it actually spiraled into a regulatory or a reputational crisis. So without that immediate coordination, the impact would have been significantly more.
Now to come to Gisha, a recent global breach has exposed over 16 billion structured credentials. You can imagine how big that number can be, across the cybersecurity circle. Now, the credential leak has shown that even businesses with basic cyber hygiene aren't immune to such attacks. Do you think Indian companies today are misunderstanding the scale of reputational and financial risk tied to credential theft particularly?
Thanks, Yash, for the question. It's a very pertinent one, and it's something that we have, we have observed this over time, that for whatever reason, like, Indian corporates, a lot of our market kind of underestimates the extent of the impact that some of these losses have. Like in the case that you referred, like 16 billion credentials, customer credentials, it's not a small number. And if we see the way it was orchestrated, it's more an accumulated credential breach rather than a single one. So customers across organizations have been targeted. Now, when we look at corporates, most corporates still are focusing on base level hygiene, cyber hygiene, and they take care of their basic perimeter defenses. But in this case, if we observe, the customers were targeted with their personal information, their devices outside of the office computer network were targeted to steal credentials and session data, etc. And the data comprised of very critical information like URLs, usernames, passwords. And very often we see, right, like customers using the same set of passwords or similar set of passwords for official and unofficial work. So when you have this kind of data available in the open, we can assume that there can be mass exploitation of such information to orchestrate more, larger kind of attacks, subsequent secondary attacks onto corporates, onto the individual persons, etc. And when it comes to organizations, I think, a lot of organizations keep their mind around breach response or breach response costs. But in situations like this, where customer information is breached, you would have noticed, like, we have the recent Digital Data Protection Act as well. That gets triggered. There could be regulatory inquiries. There could be heavy fines and penalties which could be levied due to a breach like this or a gap like this. And that further adds up to the overall cost, not just the cost, also the reputation around it, because at the end of the day, it's the customer's trust which gets breached in these kind of situations. So definitely, there's a lot of underestimation of the extent of the impact and damage that these incidents cause.
Najma, I want to come to you. Now, for many, cyber insurance still perceived to be a reactive tool. Can cyber insurance evolve into more proactive business continuity partner, integral to, risk monitoring, forensic services and breach response?
So, Yash, when it comes to cyber, it is not those traditional ways wherein insurers are looking at proposal forms and deciding about the risk. It has significantly changed wherein the insurers have started looking at the outside observable data. There are security rating agencies report which the insurers are evaluating. At the same time, they are also looking at the industry trends in terms of claims, the experience which they have. There are a lot of tools which the insurers have started using is not only just to review the risk, but also to highlight exposures to the insured, that these are the areas which probably you would like to need more investment, more focus, because we continuously see those areas, those infrastructures are getting targeted. So I think sharing those case studies, sharing those experience, I think also making the insured aware about this exposure.
On that note, we'll take a very short break as promised. There's a lot more lined up on the other side of this break when it comes to this large issue, and an issue which does not get a lot of attention, the issue of cyber risk and cyber insurance. Stay tuned to hear all of those conversations on the other side of this short break.
CNBC-TV18, the Policy Bazar Insurance Show. CNBC-TV18, the Policy Bazar Insurance Show.
Well, welcome back on the Policy Bazar Insurance Show, and as promised, we continue our discussion on securing your business through cyber insurance, and we start this segment with Eva. Eva, cyber risk is a systemic issue, as we all know and have discussed. I want to look at it, look at the entire ecosystem. How are insurers, cyber security firms and regulators, coordinating today, and how that coordination should evolve to sort of put together a national cyber resilience framework, especially, in this case for MSMEs and keeping in mind the risks for them?
Yeah, it's a very important question, and that is what exactly everyone should be working towards. The next phase of India's cyber growth won't be built on individual efforts. It'll be built on a coordinated national approach that lifts MSME, large industries together along with bigger enterprises also. I think the only way we can protect MSME at scale is when everyone work towards it. I feel it's all about collaboration. If you're serious about protecting India's digital economy, then MSME have to be at the center of this conversation. They make up nearly about 1/3 of the GDP, and they power every supply chain in the country. And paradoxically, they are also the least prepared to handle a modern, large effect cyber incident. And the real truth is that the MSME can't solve this alone. So what we really need, and what you rightly said, is a national cyber resilience framework that is co-created. And we should strive for a model where certain regulators define the clear, practical hygiene baselines, where cybersecurity firms provide low-cost, easily understandable, standardized toolkits for basic protection or phishing simulation, etc., and where insurers reward good hygiene with more accessible pricing and faster onboarding. So, and for large systemic events, say a major cloud outage or a supply chain ransomware attack, regulators can support a risk sharing pool so no single insurer or business is overwhelmed.
Najma, I want to understand, with the rise in AI-enabled phishing, deepfake fraud, synthetic identity hacks, how are underwriting models adapting? Are we still pricing such policies based on historical risk or shifting to real-time posture assessments?
When we are talking about how insurers are evolving when it comes to this ever evolving risk, yes, as I said, we have moved significantly from assessing the risk from those traditional manners wherein we used to look at those proposal forms, look at our own traditional experience with respect to those risks, with respect to those industries. Definitely, when it comes to underwriting, insurers are trying to deep dive within the structure of the organization, the posture which they carry, the kind of data which they store. So a lot of things like your external attack surface scan, which they are working with various agencies, various vendors to assess the clients, where they look at your end of life technology which you are using within your system, whether you are having multi-factor authentication in place, how many those assets are exposed to internet which are not having those backup supports from their vendors. So all of that the insurers are trying to look at. At the same time, they are also trying to address things like what kind of trainings which are getting imparted to the employees of the organizations, not only employees, even vendors to that particular organization, because we see a lot of claims, in fact, as high as almost 40% incidents what we see is happening because employees are unaware of this exposure. So insurers are also trying to understand what kind of trainings the organizations are imparting to their employees, their vendors, so that these exposures can be mitigated.
I just want to understand just the way, let's say, a DICGC insures principal and interest up to a maximum of, I think, about 5 lakh on bank accounts and bank deposits. Should cyber insurance also be made mandatory for every current account. Do you think that is the way, that is the approach which should be taken?
Well, it's a good thought, Yash. Like so far, we haven't seen anything like this before. So they definitely food for thought. So if you look at the pros of something like this, will be that one, if you mandate a certain coverage across all current account holders, there will be a basic baseline kind of protection that we could build for the segment that, particularly for the MSME segment, there will be a baseline protection that we could create if something like this is mandated. At the same time, it could also help drive up standards because, once you introduce a mandatory insurance coverage, there's a lot more focus around it, a lot more MSMEs become aware about an exposure like this and coverage available, etc. And automatically it starts driving the awareness aspect that we discussed before. I would say that there are pros and cons, good and bad. Maybe to start off, we could look at, rather than mandating, we could start with incentivizing. Like we bring the institutions like CERTIN and the regulators into picture, where we start supporting the MSMEs with a more, first of all, more awareness and input about what are those baseline items that they could focus on, basis that we could support them with some incentivization through the regulators, through the various schemes, whether it is onboarding a software as a service kind of models that we could build for this segment, etc. So I think it's more about enablement, a bit more incentivization rather than making it mandatory for them at this stage.
Okay. Manu, I want to ask you one question. We did mention about how the insurance companies are looking at the evolving cyber risk and developing new techniques. I want to understand, with the rise in AI, are insurers also looking at AI themselves for dynamic risk coding, automated incident classification, as well as pre-breach vulnerability risks, using purely from AI point of view?
That's a great question, Yash, and absolutely answer is yes. So let me give the answer from perspective of both what's happening on applying analytics and AI to cyber incident data, for example, or let's say penetration data. Yes, there is a significant usage of, for example, automated threat detection through what we call as abnormal pattern recognition algorithms, right? Which are really trying to figure out, has the threat pattern changed? Has my dynamic access or attempts, for example, a potential DDoS attempt from a certain country, from a certain geography changed? AI is coming to a lot into rescue as far as pattern determination on threat detection is concerned. That's number one. The second area where AI is working significantly, today what happens is, Yash, that the events happen across a wide variety of input and output points. There are certain events that only get triggered at the periphery. There are certain events that get triggered in core systems. What AI is doing very well today is the ability to do event correlation across a very diverse set of portfolios of technologies. Because when a threat happens, it propagates through the system through a wide variety of processes and landscapes. The ability that AI gives is to create intelligence on what potentially can be a root cause for such a propagation by correlating events across this very, very vast and diverse portfolio. So yes, short answer, absolutely yes. Not only in the area of threat detection for security, for cyber security, but also cyber impersonation detection, for example, that AI itself creates in the process of medical underwriting, for example, right? So there's another dimension of threat prevention, which is how do I create or prevent risk through applications of visual AI, through applications of even Gen AI, where we are trying to figure out what is an abnormal pattern, even at the point of an application, for example. Having that intelligence, having that correlation, having that data to make sure we are able to predict points of failure, we are able to predict that something is changed in the patterns, and then we are able to alert the backend systems far more adequately that here there's a potential shift, there's a potential threat, and that needs to be either isolated immediately before a remediation can actually be found, but at least isolation becomes very, very critical and very, very rapid through the application of AI for some of this pattern recognition.
Well, absolutely. Using cyber intelligence to fight against cyber risks. Thank you, everyone. All our panelists, Manu, Eva, Najm, as well as Gisha, for joining us and sharing your valuable insights on today's show. But yes, that's the end of today's episode of the Policy Bazaar Insurance Show. Until next time, thank you so much for joining us and goodbye.
CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome. I am Ashmit Kumar. Now, the Union government is set to table a new bill to replace the 2005 Mahatma Gandhi National Rural Employment Guarantee Act, also known as Manrega. Under the proposed legislation, the program will be renamed to Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin. The bill proposes several structural changes to the scheme, beginning with an increase in the guaranteed employment days. The number of assured work days will rise to 125 days from the current 100. The legislation also proposes a significant change to the funding structure, shifting a higher financial burden to the state governments. At present, the centre currently bears 100% of unskilled labour costs and 75% of material costs. Under the new framework, 40% of the total cost will now be borne by all states except northeastern, Himalayan states and J&K. Now, the governments in these regions will also bear 10% of the costs. The bill also seeks to alter the process of budget allocation. The central government will provide a fixed allocation to each state determined by several parameters, including what it defines as a rural area for the state. This marks a shift from the current system where states have the flexibility to propose budgets based on the anticipated demand for work. On News Center, we help to decode the implications of these changes on major states. And in fact, joining us now to take this discussion ahead is with us Nikhil De, founder and member of Mazdoor Kisan Shakti Sangathan and National Campaign for People's Right to Information. He was one of the key architects of the Manrega. Mr. De, thank you so much for taking our time. You've been quite critical of this new bill that has been proposed by the centre. It's called the VBG Ramji bill is what is being touted as in the parliament and social media. You've been quite critical. Tell us what's the one big change that stands out for you and why you believe that to be a damaging change going forward.
So, frankly, the most basic thing is that it's the end of the right to work for an employment guarantee. It does indeed repeal the MGNREJ and successfully so, I mean, in the bill. But what it replaces with is no guarantees of any kind at all. In fact, what you talk about, it's the architecture that allowed MGNREJ to work, which was a nationally, centrally funded scheme across the country that gave a universal entitlement to any rural citizen who wanted to volunteer to do manual work under minimum wages to start off with. That has been replaced, and just 3 sections actually should be understood. Quite rightly, you have said, one is the section where it says that the funding ratio will be now 60:40. The reason MGNREJ ran and all the states accepted it and it ran nationally was because the central government said, we will fund the entire labor component, 100%. Section 22 of the MGNREJ has now been replaced with Section 22 of the G-Ramji bill, which says that 60% for most of the country, barring northeastern states and hill states and union territories, the new bill says that 40% of the money will have to come, even for labor component, from the states. Now, there is no reason that the states may want to do this. And in fact, in trying to bring the 60 and 40 together, most parts of the country, the sufferer will be the worker who during every time of economic distress, and those distressed workers who find themselves looking for alternative employment will be unable to get any kind of guarantee. As it is, it's been very difficult because of lack of allocations. This brings me to the second point, which is Section 4(5) of the Act, the new bill. The new bill in Section 4(5) clearly states that the central government will be free. I will actually read it to you. The central government shall determine the state-wise normative allocation for each financial year based on objective parameters that as may be prescribed by the central government. Clearly, now, instead of, people demanding
Mr. Day,
law
let me
of
just
work.
come in on some of the issues that you've highlighted. One is, of course, the 40% burden that the states will have to bear. What I also want to ask is that under Manrega, there was a very clear provision that provided for additional supplementary grants. It seems under VB Ramji bill, there is no provision for additional grants except in cases of disasters. Is that going to impede this employment program going forward?
So, Ashmit, supplementary grants is later. The basic grant, the MGNREJ was our one law that said you are not budget constrained. It is the one law that said as much as demand would be up to 100 days of work per rural household had to be provided by the central government. And even in the Supreme Court, when there were arguments about lack of allocation, the central government would always say, we will provide what you are calling supplementary allocation. We will provide enough allocation for what our guarantee is. That guarantee has disappeared. It is now saying we will decide what allocation, and that's the states will have to make do with that allocation, and the rest they will have to provide. And the next provision in the Act under Section 4(6) says that it will do it for, though if the state government were to provide any extra money, it would have to do it as per central norms. And Section 5(1) of the new law, the new bill says that the central government is free to decide which parts of the state or which parts of the country it will cover under the scheme. Right. It's another
Mr. Day, just one more question. Another key aspect that's been flagged by many on social media has been a restriction of 60 days that has been introduced. Again, a new feature, was not there in Manrega, is now here in the new bill, which allows states to restrict this work for 60-day period in a year's time. On the face of it, it seems to be a move towards assisting agriculture harvest season as well as the sowing season. Is that the intent and the purpose behind this? Or is this going to have maybe consequences in terms of the number of days a job can be claimed by the workers in need?
So, Ashmit, you're on a channel that looks at business issues. It looks at the economy. MGNREJ's most powerful thing was that it provided some bargaining power to people. It provided bargaining power. It did not actually finally give 100 days of work to everyone. But the rural poor who had nowhere else to turn to could say that if you're going to give me exploitative wages, I'll go to MGNREJ. I won't come to your work. And as a result, it played a market role far beyond its own role, where MGNREJ work sites took place. By barring these 60 days, all you're doing is pandering to that lobby, that agricultural sector lobby. In most parts of the country, Narega does not run in agricultural season, very little. But it runs as an entitlement that if you find you are not able to get sufficient wages as an agricultural worker, you will say, I'll go to Narega. So it provides a kind of a equivalent of a minimum support price for agricultural labor, for their labor. So yes, it will have a terrible effect. This will actually play into the hands of contractors because Narega's work guarantee is gone. It will play into the hands of big farmers because agricultural labor will be available to them and a feudal structure. And it will really undermine any idea that the central government even has of its scheme, because the 60-40 ratio, it's very unlikely that the states will play along.
Right, Mr. Day.
So even the scheme will fail. Thank you.
Right, Mr. Day, you're clearly not happy with it, but you've shared a lot of interesting insights as to operational issues that could be faced going forward, and we'd like to thank you for joining us. But on that note, let's also go across to CPIM Rajya Sabha MP John Brittus. He's joining us live. Mr. Brittus, thank you so much for taking our time. I went through some of the criticisms that you've put forth on social media, Mr. Brittus. One of the key issues that you raised is that they are pushing 40% of the burden onto the states, but they're taking 100% of the credit for this employment scheme going forward. Your thoughts on that?
Yeah, that is precisely how this government of India has rechristened this scheme. When Mahatma Gandhi has gone and Ram has been brought in, actually the soul of the scheme has been drained out. And see, now what they have done is that this has been turned into a normal centrally sponsored scheme instead of a guarantee scheme, a pilot scheme. So assuming that you have a allocation of, say, 1,20,000 crore, that means almost 50,000 crores of burden is on these state governments. I understand even a small state like Kerala will have to shell out something like 2,000 to 2,500 crore. It simply means that the states which are starved of funds, which don't have the resources, are being asked to implement it, but the credit goes to the central government. So a scheme which was supposed to be to give sustenance and dignity to the population, rural people who are in distress, that has been completely tweaked. And at the end of the day, there is a sad demise of a scheme which used to be there as a shining beacon for a lot of people, crores and crores of people.
Right.
And further, there are other nuances which are attached to it. And I could hear, somebody is talking
Speaking
about
of those further nuances, Mr. Britis, let me come in on some of the issues that you've raised. Let's first understand, I'm just borrowing from some of the criticisms that Mr. Dey had shared. I want to put that across to you. He said that if 40% of the burden rests on states, and if states like Kerala are unable to cough up that amount of money, you've squared that down to about 2,000 to 2,500 crore rupees annual burden that Kerala is looking at. If the state is not able to cough up that money, then what happens to this employment guarantee scheme to the workers on the ground?
Now, it is no longer a guarantee scheme. That thing has been taken out of this scheme altogether. That's what I said, that it has been converted to a normally centrally sponsored scheme. What was the soul of the scheme? Anyone who wants to, it's a right. There is a right for him. It's a guarantee for him that he should be getting the employment. Now they're pegging at an amount. That means within the amount, within the budget of the state government and the central government, you need to give the employment. Once that is exhausted, you won't get the jobs. So for the guarantee, it's going down. That's what I'm saying. And second thing is that, do you think the state governments would be in a position to shell out this much of resources to make sure that the scheme is moving? No. Because already other schemes are in distress. There are something like 81 centrally sponsored schemes. Most of these schemes suffer paralysis because of the lack of resources. So this scheme also is subjected to such a paralysis that has been inflicted. I feel that...
Just one final question to you. Mr. Britas. We're running out of time, so I'll just put across one question to you. In terms of operationalizing this entire employment guarantee scheme, one of the concerns that has also been raised is the panchayat system being weakened. The criticism is that because there's a centralized approach in this new law, it will render the panchayats powerless in terms of execution of the works at hand. Is that your approach, your observation as well, or do you think some of these concerns may have been overstated?
No. Exactly. That's what's going to happen. I have been always airing my apprehension with regard to the centralization that is happening now. Everything needs to be run from Delhi alone. Such a vast country with rich diversities, if you don't take state governments and also local body governments, how are you going to implement a scheme of such magnitude? I feel that the scheme has been virtually sent to the gallows. It's going to be drained out. I feel that the government should have said that we don't have an obligation to run this scheme because the scheme came as part of the UPA 1 or whatever may be that. So instead of that, they have brought in Ram. And everything is happening in the name of Ram. I think they should not be that uncharitable to Ram, I am telling you.
Right, Mr. Britas, I'd like to thank you. I'd like to thank Mr. Nikhil Dey as well for joining us, for sharing their perspective. Very ominous words, though, in terms of what this means for employment guarantee on the ground. I'd like to thank both of our panelists for joining us. With that, let's slip into a very short break, but we continue this discussion on the other side. Well, welcome back. We're continuing our conversation on the latest bill that is seen to replace the Manrega. It's called the VB-G-Ram-G bill. And helping us now to understand what the implications could be is with us the Congress spokesperson, Sujata Paul. She's joining us live. Ms. Paul, thank you so much for joining us. We're, of course, a finance network. We're trying to look at it from what the financial implications could be. Mr. Britas was with us. He's given us ominous figures in terms of 50,000 crore rupees, he says, is the burden that the states will have to shoulder. What I want to ask you is that the Finance Commission was not very far away. Yet a burden such as this now being cast on the state governments, do you have any concerns that the government may have been possibly preempting the recommendations of the Finance Commission?
Clearly, there are a whole lot of issues as far as renaming this is concerned, because this is more to do with political symbolism rather than practicality, because Mahatma Gandhi's name, brings to your mind immense respect, and immediately the national conscience kind of reinforces the fact that this has to be an inclusive scheme. This will be something which will bring equity. And therefore, when you talk about the new name, clearly every rupee spent on it itself is going into the renaming of it rather than correcting the problems which exist, like timely payments, etc. However, having said that, there will be a lot of public confusion and accessibility also, because all those people, and especially in the last 2 decades since this program was brought in, there have been rural workers from diverse conditions, in the sense that across the country, people have been looking up to this particular scheme as something which is a guarantee for them. However, do you think that Yes. So
Ms. Paul, I just want to ask you, just want to get a sense that while you criticize this bill, the headline numbers do support the idea that 100 to 125 days, the number of work days is actually increasing under this new bill.
But tell me something, if you are pushing the burden onto the states for 40%, earlier it was 90-10. Now, if it is going to be 40%, 100% in fact earlier, and now for the northeastern states it's 90-10, and for the rest of the states it's 60-40, with the burden being on the states as well. Do you think that poor states are going to face no problems when they have to bear this extra burden? And when you wanted everything to be centralized, you should have made sure that you were pumping in more funds into the scheme, which gives guarantee and which has given guarantee. You saw what happened in the pandemic. During the pandemic, people knew that they had 100 days of guaranteed rural labor. And now, should the government not have thought about, bettering the scheme? Now, all that money which should have gone into paying the workers going to be diverted into advertising. Yes, and changing everything.
Ms. Paul, bettering the scheme is what the government says it is doing by introducing measures like bringing in more observation and audit mechanisms to ensure that the work that is being done, the money that is being spent, is actually visible on the ground. One of the biggest criticisms of the Manrega was that there is work being done on paper but not on the ground, and therefore the need felt for a new bill, for a new audit mechanism, for new oversight mechanisms on the existing provisions.
Ashmit, tell me, where is the problem in correcting these issues? They could have done it in these issues rather than wasting so much of money, and there will be a lot of paperwork which will be required. Office renaming of, in books, in brochures, everything will require money, right? That money could have been used to make sure that this was better. However, when you talk about, the fiscal aspect of it, don't you think that the fiscal burden being shifted onto the states is going to be a matter of concern for all the state governments? Maybe the BJP ruled states will not say a word, but there is no fiscal choice given to the rest of the states as well. They will want that this should be taken up by the center, and that way this scheme could have still remained centralized. But what you're saying, and there is so much of confusion in this itself, that you are renaming a scheme to better it. How can you better a scheme when you don't have the vision to better an existing scheme? So clearly, it is not about bettering the scheme.
We're completely out of time, Ms. Paul. I'll just ask.
During the UPA era.
Ms. Paul, we're completely out of time, but I'll just come to you for a quick 30 seconds for a final comment. We've seen in the past opposition ruled states approaching the apex court, Supreme Court, when they feel there was a move that was unconstitutional. Take, for example, governors sitting on bills being passed by state assemblies. The question that I now want to ask is, when you're looking at, as per Mr. Britas, the opposition states, the states overall are looking at a burden of 50,000 crore rupees. Is this a fit case for opposition parties like you, considering moving the courts if this bill is passed, challenging the constitutionality of it?
Let us come to the bill first. Let's see how it goes and what the opposition plans to do. If the government has any sense, they will take the opposition on board. Because, you know, there is one more issue that you must talk about. When there is an unexpected reason, then then the Manrega scheme has always helped that. Whereas that aspect also, I believe, I haven't read the bill, so I can't, the draft also, so I cannot for sure say that. But what I found is that if there is some sudden need for Manrega kind of scheme to come in, then that additional spike will not be able to work, because according to me, it will be the center which will refuse to bear the burden, and the states will not be able to fund it, right?
Right, Ms. Paul. Thank you so much for joining us, for sharing your insight. Clearly, a fierce debate is what awaits us, is what Ms. Paul is telling us on the way ahead as we look at this VBG Ram G bill. We'd like to thank all of our panelists for sharing insights. But this is clearly an issue that is up for a debate. It is yet to be tabled in the Parliament. We're yet to see how the Parliament chooses to respond to this latest bill seeking to replace the MG Narega bill. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome to Finding Alpha. I'm Nigel D'Souza and we are joining in from the Mumbai News Centre. Well, the EMS sector was once a market darling but has hit rough weather amid issues at Keynes as well as Peugeot Electroplus. The big question is this just a temporary shakeout or are we set for a deeper reset? Well, to help us out with all of those answers, we are joined by Praveen Sai, the research analyst at PL Capital, who joins us on the show. Hi, Praveen. Thanks a lot for joining in and welcome to the show. Well, the top sector has been the EMS space and we've got a few queries for you.
Sure. Thank you for having me over here. And definitely we will discuss all the concerns and the way forward opportunity to that.
All right, Praveen. So let's get straight to the point then. If you could just help us out with a few details first, just to start off with the basics before we get into, stock-specific action. Tell us how large is first the global EMS industry. If you could tell us how much China constitutes of it, how much India constitutes of it, and I would be guessing that India on a smaller base is actually growing at a faster clip. So help us out with those basic details first.
Sure. So first talk about the global EMS. It's quite a larger as compared to China or even India. So that is around $1145 billion market, and that's growing at around 5 to 6%. Whereas if I look at the China, which is again growing at a faster pace than the other countries, and that is growing at a 10 to 12%, which is around 30% of a global market. The pace from the last, post-COVID, if you look at, that's a continue.
Right.
And now we are started catching up. Right. So we are, if you look at our market as compared to China of a $366 billion, we are nearly around $55 to $60 billion.
Okay.
But the important is for us the growth.
Okay.
We are growing at a 30 to 35%, and as a percentage of a global, we are just 4-5% of that. Again, with the China, we are again nearly around 15% of that.
Correct.
Whereas the lot of government incentives, government focus on this sector, and I believe this growth rate to continue at a 34-35% CAGR for the next 3 to 5 years continue.
All right. So we've got a fair idea then. The globe is there. China accounts for close to around 30%, and India, as a percentage of China, ballpark would be close to around 20%, if I got that number correct.
Right.
A few years ago, how much was it?
India.
Yeah.
India is, as a compared to China, we were nearly around 1-2% by 22.
Okay, so we have seen a big growth then, and clearly that China plus one strategy is actually playing out because India is growing at 30% and China is growing at 10%, though their base is much larger. That said, this opportunity is very large and some of those numbers will come back up for our viewers on the screen. But how much of this opportunity is by the listed companies? Because, that's where the interest will be for a lot of our viewers.
Yes, you are right. So if you look at and bifurcate our EMS industry, largely it is contributed by the mobile manufacturer.
Okay.
Mobile EMS players, and very few are listed.
Correct.
And if I look at as a listed space, major companies contribution nearly around 18-20% of our entire EMS.
Okay.
Currently contribution is.
So 20% of that $55-60 billion.
Yeah, right.
Okay, got it. And in terms of the size, if I have to look at it, it's around 9 lakh crore approximately, the total size.
So currently, if I look at our industry, industry is by end of this financial year would be around 5 lakh crore. It's expected to reach to 9 lakh crore in the next couple of years.
Got it. All right. So that's the growth trajectory that we are looking at. Give us a few more details. You briefly mentioned about, mobile phones. And if I look at a chart, mobile phones or consumer electronic appliances, they constitute bulk of it. But there are other areas of interest. If I look at lighting, if I look at automobile, industrials as well, they constitute the remaining of it. So do you expect that to contribute meaningfully over the next few years? And also just clarify this, non-mobile, non-consumer appliances, do they give better margins?
Yes. So the first thing is whether this non-mobile, non-consumer is expected to grow at a faster pace way forward. Answer is yes.
Yeah.
Because all the companies, even in the listed space, they are exploring the automobile, industrial, even we had seen for the smart meter. Everyone is going in beyond this mobile and the consumer electronics. Why? Because the margin profile is much superior. So just to give you some numbers on that, consumer fetch around 4-5% of margin, EBITDA margin, as compared of auto of a high single digit, If I go to the EVs, that is of a double digit. Then if I go to the industrial, that is again of 15-20%. So that is the another alpha what the EMS companies are looking for from here onwards.
Okay, all right. So moving to non just mobile, not just consumer electronics, there's a bigger margin tailwind in these sort of spaces. And if you could help us out with a couple of names of companies who are focusing more on this. Keynes, I think.
Yeah. Keynes is more in the industrial and auto. Then Sirma is also moving out of the consumer. They are moving to the industrial and auto. Then even the Avalon, that's industrial, is on the higher side. So we will talk in the later that apart from the vertical, there is a further opportunity in lies as well.
Okay, all right. So let's leave that for the time being. And as you said, we'll revisit the stock-specific action. But I want to focus on a couple of big opportunities. One is PCB and the OSAT opportunity. Let's start off with PCBs first. India today, I think, is largely involved in PCBA, which is PCB assembly, if I remember correctly, rather than manufacturing. So how do you see the core PCB manufacturing ecosystem scaling up here in India? What is it at and what is it headed to?
So PCB is a very small portion right now for us because PCBA is a largely around 36,000 odd crore market. That's morely PCBA, not the PCB. PCB is just a 9-10% of that. And in that also there is a lot of import happening right now. While government focus and the incentivizing this segment very largely. So now if you look at whether it's a Keynes or Amber or Sirma, these kind of players are putting up their capacities in the PCB manufacturing, the way forward. And a lot of capex they are doing to backward integrate actually.
Right.
So I believe the further opportunities also for the EMSs lies in the backward integration like this.
Okay, all right. So, just to clarify further, do you expect Indian companies, to shift focus towards, say, multi-layer, HDI PCBs, rather than, I think, as of now, they're doing what? Single or double layer PCBs. Is that the movement?
Yeah, you are right. So right now we are more in the single and the double layer. So way forward multi-layer or because the growth for the multi-layer SDI is huge. Whatever the electronics in the EV space or the iPhones are coming in, that requirement for the multi-layer or the SDI. So I think the more focus for all the companies who are doing the capex is more on that front.
Yeah.
And the way forward growth also defines on that.
Got it. So you're saying as of now, the total PCB marketed in India is around 36,000 crores. And that is moving to around 67,000 crores approximately.
Yeah.
PCBA. And PCB will be a larger constitute now out of that. So rather than just assembling it, we are going to be producing and manufacturing the PCB as well. Is that the way we should look at it?
Yeah, exactly.
Got it. Let's move to OSAT then. That I think includes, OSAT includes chip testing. It also includes packaging. Could you tell us how large is this market currently and what is the long-term growth outlet of OSAT?
Yes, OSAT is you can say that's another, the driver for the backward integration of the entire EMS space. And now we are building our ecosystem with a lot of government support, especially in this segment. Right now, it's a very small, around 300 odd crore market, not a big then. Expected to do, reach to around 20,000 odd crore by next 2 years. And why I'm saying? Because the government has approved 4 or 5 major plants in the OSAT facility. So the Keynes is one of them, CG Power. Then the Tata is investing in the fab facility as well as OSAT facility. Then we have a Macron also investing there. So these all are, and we had seen in the past, in the last quarter, we had continuously watching that the government is quite involved in that. They are visiting the facilities, looking after the chip produced from there. So I think this is one of the big driver for EMS, the way forward, how we are building our ecosystem right now. And also, it's a more important for a backward integration for entire EMS space.
All right. So OSAT is around 300 crores, you're saying, which is expected so around approximately $35 million approximately.
Yeah.
And that's expected to go to around $200 million. Yes. Very, very roughly. So we're going from around 300 crores to around 1,800 crores approximately. Right. Would that be a fair estimate on OSAT?
Yeah, correct.
Okay. And PCB, as of now, all the PCB requirement is mostly imported?
Right now, it's not the entirely maximum of the PCB.
85-90%?
Yes, right.
85-90%, and now we're getting into the manufacturing or making of the PCB. Got that. Could you tell us in the near to the medium term, though, will these chips that we require for the OSAT facility continue to be imported, or do you see scope for domestic sourcing as well over a period of time?
Very difficult actually, because this is a more technical, I can say, over here. So first, everything start with assembly.
Yeah.
So first assembly, and then after we move to the another level of whether it's IP ownership, designing and all. So we don't have a capability as a country, I can say.
Yes.
Definitely in the long terms, we can expect the ecosystem will get created and all. So far, right now, if I summarize, we are more in the OSAT facilities, and some couple of fab facilities are coming in the country.
Got it. And I think we should get some of the breakup of all the capex actually, which Praveen has helpfully given us. Tata Electronics is the big one in there. Now, I want to ask you about a couple of concerns. The PLI benefits, that's I think going to expire somewhere in 2026. Could you tell us how significant is this as a risk to the EMS industry? And more importantly, they were getting PLI benefits. How much of that was actually being passed on to the customer as it is?
Yes, so the PLI incentive, I believe, has started to facilitate, scale up the business. And I believe a government has somewhere succeed in that.
Okay.
And if I quote Dixon over here, they had mentioned earlier that around 0.6 to 0.7% of their sales in the mobile, they absorb the benefit of the PLI. Around 3 to 4% they pass on to the end consumer.
Okay.
Now, once the PLI will get over, what I believe is the detrimental for the large player is the efficiency what they improved or the scale they had achieved. Thirdly, their backward integration.
Yeah.
So these all will give them an upper hand or the benefit the way forward. Even though the PLI will be not there, they are the beneficiary of them.
So you don't see this as a big, as a big headwind for the companies, because you're saying that they're getting a PLI benefit, and bulk of that benefit is actually being passed on to the ultimate consumer or the customer. So they're only keeping around 0.5%, which, if at all, that will be the hit to their numbers.
Correct. That is the only hit, 0.6% around in their margin.
Doesn't it reduce the competitive intensity though? Or do you think it's only to that extent, so not much?
It's not much actually.
So you wouldn't view it as a big risk then, the PLI benefit expiring?
Yeah, it's not a big risk, I can say here, because this ultimately whatever the increase in the prices, they will pass on.
Okay, let's get straight to the point then. We have got, we'll keep flashing the graphics on the screen with regard to the size of the industry, the PCB opportunity, the OSAT opportunity as well. But let's talk about stocks. They have all seen a big correction, right? Valuations in the EMS space though, they remain quite elevated, if you compare it with any of the other sectors as well. According to you, give us that one stock which you're most bullish on at current levels post the recent correction.
So I am more positive on the Amber Enterprises.
Okay.
And the reasoning is they are quite diversified. I segregate this EMS in the two ways, that's contract manufacturer and the PCBA players or the PCB manufacturer.
Okay.
So if you look at Amber, they are well penetrated in all the segments. So they are RAC contract manufacturing as well as they are non-RAC contract manufacturing of component. They are in the venturing out very aggressively in the PCB manufacturing. They are doing the PCBA for the consumer as well as wearable, industrial. They are doing so. They are well diversified. To somewhere, whatever the risk in any of the segment, they will pass through very easily.
But let's focus on the stocks actually that derail the entire sentiment. Investors, they have raised some concerns on Keynes. Their management has come out, they have put some clarification as well. Do you see this as an entry opportunity? And what do you make of this risk with regard to their smart metering business? The cash flows as well weren't adding up. So your view on it, entry opportunity or stay away?
See, we can't negate that what the Keynes has delivered so far. Their order book is very strong, 8,000 odd crore. Whether they are diversified in terms of vertical, yes, they are well diversified in the vertical wise. In one thing just to highlight, in the last 5 years, if you look at, this company their revenue get driven by the one single client.
Okay.
So average out, if I look at, around 15% of a contribution from the single client they had received. And in the year like a 24, when the 26% of their revenue came from the single client.
Okay.
And that's the same thing happening right now with the smart meter. One of the client contribution is on the higher side, and we all know the smart meter has a stretch, working capital.
Yes.
And somewhere they are, in between they are in actually. The way forward, I can say that as per their order book, the diversification of the vertical is very high. It's not like a smart meter is a contribution is on the higher side. That's going to go down from here. And the other automobile industrial is going to go up further. So I think the risk related to the working capital will go away in the year to come for them. That is another risk what related to the cash flow, one. Second thing about the, their capex plan. Now they are doing a very efficient way, I can say, going to the OSAT and the PCB manufacturing.
Got it.
So those are going to play out by next year or so, 27, 28. That is another driver for them. So on the business side, I have no risk, I can say. Definitely what happened to the, the stock or what happened, in the last couple of days or you can say in the last 15 days.
Yes.
Definitely one of the reason is quite notable, and the company has addressed that.
Correct.
So I believe from here onwards, sorry to interrupt, I believe here one should look at, because technical know-how, they are very good.
They're diversified, smart metering business will contribute less, and you believe that they'll fix this issue with regard to their cash flows. Am I getting that correct?
Yeah, right.
Got it, Praveen. We have lots more to ask you. For the time being, though, we'll slip into a short break. You come back, we'll continue our discussion on the EMS space. We'll also pull in a couple of viewer queries. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. And as we have been telling you, we have been drilling down into the macros as well as the micros of the EMS segment. That said, Praveen, let's continue our discussion then. Let's focus on a stock, PG Electroplast, right? It was one of the standout performers, big wealth creators in the recent bull run. However, the management went ahead, they sold some stake, and then they cut their guidance. Street didn't like it. Your view on the name?
One thing, PG is not under coverage, but if you look at as a contract manufacturer, and especially in the RAC, they had did very well. They had grown. Definitely there is a miss in the guidance, and that's because of a seasonality, what I believe, because RAC is a very seasonal product, and there is a seasonality impact as well as client got impacted, and so as this company. Whereas so far their guidance for the entire year, growth of a double digit in teens, mid-teens, their growth rate is. Definitely this year is a challenging year for them, because in the RAC industry, you also see the compression in the margin because of a RM price. Correct. Because the one, our currency movement, another is copper prices is up, and the third is the new table change. So all these things are definitely going to impact those who are largely dependent on the RSC.
Correct.
And so as for this company, what I say, but eventually, as I said in the earlier conversation, I am very positive on the RAC industry. RAC industry is expected to go from 15 million to around 31 million by CY30.
Okay.
So in that front, those who have the capacity to manufacture so as of a PG, definitely going to get benefit.
We have Vivek Gupta, who writes to us from Noida. He has around 250 shares of Amber Enterprises at 2,200 rupees. Since 2023, he wants to know the long-term prospects of the stock. Well, Vivek, Praveen just told us that we should get the plate up of all the stocks that he has under coverage. And Amber actually is the one that's one of your top picks, right? Yeah. Right, Praveen?
Perfect.
So he should continue to hold on to the stock?
Yes.
Since he's got in at 2,200.
Yeah, that's a very good level he has.
Got it. We are just to flirt a little away from EMS. I want to ask you, within the consumer electronics segment, which is the sub-segments or companies that you currently find most attractive? We have to just digress a little way from EMS. What do you like? Voltas, LG LG just listed as well. What do you find most attractive over there?
So in the consumer durable, in the white good space, currently I'm liking LG Electronics.
Okay.
And it's a recently listed even. It's a more diversified. And it's not only the diversification, they are the market leader in most of the product where they are actually in.
Right.
So whether it's a refrigerator or washing machine or the RSC or the TV, they are in. And the most important is they are not only the market leader, one of the market leader in each category, they are a largest premium contributor in each segment.
Yes.
So the premiumization is also one of the big card for this company to grow, or the margin to be maintained over here.
Okay.
Next leg of a growth, what they are guiding for their AMC business,
yes,
that is the scaling up eventually. They are going aggressively in the B2B business, HVAC business. They are going on, taking a support from the, the parent company in terms of the product, expanding very exponentially, expected to grow in that particular segment. So, and also they are building their capacity in the south, and that south plant will start with the RAC manufacturing. In fact, they also guided their export opportunities also lined in, and this plant is going to contribute to the export market as well.
Okay.
So I think there are a multi-lever in that particular company. From here onwards, that's a trading at nearly around 41 times FY28 earnings, looking very attractive.
Looking attractive, much higher than the IPO price, but it's come off a little bit from the listing price. LG Electronics is one of the top stocks you have from the consumer appliances segment. Well, Praveen, thanks a lot for joining in and giving us an insight into your view on the EMS space. Appreciate you joining in here on Finding Alpha. Well, as we wind up, I just wanted to pull up Praveen's picks for you on the screen, the stock recommendations, the official call that he has on the stock, and the valuation picture as well. As Praveen says, the globe is growing at mid-single digits. China is growing in double digits, but India's EMS industry is expected to grow at 30 to 35%. So there's a long runway, and he's sounding more optimistic on the space, with Amber being the stock that he likes the most. That's all the time we have on this edition of Finding Alpha, though. Thanks a lot for joining in. hopefully you've learned a little bit more on the EMS space.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Rupee hits a record low in early trade but recovers in later. India's trade deficit narrows to just over $24 billion in November as exports rise and imports decline. Commerce Ministry says India and US are very close to a framework but stops short of prescribing a timeline. India proposes a preferential trade agreement with Mexico to avert the newly proposed 50% tariffs on goods from Asia. Sensex and Nifty end marginally in the red despite a late recovery. Financial stocks buck the trend with the Nifty Bank Index ending in the green. Authorities invoke stricter pollution control measures as air quality in Delhi remains severe for the third straight day. Construction is banned, primary schools go hybrid. UK, Canada and Singapore issue advisory to citizens to stay indoors. The Union government will table a new bill to replace the Mahatma Gandhi National Rural Employment Guarantee Act. The proposed legislation hikes the guaranteed working days to 125 per year from 100. Also mandates that most states will now bear 40% of the cost, proposes that union government will determine the state-wise normative allocation for each financial year based on objective parameters. Flipkart receives NCLT approval to shift the domicile of its holding company from Singapore back to India, gets set for a potential IPO. The e-commerce major had mentioned earlier this year that it was working towards relocating its legal base to India. China's retail sales post the worst performance since COVID restrictions. Factory output slows to a 15-month low. President Xi Jinping warns officials against chasing reckless GDP growth even as the economy appears to have stalled. 15 people are dead after a terror attack on Jewish people at Sydney's Bondi Beach by a father-son duo identified as Sajid Akram and Naveed Akram. Australian Prime Minister promises stricter gun control after licensed firearms were used by the shooters. A heroic bystander named Ahmad El Ahmad, who tackled one of the gunmen and got shot in the process, is recovering in hospital. Ukrainian President Zelensky offers to drop his country's bid to join the NATO in exchange for security guarantees, but rejects Washington's push to cede territory to Russia. Zelensky met Trump's envoy Witkoff and son-in-law Jared Kushner and European leaders in Berlin to discuss peace plans. 45-year-old Nitin Nabin appointed working president of the BJP as the party signals a generational shift. The five-time MLA from Bihar is expected to be formally elected in January, ending months of suspense. All right, the top story this evening, it was a roller coaster ride for the Indian rupee today. The currency hit fresh lows in the morning, but recovered in late trade. The rupee plunged to a new record low of 90.79 against the dollar. But trade deficit narrowing to just over $24 billion in November lifted sentiment in late trade, sparking a recovery. Lata Venkatesh is here with more on the rupee and the trade data. Lata.
Yes, it started off as another very weak day, and the fall was almost 0.5%. It was also not a fall accompanied by other EM currencies. 90.79 we saw, and 90.80 was a very important level where there are a lot of options written, we understand. The relief came because of the November trade deficit. November trade deficit, very important to note, $24.5 billion is the trade deficit. You know the number in October, 41.7 billion. So it's almost a halving of the trade deficit. And if you looked at our own poll was expecting 30 billion. So even compared to the poll, it's like 24 billion is a very good number. If you took goods plus services, then the deficit is only $7.5 billion, $7.28 billion. In the month of October, it was almost $22 billion. So that again looks very positive. The worry is about goods exports. Services exports have come as good as last month or last year. But goods exports was what we were worried, because dumping in Asia, US locked out for us. But goods exports are up 20% year on year for India. It's about over 38 billion against 31 billion year ago and against 34 billion in the month of October. More importantly, exports to the US are up by 1.3 billion. That was the one which we were worried about. Looks like if you take out all the exceptions and then the ability of Indians to compete in some areas, the export hit is not very much. So dealers are very happy to note that the fall in the deficit has come because the goods exports have done well, not just services exports, which were anyways doing well. But is that the end of pressure? No. The pressure continues because of the overhang of the trade deal, nowhere in sight yet, as well the FPI's non-stop selling. Every day you think that the market didn't fall so much yesterday. Will we get a good FPI number? And it is a sell. In fact, dealers are telling us they're selling out of bonds as well. Until now, at least bonds year to date is a plus $8.5 billion. But lately they've been selling because they're losing out on the currency. And therefore there is a worry. I mean, our worries have not gone away. There is also additional day-on-day pressure. Month ago, NDF market interventions by RBI are maturing today. That cast further pressure. RBI is supplying dollars, but it's not trying to protect any level. And that's why the weakness is not going away. There is a temporary relief.
Right, thank you, Lata. So, as Lata mentioned, a key overhang for the rupee is the uncertainty over the trade deal with the US. Commerce Ministry officials say both sides are very close to a framework agreement aimed at dealing with reciprocal tariffs. But the officials stopped short of prescribing a timeline. Now, India has also engaged with Mexico after the country recently announced a 50% tariff on goods from Asian countries, including India. Exports worth $2 billion to Mexico will be impacted by the new tariff. The Commerce Ministry believes the new tariffs are not targeted at Indian supply chains and is hopeful of signing a preferential trade agreement with Mexico compliant with the WTO rules. Let's talk about stock markets now. Dalal Street recovered from lows to end the day flat, but with a slight negative bias. Sensex fell 54 points while Nifty fell 20 points, holding on to the 26,000 mark. Banks batted for the bulls with the Nifty Bank Index ending in the green, while mid-caps fell in line with the blue chips. Now, home furnishings brand Wakefit made a muted debut on Dalal Street. The company's stock listed at par with its IPO price of 195 rupees a share. It ended in the red on day one. Remember, Wakefit's IPO was subscribed just over 2 times, led by retail investors and qualified institutional buyers. Staying with listings, pharma player Corona Remedies made a strong debut. The stock listed at a 38% premium to its issue price of 1,062 rupees a share. The company's IPO was subscribed 144 times. Walmart-owned e-commerce major Flipkart has got the green signal from the National Company Law Tribunal to shift its holding company domicile from Singapore back to India. This is a crucial step for the firm that is preparing for an IPO in India. The nod follows Flipkart's disclosure earlier this year that it was working towards relocating its legal base to India to better align its corporate structure with its core operations and business footprint, which are overwhelmingly domestic. The big national headline: the national capital woke up on Monday to another day of dense smog, with air quality in the severe category for the 3rd consecutive day. Now, Delhi's air quality index stood at 456, marking the season's 2nd worst reading so far. Stage 4 of the graded response action plan is in force in the national capital. The entry of trucks and other heavy vehicles has been curtailed. Schools have also been shifted to a hybrid model. Abhimanyu Sharma with this report.
A fog alert has been sounded in several parts of northern India due to decreased visibility, which has impacted travel plans severely, which has also exacerbated the situation which was persisting due to a deterioration in air quality. The AQI has fallen, which has led to imposition of GRAP 4 restrictions in the Delhi NCR region. Travel plans have been impacted. Speaking about cancellations of flights at the Delhi airport, 61 flights till now have been reported as cancelled, and 5 flights have been diverted so far. Now, both the airport authorities as well as airlines across northern India are working to resolve these disruptions and to minimize delays to reduce any inconvenience to passengers. Some days back, a fog alert had been issued by Air India, and they had indicated that an option had been given to passengers for a complimentary reschedule or a full refund at no penalty for weather-related delays. Indigo has issued a statement and has indicated that some flights may experience delays and few may be proactively cancelled to prioritize safety and minimize waiting at airports. Now, it's a dynamic situation. It remains to be seen how it's going to pan out in the next few hours, in the next few days, even as action is underway, not just from the ministry's side, but also airlines and airport authorities are working to minimize delays.
Right, Prime Minister Narendra Modi has departed from Delhi on a 3-day nation tour covering Jordan, Ethiopia and Oman. The visit begins in Jordan at the invitation of the King and coincides with the 75th anniversary of diplomatic relations between the two countries. In the second leg, the Prime Minister will travel to Ethiopia from December 16th to 17th, marking his first ever visit to the country. The final leg of the tour will take him to Oman from December 17th to 18th. The Ministry of External Affairs said that India and Oman share an all-encompassing strategic partnership rooted in centuries-old ties of friendship and trade. India's wholesale price index continues to tread in the negative territory for the month of November. According to Commerce Ministry data, food inflation contracted 2.6% against a 5% contraction in October. Similarly, vegetable prices contracted by over 20% compared to nearly 35% contraction in October.
Hello and welcome to News Center. I'm Parikshit Luthra. Today on News Center, we begin with two horrifying mass shootings, one at Brown University in the United States and the other at Bondi Beach in Australia, a major tourist attraction. At the Brown University, terrified students were seen running for lives, while others barricaded themselves inside classrooms. Following the shooting, 2 students were killed and 9 others injured. The person of interest who was arrested is expected to be released, with authorities citing a lack of sufficient evidence as search for the suspect continues. Meanwhile, Australia was rocked by a mass shooting at Bondi Beach that killed close to 16 people. A father and son duo allegedly carried out the attack, which is suspected to have targeted members of the Jewish community gathered for Hanukkah. This is the deadliest incident in the country since the post-Arthur massacre in 1996, when 35 people were killed. Meanwhile, Jewish Australians gathered near the site of the shooting, offering their condolences to the victims and their families. As per reports, a 50-year-old man who was also killed and a suspected second shooter have been hospitalized. The incident is currently under investigation. Australian Prime Minister Anthony Albanese said one of the gunmen in the Bondi Beach shooting was probed in 2019. Joining us now to take this forward is John Coyne of Australian Strategic Policy Institute. He's the head of the institute. Dr. Coyne, thank you so much for being with us on the program. First of all, what was the motivation for this attack and the level of planning that must have gone into this, according to you?
Look, the motivation on this was really clear. It was a targeted attack against Jewish people in Australia. It had one intent, and that was a cowardly intent to cause fear and disharmony in the Australian community. It was specifically designed at a family event, so the cowardly perpetrators of this attack were focused on causing maximum casualties of Jewish people, and particularly children. The fallout for this is absolutely significant. The tactics, though, weren't advanced. For some 3 decades, Australia has had the gold standard of gun laws, and as a result of that, the offenders didn't have access to high-powered semi-automatic weapons or automatic weapons. They were limited, and this could have been far worse. That said, it is a great tragedy and one of the greatest single tragedies in Australia's history in terms of these sorts of active shooter events and terrorism.
Dr. Coyne, we have been seeing how the Israeli Prime Minister Benjamin Netanyahu has criticized the Anthony Albanese government, saying that there have been incidents in Australia fueling anti-Semitism in the period leading up to the shooting. We've seen Jewish associations around the world, also in Australia, saying that there were anti-Semitic attacks and somewhere the government let its guard down. Would you agree that somewhere there was a gap in security preparedness?
Look, I think the issue here is not as clear as the terrorism issue. So, absolutely, 100%, this was an anti-Semitic attack focused on targeting Israelis or Jewish people. However, Australia over the last 18 months has been trying to struggle with issues here of that difference between free speech, the difference between free speech and hate speech, the difference between ideological crime and driven crime, such as attacks, physical attacks on residents and cars, etc. At the end of the day, my nation has been unsuccessful in dealing with the rise of anti-Semitism, and in some ways, that anti-Semitic behaviour, those regular protests that we see across Australian streets on weekends in cities like Melbourne, has normalised anti-Semitism to some extent.
There is also a lot of reportage on how one of the shooters involved in this terror attack, the 50-year-old man, he had been questioned earlier in connection with an ISIS terror cell, and this was some years back. So do you feel that somewhere there was an intelligence failure, that somebody who was on the books, who had been questioned earlier, went off the radar and planned something like this?
Look, the actual reporting seems to indicate that it was indeed his son with those connections. Now, there's a couple of factors with this. It's having spent some 25 years working in intelligence and then the last 11 years working in a think tank, it is so often that we jump to this conclusion that there must have been some sort of intelligence failure. First off, let's look at the heart of what intelligence is. Quite often, intelligence is having a 10,000-piece puzzle. You don't have the picture. They just give you 4 pieces, and you're meant to make out what the picture is. After the fact, when someone shows you a picture and then you look at the 4 pieces, it all looks incredibly obvious. Secondly, which is that with the rise of and continuing rise of terrorism, so many people in the Western liberal democracies especially have assumed that the global war on terror was over. In stark contrast, we see a return of the Taliban in Afghanistan. We see Al-Qaeda and IS both operating in Afghanistan. In the last week, we've seen attacks against Americans in Syria by Islamic State. They're active there, they're active across Africa. We see their activities continue in the Philippines, and we see a rise in right-wing extremism, white nationalism, violent misogyny, and the list goes on. Governments only have so many resources from which to monitor targets. They must make priorities, but there will certainly be significant inquiries to see why this person was deemed not to be a high priority threat or a high priority target for ongoing management.
Right. What do you think is going to be the fallout of this attack at Bondi Beach? The long-term implications on how the Australian government deals with the issue of terrorism?
Look, I think the Australian government in relation to this has been the gold standard of responding to terrorism. So over the last 25 years, whilst Australia has not been free of tragedy, it has been highly successful, its intelligence agencies and its police, and it's been the envy of countries like France, countries like the United Kingdom, Canada and the US in terms of preventing attacks. In this case, it didn't happen. In this case, unfortunately, terrorists only have to get it right once. In contrast, government authorities have to get it right all the time. The long-term impacts of this are hard to say, but what I will say is if you look over the video footage of this incident, what it does show is the greatest parts of Australian and the Australian nation. It most certainly demonstrates the bravery when an unarmed middle-aged man rushes across a car park at a gunman to stop him, where police who, after being shot at by terrorist offenders, they shoot the offenders and immediately begin CPR on them, trying to keep them alive, where people stop and throw their bodies over children to avoid them getting killed, where people hold their hands on wounds and provide first aid, where our first responders race towards the incident. So in many ways, these terrorists have shown the strength of Australia. Moreover, this evening, we've seen memorials at Bondi Beach where Jewish people, Muslim people, where Christians are all gathering. And they are all mourning this terrible incident. So in many ways, it is bringing Australia together, and the terrorists have failed to bring about any sort of fear in the Australian population.
Right. But Dr. Coyne, do you also believe that somewhere it will have an impact on the politics in Australia?
I think it's inevitable that it will have an impact on politics in Australia. There can be no doubt when an incident like this occurs, the general public expects their governments, be they at the state level or the federal level, to act quickly and decisively and assure the security of its nation. There will be many questions asked, and certainly in these early days, it's too early to say what the full picture that led up to this attack, whether or not there were errors made. But certainly one of the things I'm pushing here at Australia is we need to have a Royal Commission. The Royal Commission needs to look at both the attack on Bondi and the events over the last 18 months in terms of the rise of anti-Semitism in Australia. And we need to have those decisive answers from which good policy can be developed.
Right. Dr. John, my last question to you would be, would you think that this was limited to a plot hatched by 2 or 3 people? Or do you think there could be an element of international conspiracy? I'm sure the Five Eyes which Australia is a part of, would already be working together behind the scenes. But do you think there is an element of an international hand?
Look, I think there is most definitely an ideological connection between this horrendous event and attack and between the Islamic State. We know that an Islamic State flag was found in the car of the offenders at the incident site. We know that the youngest offender had links and had links to Islamic State that date back 6 years. So, look, there are some very clear indications. Certainly evidence over the last hour or two has revealed that that both the father and son had travelled to the Philippines for a month. So there are certainly ideological links between this attack and Islamic State. How deep those linkages go, I think, will remain to be seen, and those the sort of details that we'll see coming out over the coming days and weeks as Australia's law enforcement agencies and intelligence agencies continue to undertake their investigations and chase down every single link, every single possible clue, every single line of inquiry to ensure that if anyone else was involved, they are brought to justice.
All right, Dr. John Coyne, thank you so much for joining us on the program, giving us your view on that terrible terror attack that has taken place in the Bondi Beach, and hopefully the perpetrators will be held accountable and brought to book. Thanks once again for being with us. That's all the time we had here on this segment on News Centre. Thanks for watching. Goodbye.
Hello and welcome to Startup Street. I'm Arundhati Ramnin, and with me are Shruti Mishra and Ritu Singh from the Bangalore studio. These are the top headlines from the startup space. Flipkart receives NCLT approval to shift the domicile of its holding company from Singapore back to India. Gets set for a potential IPO. The e-commerce major had mentioned earlier this year that it was working towards relocating its legal base to India.
Home furnishings brand Wakefit made a muted debut on Dalal Street. The company's stock listed at par with its IPO price of 195 rupees a share. It ended in the red on day one. Wakefit's IPO was subscribed just over 2 times, led by retail investors and QIBs.
BizData announces 50 crore rupees fund to back women-led startups across India. The newly announced fund will support early stage and growth stage women-led ventures with strategic capital, mentorship and access to expert networks.
Legal tech startup Lawyered has raised 8.5 crore rupees at a 120 crore rupees pre-money valuation. The proceeds will be used to drive product innovation, expand its technology infrastructure, deepen nationwide distribution, and strengthen brand visibility.
Tesla's board of directors has earned more than $3 billion through stock awards that far exceeded the value of those given to peers at the biggest US technology firms at the time they were paid, according to Reuters. Tesla's spokesperson said its directors' compensation is not excessive but directly tied to stock performance and shareholder value creation.
Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Furniture and home lifestyle brand Furlenco has raised 125 crore rupees in fresh equity from Sheela Foam with participation from marquee investors Madhu Kela and White Oak. Founded in 2012, Furlenco has turned profitable in FY25, posting 240 crore rupees in revenue and a 3 crore rupee profit after a 139 crore rupee loss just last year. With over 1.5 lakh active subscribers and more than 10 lakh homes furnished, the company says it is entering its strongest phase of growth, backed by an aggressive push into new cities, offline stores and omni-channel expansion, as it readies itself for a public market future. Joining me now is Ajit Mohan Karimpana, founder and CEO of Furlenco. Ajit, welcome to Startup Street. Like I mentioned, FY25 was a major turnaround year for Furlenco. 240 crore rupees in revenue, 3 crore rupee in profits from a 139 crore rupee loss the year before. What changed, Ajit, fundamentally inside the business to deliver that swing?
Thank you, Shruti, for having me on this show. Well, grit and determination is what I would say, but no one silver bullet that got us here. Minus 130 plus crores is the right number. What we first did was to pare down our debt with the equity that we raised in the previous round, which is about 400 crores from Sheela Foam. Bringing the debt down automatically meant that money was not going to lenders, but it was staying in system. That money we used to invest in our infrastructure, mainly set up our manufacturing setup, our refurbishment centers, our warehouses, and things like that. And most importantly, in our technology, where things like our routing algorithms and our supply chain were strengthened. All of it put together meant that we started becoming positive in terms of cash flow and ultimately profitable. So no one silver bullet, but everything put together brought us to this last year, which was about 3 crores.
All right. Ajit, Furlenco has just raised 125 crore rupees. You plan to deepen your presence in existing cities, expand into new markets and invest further in product innovation, tech and customer experience. What's coming next on the product side, and how do you plan to scale your offline and omni-channel footprint?
Sure. So let me start with the second part of the question. So as you know, Sheela Foam is a big investor in Furlenco. They are giving us access to their dealer network. They have about 5,000 plus dealer network across India. So we would be slowly but steadily getting into their dealer network, and through them we will be providing our services, which is rental services mainly. So that is going to be one big push from a retail presence. Second, in terms of category itself, we are now focusing more on premium side of furniture. So we call it the premiumization of the rental model itself. We believe that as the nation is growing, growing towards the next $1 trillion, $10 trillion kind of an environment, we need to provide the most premium services when it comes to rental. So premiumization of furniture is something that we'll be focusing on. Kids is another area that we are actually getting into. We believe that kids grow up. So why buy furniture for kids, but rather get them the best possible pieces of furniture for them to keep growing on. So kids is another category that we are going to be getting into. So together is how we're planning to go.
Okay, so premiumization of furniture and the kids, those are the two areas that you're looking now. Furlenco's subscription-led asset-light model, let's talk about that. It was once seen as capital-intensive and risky. Has the market, Ajit, finally caught up with your thesis, or have you had to rethink the model along the way?
We stood by the model. We can't escape the fact that this is an asset-heavy business. Asset light maybe for the business by keeping the assets outside in some other book, but at the end of the day, it is debt. Keeping the asset outside the book basically means that you're adding to the cost of the debt finally. So as of now, all of our assets are back into our books. It'll continue to be there, but the fact that we're generating about $1 million of cash per month is helping us get our cost of debt lower. So we'll continue to be on the same model.
Okay. The furniture and home lifestyle space is crowded. We have D2C brands, marketplaces, local carpenters, and now even quick commerce players are eyeing furniture. What is Furlenco's real moat today?
We are actually playing in the blue ocean. I think we are the first ones. The rental category is the first set of industry which people enter into when they want to get access to furniture. So once they are done with us is only when they think of buying. So the biggest moat is the fact that we are the first choice for people more and more as time goes along. Second, this is not an easy business. You're talking about reverse logistics, refurbishment of furniture, etc., etc. So all of this means that we have a very large moat, and the fact that we already have 1.5 lakh homes subscribing from us, that's a moat that cannot be easily beaten. So yeah, all of them put together makes us much larger business than compared to some of our other selling businesses out there.
All right, Ajit, with over 1.5 lakh active subscribers and more than 10 lakh homes furnished, scale brings a new set of challenges. What would you say is your toughest one right now? Retention, logistics, or customer experience?
Customer experience is one of the tougher ones. Unlike people who buy furniture, when it comes to rental furniture, you want it yesterday, literally. So getting the furniture as fast as possible into people's home and at the same time pick up the furniture efficiently is a very tough problem, which we are solving, continuing to solve, but challenges in the customer experience remains. But we are responsible. We are continuing to improve on that. And by the time we get to IPO, we should be a fantastic company to invest in.
All right. You've spoken about being public market ready over the next few years. In fact, Wakefit recently listed. It just listed. What metrics matter most to you at this stage? And when Furlenco eventually rings the bell, how do you want the market to describe you? A furniture brand, a lifestyle platform, or a subscription-led consumer tech company?
I would say furniture brand first, and then that subscription-led technology company. But primarily, I think NPS is going to be the biggest driver. Do people like this brand? Do people want to rent furniture? I think that's what matters at the end of the day. Not revenue, not profitability. If people are happy, then automatically revenue comes in, automatically profit comes in. So I would say NPS.
All right. On that note, it's time for me to wrap up our conversation. Ajit, many thanks for joining us on Startup Street today and wish you the very best for all your growth plans.
Thank you.
All right, we'll move on to D2C plant-based nutrition brand Earthful, which has raised 26 crores in its pre-Series A funding round, which was led by Fireside Ventures and We3 Ventures. Now, Earthful is building natural solutions that are designed to make nutrition less intimidating with a focus on menopausal women's health needs. In the last 2 years, it claims it has built a customer base of more than 2 lakh customers already. Now, these funds are going to help them deepen the product portfolio for women's health, along with team expansion in Hyderabad and Mumbai to support the next phase of growth. For more on this, joining me now is Veda Gogineni, the co-founder of Earthful. Veda, welcome to Startup Street. Thank you for your time here. Begin by telling us about what led you and your sister when you were out of college to start this venture and the size of the opportunity you were chasing and why the focus on menopause as the core mission.
So thank you so much for having me on the call. And so my elder sister and I, we graduated out of IIT Kharagpur. We studied chemical engineering and biotechnology, both being science students. After 7 to 10 years of experience in corporate field, we around 2020, when we entered our 30s, we started experiencing a lot of nagging health issues like your knee pains when you're doing yoga, or you have acidity when you're taking your tea and coffee, right? So we realized that there was still something missing in the pie of health. And that's when we went deeper into nutrition space. With the larger market size that we're going after, nutraceuticals has, done about $30 billion last year. And menopause is a category which has been deeply underpenetrated, and no solutions have been made for women above 40. Women spend literally half their lifetime in this phase, and very less focus and research has been done for solving for this life stage. And it's expected that there'll be close to 350 million women in menopausal phase by 2030. So that's what we are going after.
All right, that's interesting that you went through something personally and decided to solve for it. But now that you've raised this 26 crores, Veda, from Fireside and V3 Ventures, how exactly are you going to deploy this capital? Whether that is product development, team expansion, omni-channel growth, tell us what specifically your plans are.
I think we want to go more deeper into specific women health concerns. So our product portfolio, we want to go further into specific issues that women face post this life stage above 40 years. And also we are targeting specific ingredients also, like protein category. Also, we've created very novel solutions with minimal clean ingredients. So we want to expand on the clean label market focused on women's health. Apart from that, yes, team expansion. We have 2 offices in Hyderabad and in Bombay. Our marketing team in Bombay, we intend to expand it even further. And we also want to have larger focus on brand building as well, so that there's more word out there about Earthful and more women can benefit with the novel products we have created. We've been the first who created a multivitamin which is specifically customized for 40 plus women. We've added certain herbal ingredients like your shatavari and gokshura, which are known to have phytoestrogens, which specifically solve for your hormonal imbalances. So we want more women to benefit from these solutions, and the word spread out larger.
All right. But Veda, let me quickly ask you about your product portfolio. I mean, currently what you have is you're addressing nutrition gaps across age group, but you say the focus is on the 40 plus segment, and you're targeting solutions for skin, hair, and sleep. How will this product portfolio evolve as you grow? Can you give us a sense of what kind of a pipeline you have and some of the fastest growing categories you're seeing, or market gaps where you want to bring in new products?
Right. So I think for the 40 plus women itself, we want to go into more specific areas in which they're facing certain issues. So that will expand much further in the next 6 months. Also, these products such as hair, skin, or sleep issues, these are also specific areas in which women are facing concerns on a day-to-day basis. A lot of them complain about, sleepless nights or not feeling very rested. So our product on sleep is a herbal solution which calms your nervous system down. Hair and skin are also areas that get affected due to hormonal imbalances. So these are like very specific health areas that we've created more customized solutions. But at the same time, for 40 plus women, they face symptoms such as hot flashes, your knee pains, night sweats, and irritability, mood swings, brain fog. The list is endless, vaginal dryness, right? And these are areas which have been very less researched. The options available for women in the market are also very limited. So we are extensively researching on plant-based ingredients, which have like clinical backing in the modern science. And we are creating like unique formulations to solve for each of these concerns that they're facing and to help them manage better. Because whatever we add are your vitamins, minerals, and herbs, right? And these are within your daily dosages. So this helps them in their daily supplementation and help manage the symptoms better.
Veda, I wanted to ask you, I mean, in the last 2 years, you say you've grown about 3 times. You've already built a customer base of 2 lakh, sort of consumers. But give us a sense of, in terms of retention, in terms of bringing your own brand and building that brand and moat in the market, what are some of the levers you have in place? I mean, it is a fairly crowded market. Every makeup company wants to be a skincare company now. The whole pharma market, of course, is large, fragmented, unorganized, and of course, there's the organized players. where are you going to find your right space, and how do you hope to grow this current customer base of 2 lakh?
I think the biggest moat we have is we have a razor-sharp focus on our positioning of being a plant-based brand with also a very clean label. We do not put any excipients in the product, no binding agents, caking agents, or any unnecessary ingredients that do not help in your nutrition, including our capsule shell, which we are sourcing it from pine bark, and it's a vegan capsule shell. So I think this clean label and ingredients which are very like garden and kitchen ingredients, like your vitamin C is from amla, vitamin A from moringa, your B12 is from spirulina. So these are ingredients which women understand, they relate to, and they're able to trust. I think that is why we were able to also very boldly tell the consumers that read the label, right? And there are very few brands in India right now who have this boldness to ask the consumer to read label. And this, I think this positioning will keep us sharply differentiated from the others.
Well, Veda, that brings me to my final question. I mean, going ahead, what are the ambitions for Earthful, this market that you're describing? How much of the market share do you hope to command in this broader Indian nutrition and wellness market space, say in the coming 5 years or longer?
I think the broader vision is we want to be India's most trusted plant-based nutrition brand. We want to reach more and more women households, and eventually expand into other segments as well. Nutraceutical market is quite big. It's already $13 billion now, and it has overshot the projections of $17 billion of last year. So the idea is like we need to become a leader in some of the segments in the next 5 years. I think the idea is to at least hit the 500 crore mark and help serve more women manage their health concerns on a day-to-day basis.
And we wish you the best with that, Veda. Thank you so much for your time here today on Startup Street. Thanks very much.
Thank you.
On that note, it is time for us to head into a short break. But coming up next, Uolo bags $7 million to double down on its Gen AI offerings. We unpack the opportunity, the scale-up, and what's next for the firm on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. Education is one of India's largest and most complex markets, but learning outcomes often break down outside the classroom. UOLO is trying to fix that gap using AI, working directly with schools to extend structure, discipline, and learning continuity into students' homes. The company now partners with over 2,500 schools and supports more than 1.1 million paying students across the country. With a fresh $7 million pre-Series B round led by 5 Sigma, UOLO is doubling down on Gen AI learning companions and deeper school integration. To unpack the opportunity, the scale-up, and what's next for AI-led education in India, I'm joined by Pallav Pandey, the co-founder and CEO of UOLO. Pallav, thank you so much for taking time and being here with us on Startup Street. Take us back to the early days of UOLO, right? What problem in K-12 education were you trying to solve, and why did you sort of believe adherence and not content was the real gap in India's learning ecosystem?
See, the problem in K-12 education, and it is very different from the test prep market, has always been the same, that the child does not want to study. It is us as parents who want the child to study, but the child does not want to study. So what the society has done, it has created the infrastructure of schools where the child goes and incrementally learns slowly over a 15-year-old journey. And that, I think, fundamentally the problem of getting an uninterested child to learn systematically over a long period of time is the problem that UOLO wants to solve. And it has to be done in partnership with the schools. So that is what we are trying to do.
Sure. And India has over 25 crore K-12 students, right? With private schooling growing rapidly. So how big is the opportunity that UOLO is targeting, and which segments, urban versus semi-urban, primary versus senior classes, are the most critical to your growth thesis?
So you're right in saying that India has about 25 crore children in K-12 school. And what is very interesting is, unlike anywhere else in the world, India has got the largest percentage population. Almost half of these students are studying in a private school. So that makes it very, very different from anywhere else in the world. And I think it presents unique opportunity and challenges both. In terms of market size, there is an existing spend of about $30 billion that parents are spending in India for school education, and a large part, or not a large part, but a small part of that, about $3.5 billion, is being spent on content. And all of this is actually going to change in the AI world. Schools will continue to be there, but the way the education works in terms of getting hyper-personalized, that is what we can expect in the AI age, which we will see in next few years.
Sure. And you've raised the $7 million in pre-Series B round led by 5 Sigma, right? How will this capital be deployed across your product development, school partnerships, and expansion beyond your current school footprint?
So basically, two avenues will be there for capital deployment. The one is development of the product portfolio. So we want to double down on our AI product offerings. And number two, we need to grow our school network. So that is where the capital will get deployed.
Sure. And YOLO's AI works as a learning companion integrated into the school day, not just a standalone app, right? So what's next on the product roadmap, especially around Gen AI-based companions and learning continuity between the classroom and home?
So see, the core problem, like I mentioned earlier, is around what we call as adherence, getting the child to study day after day, every day, and maybe a little bit. And it has to be, accompanied with overall growth and going out and playing and all of that. But, child needs to study every day. And to make that possible, what we are doing is introducing a concept of our AI companion that the child can partner with, who can encourage the child a little bit every day. And that companion has all the context of what is happening in the school. So that is the imagination of this AI companion that we're developing. And we're getting exceedingly good response from the schools that we are partnering with for this kind of a product.
All right. And can you give us a sense of YOLO's current revenue run rate and how you sort of see revenue scaling over the next 12 to 24 months as AI adoption deepens within schools? Like, what's the target that you set for yourself?
So right now, we are at a scale of about 103 crore rupees. And over next 2 years, we think this number can be anywhere between 4 to 500 crores.
All right. And EdTech is a crowded and often trust deficit space. So what is YOLO's real moat today? Is it school-led distribution, curriculum integration, data depth? What's working for you guys in staying ahead of competition?
I think the fundamental problem with EdTech is that nobody was able to solve for adherence. So while parents purchased expensive products, the children never bothered to study because they never really wanted to study. But when you partner with school, you fundamentally solve the problem of adherence. So teachers make the children accountable to spend time on these apps so that child can learn a little bit more than what the child already knew. I mean, fundamentally, right, the consumer technology developments that we have around making apps more fun, that is not what will work for EdTech. And that has, I think, been the problem all along. I think partnership with the school is really our moat in this market.
All right. And looking ahead 5 to 10 years, how do you want YOLO to be positioned in India's education system?
I think our aspiration is to make YOLO the most important education company in India and hopefully outside India in developing markets as well.
And what are the markets that you're eyeing outside of India right now? What's the expansion plan?
So nothing right now. I think it's more of a ambition. I mean, if we can solve for India, and which is a hyper-competitive market where the cost pressure is very high, if we can solve for India, I think we can surely solve for Africa and Southeast Asia. But right now, like completely, we have put blinders and we are focused only and only on India. And within India, the private school market.
So you've got the blinders on and you're focused on the India market for now. All right, Pallav, thank you so much for taking time out and being here with us on Startup Street.
Thanks a lot for having me.
Well, with that, it's a wrap from Ritu, Arundhati and me on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
frugality drives innovation just like other constraints do. One of the only ways to get out of a tight box is to invent your way out of these. Words from Jeff Bezos will echo with my guest today, a man who's invented and innovated his way to building profitable brands from commodities. A self-confessed lifelong learner, Harsh Mariwala's journey is unique in many ways. But perhaps what stands out the most given his peer set is his ability to step back and hand over the steering wheels of the company that he built over 3 decades to a professional. And in doing so, he believes he stayed true to his rule that the organization comes first.
Sometimes you win, sometimes you don't lose. You always learn. The family promoter thinks that he knows it all, that he has to be in control, you know. And I think that's wrong, and that his children has to follow him, you know.
Was the conversation that you had with your son about the decision that you took probably one of the hardest things that you've done?
With my son as with my wife, yeah. It was tough. Socially also, when you go out, how come you didn't appoint your son? At that time, he was not fully ready. I am completely against Jugaad, because Jugaad is coming out of a certain necessity, but it cannot be scaled up. India cannot be
a Jugaad nation.
Jugaad nation.
What are the non-negotiables when you acquire a company?
Each acquisition has to be done differently. In some of the D2C brands, we have allowed the promoter to continue. So it's important to be flexible when you acquire.
It's interesting that you talk about emotional connect as one of the things that you've incorporated now into culture.
So I used to hear from many of my colleagues who had joined from outside, oh, this company, there is so much of bureaucracy, there is politicking, there is backbiting, there is gossiping. Because a lot of workplace pressure, a lot of workplace mental health issues can be tackled if you have the right culture. A right culture where there is high degree of openness. If I have to say something to you, I don't like something about you, I should be able to tell you on your face.
What is it that you don't know about your dad? See, now.
He'll write down the minute details of things that he has to do.
Really?
Yeah, it'll be like...
He has a diary or something?
Like a daily sheet. And he's got really bad handwriting, only he can understand. He write it down and then he'll erase it, or he'll start tearing those pieces. His best buddy on the golf course is his caddy, the guy who carries his thing. All his golfing buddies know that
he's the keeper of all secrets,
exactly.
Sir, you can come in.
Okay.
What is the best piece of advice that you've given him? You think, in your view, and I'll ask him what he thinks is the best piece of advice.
He will not like it, but I think he was in Dubai for the last 4 or 5 years. And I told him to come back.
Come back home. So was that a contentious decision?
It was.
It was?
Very.
Yeah? So you wanted him back and you didn't want to come back?
Correct. But I said,
But
all the businesses...
pretty much like your father, right? You wanted to do an MBA, he didn't want you to study abroad.
That's very different.
How different are the two of you?
Very different, I think. I'm not... I think he's more what I call a 5-star army general. With discipline, structure, punctuality. I'm more of an investor, so I enjoy, living vicariously through other entrepreneurs and seeing their journeys.
Joining me today to talk about his mantra for success, scale, innovation and well-being is the man himself, Harsh Mariwala. Many thanks for joining us here on The Leadership Language. It's a pleasure to have you join us here on the program today.
Thank you, Shirin, and thank you for having me over in this program. So I'm delighted and thrilled.
This wall here perhaps encapsulates the many mantras that you've lived by or used to drive America. But there was one that I saw there on the extreme right, which said that faith is when you take the first step before having the ability to see the full staircase. And that's what I want to start with. Your ability to let go, your ability to step back, hand over the reins of the company that you built as a first-generation entrepreneur. And I say first-generation entrepreneur because you didn't do what your family business was doing. How hard was that? Because this is not usual.
So, very good question, Shirin. And I think if you look at Indian businesses, there is an expectation that your children will step into your shoes in terms of the role. My son also thought that he will step in. My wife also thought that he will step into my shoes. But I deviated from the normal practice of putting my son in my role. And I did it because of one, I used the thumb rule, and that's the thumb rule I always use. There are always conflicts between an organization's interest and any stakeholder's interests, whether it is the promoters or the employees. And the key thing which thumb rule, the organization interest comes first.
Yeah.
And that's the thumb rule I use when Shogata, who is the current managing director, came to me and asked me whether is there an opportunity for him to play or to become the MD, because that's his ambition. And I discussed that with my board at that time, and the board felt that, yes, I had steered the company for many, many years. I founded the company, and now it was time for me to step down and give him the reins. And most promoters think that they know it all, and there is nobody better than them. And I disagree with that. There are always individuals you can find, and you should try and find who could be better than me. So I was not expecting this from my personal time spent, because I can't relax. I don't know
how to relax.
How to the habit of doing nothing. I cannot just not do anything. I have to be occupied on a perpetual basis. And my wife and I discussed with her, saying, you are not sitting at home. So it was very clear that I'm going to go to work, even if I step down. And it's almost now 11 years I've stepped down. It's been a very good decision, because at one level it has helped me do a lot of things which I never thought I would do. So for me, every moment is different. Whether it is a new business I've started, or whether I'm helping my son in his own business, or philanthropic issues, or on boards, or writing a book, or speaking at various events. So my diary is full. And I still spend time on the business, but it's about 20%, 25%. I manage the board. The CSR part of Marico Innovation Foundation reports to me directly, because I wanted the managing director to concentrate more on the business. So that reports to me directly. But I went through a lot of struggle in terms of the decision itself. What will I do? What will I tell my family? And of course, my wife and my son were unhappy that I did this. And socially also, when you go out, how come you didn't appoint your son? At that time, he was not fully ready. And I decided to take this step. But as I said, it's worked out well. It's worked out well for the organization. Our overall valuations have gone up. And the most important thing is my son has started a new business, which if he had stepped into my shoes, he would not have started. And the best thing is that the business is done well. So now he can claim that this is my baby. And our equations have improved dramatically over a period of time. At one point, we were like, not adversaries, but we had our own set of frustrations in dealing with each other. But now we are completely aligned. And now I am grooming him to take over Marico chairmanship from me over a period of time.
In hindsight, the decision worked out.
Yes.
But at that point in time, when Shogata had that conversation with you and said, look, my ambition is to become the managing director, you could have very well said, and I know that you were not ready to give up at that point in time. What made you say that this is the right thing to do for the organization, knowing fully well that you wouldn't have the buy-in of the family, you wouldn't have the buy-in of your son and your wife and others?
So I think two things. One is we had to retain him. If he had not given him that role, he would have left. And he had made it very clear that he is ambitious, and which is fair. I think every person has their own ambition, and if that ambition is not fulfilled by the current organization, then that person should leave. So he would have definitely left. And I think he was a very prized asset in terms of his capabilities. So we had to retain him. Number two, the company also needed a new set of thinking. And I think that also came in, because I think they say you have to change the CEO or the leader every 10, 15 years. But here in this case, I built the business from scratch, and I was managing the business from the time its inception, from 30, 40 years. So it needed a new lens. So I think, and then the board also felt that I should do this. So I think a combination of these three made me take that step. But I think more important thing is after that taking a step, the board said that you promoted him, but there is a tendency amongst most promoters to interfere on a day-to-day basis. So the MD on paper is not empowered. There is constant interference and
the backseat driving.
Correct. So the board wanted to avoid that, and they asked me to have a statement in terms of role clarity. What will I do? What I want to do? What will the MD do? What he want to do? And when will he come to me for decisions? So the document is so much in detail.
Did you draw it up?
We jointly drew it up. I drew it on my own. He drew it on his own. We exchanged notes, and it's working wonderfully well. So things like I will not participate in any investor meetings. I will not do anything, any PR about Marico per se. I will talk about macro issues, about my own journey, but Marico related PR I will not part. So that's his baby because he's managing the business. I will not go into day-to-day functioning at all, but there are certain things I will manage, like the culture of the organization. Like I'll do skip level meetings. I will interview people who are going to report to him. I will have review meetings every month, but most of my work will be done through the review meetings of two hours, and not on day-to-day basis interference. Some of the acquisitions, key decisions will come to me. So it's worked wonderfully well.
I think part of why promoters hold on well beyond they need to, well beyond perhaps in a crude way, their expiry date, is to stay relevant. I think the fear of being irrelevant often drives, and ego drives the decision to stay in the seat, to stay in the saddle. Was that a concern for you?
Not really, because I'm staying relevant because I still do a lot of outside, and I go market visits, which is not a day-to-day work. So I get my inputs from there. I read a lot.
You still go on market visits?
Yeah, I still go on. Once a month, I go on market visits. I interact with the customers, shopper behaviors, and things like that. So I do all that. I review meetings at all our international locations once a year. Just 2 days back, I went to R&D. So once in 6 months, we have a review meeting with R&D. So there is structured involvement, not day-to-day basis. Nothing comes to me for decision. And I think the biggest problem with most promoters is that ego, which is driven by the fact that they think that they know it all, which should not be. Because the organization will have to continue on a long-term basis, even when you're not there. And I believe in perpetuity of an organization. I don't believe that the business is to be built and then sold. And I'm not the serial entrepreneur type. So if that organization has to last much beyond me, you have to create certain values, culture, talent, and I think only that can only come in when you start delegating, empowering people.
Was the conversation that you had with your son about the decision that you took probably one of the hardest things that you've done?
It was tough with me, for my wife, with my son as with my wife. It was tough.
How did you repair that relationship?
So I think over a period of time, things just
fell into place. He
started doing well. So it got accepted initially. That acceptance is still, at that time, it was hard, but over a period of time that...
one of the other things that is often associated with you is the focus on what is called frugal innovation. And I don't know how you describe what frugal innovation means to you or what it's meant to you through the course of your journey and through the evolution of Marico. But, when you look back at how your journey shaped, the role of the kind of innovation that you decided to focus on, would you attribute Marico's success in large measure to that?
So if you look at our own journey from the time we started, and much before Marico also had part of Bombay Oil Industries, when I started our Parachute and Saffola brands and scaled it up over a period of time, the most important times when we had a massive spike in our sales or market shares was when some innovation succeeded. And mind you, many innovations have failed, so everything doesn't succeed. But that just reinforced in me the need to innovate on a perpetual basis, because you'll innovate, it's a matter of time, others will copy, you're bound to copy, which is fine. But you have to be 2 steps ahead of others. So you have to continuously go on innovating. And my belief in innovation just went on getting reinforced. So the frugal innovation sometimes is mistaken for the jugaad. I am completely against jugaad, because jugaad is coming out of a certain necessity, but it cannot be scaled up. India cannot be
a
jugaad nation. I mean, it's okay. You're taking some shortcuts, but that's fine. It's good to talk about it, good stories, making lassi in a washing machine and whatnot, but nothing beyond that. So, but I was very clear that we had to make Marico an innovative organization on a perpetual basis. And that can only come in when you create a culture of innovation, where innovation is thought by each and every person within the organization. Each person thinks, what can I do it differently? Each person is willing to experiment, doesn't have the fear of failure, because the biggest deterrent to innovation is the fear of failure. You don't want to take a risk. What will happen if I fail? So you have to give an assurance to your talent that it's okay to fail. Many experiments will not succeed, but it's okay, because you can't go on determining your future journey based on market research. There is no shortcut to actually testing your product in the market.
You're not a big believer in market research?
I'm not a big believer. Yes, you're right. But sometimes market research is just done to confirm your certain thoughts. You can't arrive at a strategy based on market research. I'm not in favor of. But yeah, if you have certain thinking, you may just confirm that, okay, market, and then say, okay, this is my thinking. It's getting confirmed by this research. But you can't say, I want to do a market thing on, launch a product based on market research. That I'm not. I think that can only be done through consumer insighting, which is different than market research. You have to actually go and meet the consumers on your own and go deep into consumers' mind in terms of what's the latent need which is missing at the consumer. And whether it's health related or whether it is beauty related, we are seeing certain trends in the environment coming in from either from developed countries or now from a lot from Korea also. You can see skincare, food coming in from Korea. You have to continuously keep track of those trends and try and find out what will work with the Indian customers.
course of the journey, what would you say have been some of the most significant innovations that you made, that you decided to bet on, that changed the trajectory of the company, and those that you thought would work but actually failed?
Yeah. So if you look at a brand like Parachute, we just started with coconut oil, and then at that time it was intense. We converted the whole market in plastics. We again rolled out all the innovations in Bangladesh. In that market, we have 80% market share. And then we used the property of coconut to go into other skin, hair care products. So I think that's the whole journey of Parachute and its extension. And now we are seeing it at a global opportunity in terms of leveraging coconut as a superfood in other developed markets. Hair oiling in other countries also is catching on in developed markets. So can we tap that opportunity? So through the Parachute brand name is something which has evolved quite a lot. And similarly with Saffola, started with oils, we went into blended oils, and now we have cold pressed oils also, and then into foods also. So we've gone to oats, masala oats. We have a whole range of Saffola honey, Saffola muesli. So I think leveraging those brands into related areas through extensions has played an important role, But we have failed also. We thought we launched fabric softeners, and we launched it at that time. I'm talking of 30 years back. We were too ahead of our times.
Yeah.
Now the fabric softener market is caught on, but we launched it. So timing also plays a very important role in terms of when to launch. And you do it too prematurely, and then the market is not ready.
Yeah.
So the right timing is, now it's become a big category.
As you look at where Marico finds itself today, and the market has changed, consumer habits have changed, consumer behavior has changed.
Yes.
What excites you about the opportunity, but also what worries you about the change that you're seeing?
So I think you are absolutely right that the consumer habits are changing very fast. Earlier, there was to be brands which were for family, then became quite personal. And in terms of marketing language, we used to call it segmentation. Now there is micro-segmentation with the emergence of D2C brands. So there is a huge discontinuity because of technology, because of consumer habits. And I think you have to look at it from two windows. What is the threat to your organization? You have to protect that. And what is the opportunity arising out of those discontinuities? And I'll just give you an example of D2C brands. FMCG as a sector is perceived to be very defensive because you needed big money to create a brand through television, through press, and the kind of budgets you needed to launch a national product would be in upwards of 20 crores. You needed a huge distribution network to tap into all of India in rural area and going into millions of outlets. Very difficult for any newcomer to get that, to spend that money unless one is willing for a huge long-term sacrifice. So in a way, we were in a cocoon where we didn't see any new competition coming in.
Yeah.
Come all of a sudden D2C brands, and
the competitive landscape has changed.
Changed completely. You can do digital marketing. Your budgets could be 1/10 of the FMCG budgets. You can go through marketplaces, social media, then you go to Amazon, e-commerce initiative. Now Q-commerce coming. So all of a sudden, because of those entry barriers going away. So there are two ways of looking at it, as I said. One is threats. So how do you protect your current businesses? Of course, you take what was action is needed. But more importantly, what are the opportunities arising out of D2C threats? So we acquired 4 brands in the last 3 years.
Yeah.
And today, annualized turnover of those 4 brands are upwards of 1,000 crores. All of them have scaled up very well. But we have managed that very differently because the mindset required to manage a D2C brand is very different than the mindset required to manage an FMCG brand. So different team, much younger, very digital savvy, small budgets, a lot of fast reaction time.
So they're islands within the Marico universe.
Yes. And I'm glad we did it that way because if we had combined with the FMCG marketing, it would have not worked out because they have abundance in terms of budgets. Here you have frugality in terms of the budgets and the way you work, very, very fast pace of action. And we also have our own D2C brands.
Yeah.
So I'm just giving, so this was a threat and we turned it into opportunity. I think we may be the most, if you look at all the FMCG companies, we may be the most aggressive in terms of acquisitions, in terms of number of brands we acquired.
So do you believe that given the landscape that you see today, as well as the fast-paced changes, that building is perhaps harder to do versus buying? Do you think that it's easier to buy your way to market share or build your way to market share and new categories?
So I think you're talking about acquisitions, which is, and I strongly believe in growth, okay? So growth has to be the most fundamental part of any organization. Growth has to be sustainable, it has to be profitable. And acquisitions, sometimes, many companies think that acquisition is very sexy because it gets talked about.
Yeah.
You get a lot of visibility. But I think you should be clear why you're acquiring a brand. Is it to get into new category? Is it to consolidate your market share? Is it to enter a new country? So we've made something like 25 acquisitions. And I think overall our success rate in acquisitions is much, much higher than the perceived success rate of overall global acquisition success rate. They say is roughly about 30%. And failure rate is 70%. In our case, it's more than 80% is successful. Because we are very clear why we are acquiring. Now to answer your question whether should we look at organic or inorganic growth, I think you have to pursue both. You can't just say, I will only look at acquisition, because you may not get an acquisition. Or you may get an acquisition which may be very, very expensive and you may not want to pay that kind of a price. So you just can't say, I think organizations have to look at organic, inorganic, because once you acquire a company, again, it has to go through an organic route of expansion.
Exactly.
So organic capabilities have to be there. In some of the D2C brands, we have allowed the promoter to continue. So it's important to be flexible when you acquire. You can't say everything I want from day one, because if I told that promoter that please sell 100%, they would never have agreed. They want to continue participating in that journey for 2-3 years. They want to see an upside, and also have patience when you integrate acquisitions. You just can't behave like a cowboy that day one you acquire a company and start changing, because that company has certain strengths, certain people strengths also. And you can't just create that fear in the people that, okay, we are going to change everything. You have to go deeper, and then, of course, over a period of time, what's not working well, you have to change. But you can't from day one start changing things. The other thing which we say is that governance play very important. Some of the companies we acquired had very bad governance. On that, we will not compromise.
And that brings me to the question on culture, because I know that you see yourself as the custodian of the culture that you've helped create and build here at Marico. And culture is not just compliance with what the regulation wants you to do or mandates you to do. It's much more than that. Why has culture meant so much to you from the very start? I know that you believe from day zero that governance should be part of your preamble, as a company. What made you so conscious of that?
I don't know what made me conscious, but maybe a lot of reading. I read a lot. So because of those readings, I got a little bit more influence for the need to build a strong culture. And because of the innovations which succeeded prior to formation of Marico, I wanted to build a very strong culture of innovation. So how do you create a culture of innovation was the biggest challenge. So I wrote down a lot of thoughts on my own and shared with my team at that time. I'm talking of early 90s, where culture was not talked about. And they took a very positive response. Then I went to a consultant from Delhi, Dr. Mrityunjay Atreya, and with his help, we internalized the culture. I went and talked to people, but culture doesn't start, starting point was me. Ultimately, it has to be owned by the whole organization. And the top leadership has to play a very important role. If they say that this is MD's culture, I don't agree with it. It's a disaster. I don't want to paste our values in the reception, and down the line, people say that this is not the organization which it is. It has to be exactly based on, it has to be lived. And for that living to happen, the top management, the senior management has to set an example. So there is a lot of in-depth, shall I say, attention given to culture, because ultimately in any organization, strategy plays an important. Strategy and culture has to fit in with each other. Culture has to help strategy.
So how different is that handwritten code of conduct that you took to Professor Atre? How much of that has been translated into actual reality over the course of the last 3 decades?
Good question. I think over a period of time, cultural values, there may be a need to change because the business has changed. Those days, there was no digital, the agility was not there. So every 10, 15 years, we look at our values and change the values. Some of the new values which have come in are to do with agility, to do with emotional connect, to reduce bureaucracy. So to have a global mindset, because we went global at that time, we were only Indian company. So it has to, you have to relook at what has the business gone into and what are the new needs.
It's interesting that you talk about emotional connect as one of the things that you've incorporated now into culture. Why is that?
See, some of the new things through COVID, we realized that the need to emotional connect was very high. The need to interact with people when they were living with COVID in terms of insecurity, somebody in the family, older person expiring, or so there was a lot of fear, and also realized that agility is very important because vaccines which used to take about 10-15 years to develop were developed within 2 years. So we can be agile. And I think we have tried to do that. Earlier our new product process was like 2 years. Now you condensed it, all that.
What did you change? What are you doing differently versus,
so I think
versus previous?
So normally organizational bureaucracy slows down agility, and the need to, especially interfunctional authorization helps. So we did a study in terms of over a period of time in any organization, new processes come in, new bureaucracy comes in depending on the change of the new person who's coming into the role. So we had a review of all the processes and cut down a lot of processes, which just made things much, much faster. On top of that, the overall top management has to move fast. And sometimes perfection and agility don't go hand in hand. So depending on the issue, if you try to be very, very perfectionist, you may just spend 1 year extra. And that higher degree of perfection may not be truly relevant for your success. So you need to take a call on that person.
So you're saying time to market has to be given more significance than the perfect product to market?
Yes, because if you don't do it, somebody else will precede you, So you may be missing out on an opportunity.
mental well-being, and I know, again, that's not something that has typically been a focus area for leaders, especially, leaders in India. Of course, post-COVID, it started to be talked about, but you've been doing it well before that. Again, why this focus, this emphasis on mental well-being? Where did that come from?
So I've never worked anywhere else, so I used to hear from many of my colleagues who had joined from outside, oh, this company, there is so much culture, there is so much of bureaucracy, there is politicking, there is backbiting, there is gossiping. So I was like puzzled. I said, why? And then half the time they would waste in doing all this nonsensical kind of thing just to... So if you want to get a promotion, you have to find out what is the whom will you back in terms of leadership.
So this is happening in other companies, you're saying?
That's what I meant on hearing. And I said, I don't want to have this kind of culture in the organization. I don't want all these pressures to come in. Because a lot of workplace pressure, a lot of workplace mental health issues can be tackled if you have the right culture. A right culture where there is high degree of openness. If I have to say something to you, I don't like something about you, I should be able to tell you on your face, rather than telling 20 other people that she's like this, So try to build in the culture of openness, trust, meritocracy, empowerment, and I think that's played an important role in people enjoying this journey, and hopefully our mental health issues, because the workplace pressures are lesser. Of course, there will be some other mental health issues. It could be because of certain relationships. It could be anything. It could be some health issues in the family, but at least try and improve the mental health quotient within the organization.
But how did you make it a two-way street? Because very often leaders expressing their own vulnerabilities is not something that we see.
I know that, but I realized that when I expressed my vulnerability, I was able to get very close to my team, because they said, oh no, you've never heard any leaders talking openly about their set of issues.
You talked about giving up control. And you've demonstrated that through the course of your career. But what are the deterrents that come in the way of actually giving up control? What were the demons that you had to battle with?
The biggest deterrent is the talent quality. It's the talent quality you have. Suppose a new recruit, you've taken somebody, and the quality of that or capability of that person is not there. Then you just can't empower that person, because then you are delegating, which means you are accountable for decision. You're not abdicating your responsibility. So delegation comes out of a certain confidence and trust you have in that person's capability. So initially, when I take a new person coming in, there will be high degree of involvement of mine. But the moment that person gets confident, gets trust and gets my confidence, then higher and higher empowerment will take place. So I think the biggest deterrent to giving up control or empowering people is the quality of talent and how that person is functioning. So if he is very caustic with his team, then I would be very reluctant, because then you're creating a culture of empowerment, participation. People have to enjoy working in the organization. And when you enjoy working, this work-life balance, I think it gets missed out.
What does work-life balance mean to you?
You have to enjoy your work. If you rightly put it, if you enjoy work, you don't have issues of work-life balance.
So you're not looking at your watch whether you've clocked a certain number of hours. You never did that, and you never did that for your team either.
Yeah, not at all. In fact, we have done away with musters, as used to have musters earlier, In early 90s, so you don't have to write musters. We trust you. We've done away with sick leave. If you're sick, you're sick. We don't have to you're not entitled to a sick leave or casual leave. So you're absolutely right. It has to come from within, because in today's times, when everybody can be sitting, but they can doing something on their own on their computer. Nobody will know. So no point forcing people to work hard. It has to come from within. You have to make people enjoy work. The moment people enjoy work, they will work and they will stretch themselves. And they will not have complaints of work-life balance. Of course, there will be some time in certain businesses which mean that you have to work much higher. But it cannot be on a perpetual basis, because then what happens is then you need to lead a certain lifestyle, certain habits, health, sleep, all that are equally important.
How important is that to you?
Very important.
Sleep, health.
Very important. I am wearing this gadget.
What is that?
This is Gabit.
Okay. What is your sleep score usually? What an average?
Last night was, no, I just started wearing this. Last night was one of the highest, 85, which is not bad.
So you were not nervous about this interview?
No. It measured your stress score also. I can show it to you right now.
So you're not stressed?
I don't get stressed much because if you do things right in the right way and you don't break laws and all, then you have the business which is strong enough because you're focused and you become market leaders.
So what's the Harsh Mariwala health regimen or routine? Like what is it that you do on a daily basis?
Okay, so morning I do, I have 10 minutes of posture exercise, just 10 minutes because I have a little weak posture in my back. And then I do 10 minutes of breathing and meditation. In the evening is my real workout time, which is 1.5 to 2 hours every day.
1.5 to 2 hours?
1.5 hours every day minimum. So it's a combination. It varies every day. So sometimes it's Pilates, sometimes weight training, functional training, then swimming or cycling in the gym, and then play golf.
So that keeps you healthy and rejuvenates you as well.
You don't do the same thing. Otherwise, it's very boring. So every day is different. Yes, of course. I can't sleep if I don't exercise. It's like exercising to me is like having a shower every day.
Market share. What have been some of the rules that you have adopted, not just to gain market share, but to keep market share intact? I mean, you've been a category creator, but to hold on to the lead, because as you said, there will be somebody who will come in taking your idea and perhaps even executing it better than you did. So what has been the mantra to hold market share?
So I think first of all, who is your competitor? You are losing market share to. You have to be clear about it and you have to protect your market share, sometimes it may mean that you have to sacrifice profits, but it all depends on the context. Who is the competitor? To what extent are they going to get market share? And that's what happened when Levers launched coconut oil. I'm talking of 30 years back. And then, they're much larger than us at that time, better distribution. There's a lot of fear that, okay, what will happen? They bought Tomco, one brand, they acquired one more brand. So we decided that this is our resource generating engine. At that time, it was Parachute was forming about 70% of our turnover and more than 70% of our profits. So we were very clear that come what may, we will protect. If it needs more advertising, it needs better distribution, lower pricing, we will do it. And at that time, we were a public company, but we gave a guidance to the capital markets that please, this is our financial performance for next 1 or 2 years may not be growing in terms of profitability, but this is what you decided to do. And I think that you were able to protect our market share because we adopted that kind of a stance and we gave that guidance, and the market also luckily bought into that argument. Now again, I say transparency plays a very important role. You have to be transparent. Even your capital markets, if you're going through a bad phase, whatever, you tell them. You have to earn their trust. The moment they earn their trust, then they are with you, saying, okay, this company is sharing their issue with us.
Speaking of lever, I want to talk about how things changed from almost having to fight off lever to then eventually going out there and acquiring a brand from lever. I mean, what was that like?
It was a great story. I think I enjoy talking about that story because at one stage we were very vulnerable. A lot of people told me that you will sell out this brand, and because Lever was desperate to buy it, they had also announced it in the capital markets. A lot of fear in the organization. So we took all the steps to protect our brand, but including I went, Uday Kotak told me to meet Karsanbhai Patel, who was at that time fighting Lever through his Nirma brand. I went and met him and concluded that we will take them on. And we know this business inside out. They are new entrants. For us, starting from me to the top team, there will be full attention given to this threat. For them, it will be some 3 layers lower than chairman will be handling that brand. And we'll take them on. And we took them on and nothing happened to our brand, our market share. Some of our competitors lost market share. So at some stage, they started losing interest because of Unilever globalization initiatives. And then they decided to sell the brand. We were very aggressive in acquiring. And again, the board played a very important role in saying that you have to acquire the brand. You don't try and double guess what others will come. You go all the way. Because you should not regret if you lose this brand. And we got this brand, and it has been one of the best acquisitions for us.
What will be the most relevant organizational structure? What do you believe the role, the job, the responsibility of a CEO today will need to be?
So I think this role and the responsibility of CEO has dramatically become more complex compared to the times I was a CEO, because the whole world is changing so fast. Whether it is technologies like AI or multiple technology, robotics or whatever, the impact on the business. Whether it's geopolitical developments, leadership in countries like US and all of a sudden things are so volatile and difficult to predict that you have to be on top of what's happening in the environment. On top of that, the organization needs have increased because of cybersecurity, because of AI, digital technology, governance, DEI, sustainability. So there are a whole host of new things which have come up on the horizon, which the CEO has to take care of. The structure has to take care of that. And within the structure, of course, you can't have too many reporting relationships. So what has happened at the CXO level, the responsibilities have increased dramatically.
So Harsh Mariwala transitioning from CEO to now virtually a strategic investor, if I could call it that.
Sure.
To many others who may be considering the possibility of doing so, but perhaps haven't yet made that decision, what would you like to share? What are the 3 or 4 things that you believe they should consider and they should emulate in making that journey from CEO to strategic investor?
So I think a lot depends on the family and the owners. It cannot be for every individual, every family to become a strategic investor. In my case, I was the only person managing the business. In some cases, there may be a family member who may be fully ready to take over, and there may not be any need for a strategic investor. But wherever a promoter has stepped down or the family has stepped down from managing the business, you have to become a strategic investor, which is a little more than just investor, little more than just a board member or chairman. Of course, because your stakes are very big in the organization. So the role which I have played in terms of empowering the individuals, but a structured way of getting a grip on what is happening in the business.
You're also helping other entrepreneurs build their businesses and build their dreams through what you are doing at Accent and what you're doing at the Marico Innovation Foundation as well. What excites you about what you're seeing in India today?
I think what is most exciting is the entrepreneurial journey and the number of new entrepreneurs which have come up in India from rural areas, from non-business families, leveraging their education, with, of course, the help of all the private equity and the eco support system. To me, India's future is going to be determined by the entrepreneurs. Because up to a point, the government, you can ask them to invest in whatever infrastructure. But beyond a point, the entrepreneurs will drive the India growth story. And I think that's what is exciting, is that we are seeing such a huge action at the entrepreneurial level, so many entrepreneurs and so many students wanting to get into that. To me, I'm most excited by that.
I know that leaving things in perpetuity is a big part of what you believe in. What would you like your legacy to be in perpetuity?
In terms of the company or
in terms of company as well as at a personal level?
So at a company level, I would say that the company should continue to be strong and, more importantly, respected. I strongly believe that you have to earn respect from all your stakeholders and not just your shareholders. So you have to do something for each stakeholder, whether it's your own employees or whether it's society or your associate. They should say that the organization has made a difference to them. At a personal level, I also feel that I think I have to make a difference to whoever I've interacted, whether it's an entrepreneur or whether it's a mental health initiative. And I think my journey is to make a difference to others, and I would like to be remembered for that. I would say that sometimes you win, sometimes you don't lose. You always learn, So there is always failure in experimenting, but use that failure for learning, And I have seen that many times we failed and it has applied that learnings from the failure to something else we've done in the future. That has worked wonderfully well, So don't be afraid of taking risks.
So sometimes you win and sometimes you learn. Harsh Mariwala, it has been such a learning experience for us listening to you. Thank you so much for sharing very candidly your insights with us here on the leadership language. It's been an absolute pleasure. Thank you very much for your time. Well, with that, it is time for us to wrap up the leadership language. From all of us here on the team, thanks very much for watching. If you enjoyed this conversation, then do visit CNBC TV18 Access. We'll see you again next week. Goodbye. Many thanks for watching.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. Rupee hits a record low in early trade but recovers later. India's trade deficit narrows to just over $24 billion in November as exports rise and imports decline. Commerce Ministry says India and the US are very close to a framework but stop short of prescribing a timeline. India proposes a preferential trade agreement with Mexico to avert the newly proposed 50% tariffs on goods from Asia. The Union government will table a new bill to replace the Mahatma Gandhi National Rural Employment Guarantee Act. The proposed legislation hikes the guaranteed working days to 125 per year from 100 days. Also mandates that most states will now bear 40% of the costs. Government tables a new bill to open up the nuclear energy sector for private players. The bill allows companies to build, own and operate a nuclear reactor. 49% foreign direct investment is allowed. Authorities invoke stricter pollution control measures as air quality in Delhi remains severe for the third straight day. Construction is banned. Primary schools go hybrid. UK, Canada and Singapore issue advisories to citizens to stay indoors. Flipkart receives NCLT approval to shift the domicile of its holding company from Singapore back to India, gets set for a potential IPO. The e-commerce major had mentioned earlier this year that it was working towards relocating its legal base to India. China's retail sales post the worst performing since COVID restrictions. Factory output slows to a 15-month low. President Xi Jinping warns officials against chasing reckless GDP growth, even as the economy appears to have stalled. 15 people are dead after a terror attack on Jewish people at Sydney's Bondi Beach by a father-son duo identified as Sajid Akram and Naved Akram. Australian Prime Minister promises stricter gun control after licensed firearms were used by the shooters. A heroic bystander named Ahmed El Ahmed, who tackled one of the gunmen and got shot in the process, is recovering in a hospital. Ukrainian President Zelensky offers to drop his country's bid to join the NATO in exchange for security guarantees, but rejects Washington's push to cede territory to Russia. Zelensky met Trump's envoy Witkoff and son-in-law Jared Kushner and European leaders in Berlin to discuss peace plans. 45-year-old Nitin Nabin appointed working president of the BJP as the party signals a generational shift. The five-time MLA from Bihar takes charge, ending months of suspense. He's expected to be formally elected as president in January next year. Messi mania grips New Delhi. The legendary footballer enthralls fans at the Arun Jaitley Stadium. His next stop is the Animal Rehabilitation Centre Vantara, where he will be hosted by Anant Ambani. Well, the top story this evening, it was a roller coaster ride for the Indian rupee today. The currency hit fresh lows in morning but recovered in late trade. The rupee plunged to a new record low of 90.79 against the greenback, but trade deficit narrowing to just over $24 billion in November did lift sentiments in late trade, sparking a recovery. Lata Venkatesh is joining us now with more on the rupee and the trade data. Lata.
Yes, it started off as another very weak day, and the fall was almost 0.5%. It was also not a fall accompanied by other EM currencies. 90.79 we saw, and 90.80 was a very important level where there are a lot of options written, we understand. The relief came because of the November trade deficit. November trade deficit, very important to note, $24.5 billion is the trade deficit. You know the number in October, 41.7 billion. So it's almost a halving of the trade deficit. And the if you looked at our own poll was expecting 30 billion. So even compared to the poll, it's like 24 billion is a very good number. If you took goods plus services, then the deficit is only $7.5 billion, $7.28 billion. In the month of October, it was almost $22 billion. So that again looks very positive. The worry is about goods exports. Services exports have come as good as last month or last year. But goods exports was what we were worried, because dumping in Asia, US locked out for us. But goods exports are up 20% year on year for India. It's about over 38 billion against 31 billion year ago and against 34 billion in the month of October. More importantly, exports to the US are up by 1.3 billion. That was the one which we were worried about. Looks like if you take out all the exceptions and then the ability of Indians to compete in some areas, the export hit is not very much. So dealers are very happy to note that the fall in the deficit has come because the goods exports have done well, not just services exports, which were anyways doing well. But is that the end of pressure? No. The pressure continues because of the overhang of the trade deal, nowhere in sight yet, as well the FPI's non-stop selling. Every day you think that the market didn't fall so much yesterday. Will we get a good FPI number? And it is a sell. In fact, dealers are telling us they're selling out of bonds as well. Until now, at least bonds year to date is a plus $8.5 billion. But lately they've been selling because they're losing out on the currency. And therefore there is a worry. I mean, our worries have not gone away. There is also additional day-on-day pressure. Month ago, NDF market interventions by RBI are maturing today. That cast further pressure. RBI is supplying dollars, but it's not trying to protect any level. And that's why the weakness is not going away. There is a temporary relief.
Quite right, Lata. Thanks so much for that. And just as Lata was mentioning, a key overhang for the rupee is the uncertainty over a trade deal with the US. Commerce Ministry officials told us that both sides are very close to a framework agreement aimed at dealing with a reciprocal tariffs. But the officials stopped short of prescribing a timeline. India has also engaged with Mexico after the country recently announced a 50% tariff on goods coming in from Asian countries, including India. Exports worth $2 billion to Mexico will be impacted by the new tariff. Commerce Ministry believes that the new tariffs are not targeted at Indian supply chains and is hopeful of signing a preferential trade agreement with Mexico that's compliant with the WTO rules. Meanwhile, Dalal Street recovered from lows to end the day flat but with a slight negative bias. The Sensex fell 54 points while the Nifty fell 20 points, holding on to the 26,000 mark. Now the banks bat for the bulls with the Nifty Bank Index ending in the green. The mid-caps fell in line with the blue chips. Now moving ahead, home furnishings brand Wakefit made a muted debut on Dalal Street. The company's stock listed at par with its IPO price of 195 rupees per share. It ended the day in the red on day one. Remember, Wakefit's IPO was subscribed just over 2 times, led by retail investors and qualified institutional buyers. And staying with listings, Pharma player Corona Remedies made a strong debut on the bourses. The stock listed at a 38% premium to its issue price of 1,062 rupees a share. The company's IPO was subscribed 144 times. And ICICI Prudential AMC's 10,603 crore rupee IPO was fully subscribed on day 2. Non-institutional investors and qualified institutional buyers led from the front. The company's IPO is a complete offer for sale with a fixed price band of 2,061 to 2,165 rupees a share. This values the company at around 1.07 lakh crore rupees. This will be the last big IPO of this year. Now, Walmart-owned e-commerce major Flipkart has gotten the green signal from the National Company Law Tribunal to shift its holding company domicile from Singapore back to India. This is a crucial step for the firm that is preparing for an IPO in India. The nod follows Flipkart's disclosure earlier this year that it was working towards relocating its legal base to India to better align its corporate structure with its core operations and business footprint, which are overwhelmingly domestic. In news now from the national capital, the winter session of Parliament continues amid a standoff between the government and the opposition. The Finance Ministry's request for supplementary grants was taken up by the Lok Sabha. There were fireworks in the House as members clashed over electoral reforms and the functioning of the Election Commission. The government has tabled a slew of new legislations, but the Insurance Amendment Bill, which proposes to raise the FDI cap to 100%, is yet to be tabled. The bill is likely to leave out composite licenses and the open architecture clause. Now, one of the key legislations tabled in the Lok Sabha is the Shanti Bill, or Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India Bill. This bill will allow private sector companies and joint ventures to build, own and operate nuclear reactors. This will effectively end government monopoly in nuclear energy and open the doors for private companies. The government is also proposing to create a unified legal framework and allow 40% foreign direct investment. The new legislation will replace Atomic Energy Act of 1962 and the Civil Liability for Nuclear Damage Act passed in 2010. The larger goal of the bill is to achieve 100% gigawatts of nuclear power capacity by 2047. What has sparked a controversy is the clause on liabilities. The bill shall be liable for damages except those caused by grave natural disaster as an exceptional character. Liabilities are also exempt during any armed conflict, civil war, insurrection or act of terrorism.
Core policy matters such as liability limits, safety standards, exemptions, regulatory norms, emergency measures, and even amendment of schedules are left to rules, regulations, or notifications issued by the executive. This abdication of parliamentary responsibility violates settled constitutional limits on delegated legislation under Article 245 and 246.
I just want to mention that most of these objections are based on the merits of the bill, which are normally and by convention taken up during the discussion. So right now we are here only to the competency of the introduction of the bill.
Well, the union government will table a new bill to replace the Mahatma Gandhi National Rural Employment Guarantee Act. The proposed legislation would be renamed Viksit Bharat Gua